All right, once again, good morning, everybody. Now, my name is Chris Kai, and I will be your MC for today, and along with a whole suite of speakers who will be sharing with you the economic outlook in 2023. So everybody, good morning, and it's so happy to see all of you here at FSM Invest Expo 2023. Having said all of that, I know all of you are around the hall right now. We do invite you to come on all the way to the back end of the hall here, where the stage is, because we got the speakers coming on up already to share with you the economic outlook, the tricks, the secrets, and what do you do to position yourself better towards 2023. Because as you know right now, it is very different. There is no longer a history of what has been done in the previous years. There are so many more things that have came up throughout the 2 years over the COVID period. And you can see with recent times, inflation, maybe recession. What can we do about it to position ourselves better? So if you are interested, come on down and be excited right here at this stage area. Having said all that, ladies and gentlemen, right now I would like to introduce our very first speaker to give us his opening address. So, ladies and gentlemen, please put your hands together and let's welcome General Manager from FSM1.com Singapore, Jean-Paul Wong.
Good morning, everybody. Ladies and gentlemen, very warm welcome to FSM Invest Expo 2023. It's been 3 long years since we had this event at Suntec. So the last time we had it was on 18th of January 2020, so just before something drastic that happened in the whole world, as you know. So that was just before the pandemic. So very happy to be back at Suntec for our flagship event. We do it every year in January. And the reason why we do so is really to be able to give all our investors the insights and hopefully useful tips for you to apply for your portfolios for the rest of this year. So there's going to be a lot of topics, a lot of discussions and debates, and some of us may not agree on our outlook for the year. But I guess that's the whole point of sharing different ideas for you. And hopefully during the course of today, we'll still get the chance to actually have some Q&A and some discussions at our Connect areas and at our partners' booths. And we also made it extra special because it's been 3 years after all. Extra special in terms of having very good prizes for you to go away with. So I hope that luck will be on your side as well for the lucky draws. And there will be some sure win, so that one doesn't depend on luck. So please join in our different booths and games later on today. So my topic today, it's this year it's different. What stays and what changes? So my point is, it's different because of what has happened in the last 3 years. It's different especially because of what has happened last year in 2022. And therefore, right, in terms of how we invest, there will be some things that we believe strongly will change. And we hope that you'll be able to see why. We're going to share the reasons. But also, at the same time, we also want to say that there are some principles that remain evergreen for you. So first, a recap of 2022. And the recap, as you can see from the performance of the different markets, it doesn't look fantastic. It's not a surprise, I think, for most of you. So if you look at the stock markets, the equity markets, right? So basically all the markets had negative returns, except for our home market, Singapore. In Sing dollar terms, it was actually positive. We ended at about 8% return. And the only other market that performed positively last year was Brazil. Everything else, including your US, China, Japan, all the major markets and regions, Asia ex-Japan, all went negative throughout 2022. So it was really a very difficult year for investors and for our portfolios, obviously, as well. And usually, when one asset class doesn't do well, what we hope is that the other asset class in our portfolio will do well. So in this case, bonds. But bonds also did very badly last year. And the reason is very simple, because we entered a phase where interest rates were increasing rapidly. So therefore, the negative correlation between interest rates and bond prices. So, interest rates go up, bond prices come down, and that's what we saw in the global bond markets. The best performing bond market was still negative, 11% down for Asian investment grade, and Asian high yield was the worst on this chart at 16% down. So I'm going to talk about what we think has really changed from last year and how it applies for your portfolio. So this time it's different. So this one part where we feel it's going to be different for us. Higher for longer interest rates. I think there's been quite a lot of optimism in the market that interest rates, after having been going up so fast last year, it's going to start coming down this year and even next year. Our point is, even if interest rates do start to come down, it's going to stay high. It's not going to go back to the kind of levels we have been used to in the last 10 to 15 years. That's something that we firmly believe in, and there's a few reasons why. I mean, low rates is something that we all wish for, right? Because, the last 10 to 15 years, we were looking at quasi 0% interest rates in many parts of the world. I think if I ask you here today, did some of you manage to get fixed mortgage rates at 1% in 2021? Anyone managed to fix their mortgage rates at 1%, 1.1% in 2021, just 1.5 years ago? Nobody? Anyone got 4.5% mortgage rates last year, fixed? Nobody? So I'm guessing that some of us managed to fix the rates, obviously, for our home loans at 1+% in 2021. But I think quite a number of us also had to deal with something not so pleasant, which is, the 4+% that we have to pay on our mortgages because of the rates last year, the huge increase. So in fact, this is the sharpest increase in the US Fed fund rate since 1988. So it's been a long time that the US Federal Reserve had to increase rates this fast over the course of 9 months. And there are a few reasons why we think higher for longer interest rates will stay. So firstly, tight labor market. So if you look at the US market, it's quite clear that the US market is still, very positive in a way, because the unemployment rate there is still pretty low. And therefore, for the people to find the jobs in the US, actually is relatively still okay. And some of them still have the bargaining power, in fact, to ask for higher wages. So that's a sign of a tight labor market. And I think in some ways, we also kind of still see that in Singapore, especially in certain sectors like finance. The other reason why we think rates will stay high for a long time is the Ukraine war, the Russia-Ukraine war. It's coming to 1 year soon in February. Very unfortunate thing, but we don't see signs, obviously. We can't predict when it's going to end, how it's going to end, and so on. But that obviously has implication on a lot of things, including commodities prices, especially wheat, and also oil and gas. That affects the whole world. So we can't expect, oil and gas to start to trend down rapidly, even if the war ends. I think it's something that's going to stay for a while. The other reason is, of course, the US-China competition. It's quite clear that for the US and China, long-term competition is something that's going to intensify. It's going to stay on. It's not something that will, improve drastically. And the reason is quite clear. I think the US sees China, obviously, as a strategic competitor in the long term. So there's going to be more measures from both sides, fighting each other, whether it's on semiconductors, restrictions. I think that's going to expand to other sectors going forward. So it's a long-term thing that's here to stay. And the deglobalization trend, therefore, also will intensify gradually. And that will obviously have disruptions on supply chains and also the kind of prices we pay for goods and services. I think for the US, especially because they have been importing a lot from China over the last 2 decades or so, they're going to find that inflation is going to stay high. So I have this little slide here. What I want to say that in July 2021 we had a webinar. We couldn't do physical events back in 2021, but we had a webinar, and it was our mid-year review, and our research team was talking about how this interest rate cycle will reverse inevitably. We have seen that happen, and we think that even though all these financial institutions, you can see on this slide from Bloomberg, they're basically saying that, rates are going to peak at 5%, 5.25% early this year. I think the disagreement among a lot of the global banks is where would they end by the end of this year. So some of them are saying that it will still stay high. Some are saying that it's going to start coming down. So we're basically saying that it's going to stay relatively high, and it's not going to definitely not going to go back to the kind of levels we're used to at 0% to 2%. And so what's the real implication for us? So the implication of a higher for longer interest rates in 2023. So firstly, I think the good thing is that the fear of missing out, or FOMO, that we have seen in the last 2 to 3 years especially, in certain speculative asset classes, like specs, like cryptocurrencies, that's going to die down. We've seen that dying down already last year. It's going to continue, and I think that's a good thing for investors because those are speculative asset classes. I don't think in the long term it's something that's good for our portfolios. And in a way, the fear of missing out is not going to be there for this kind of speculations. It's going to be challenging times for equities. You're going to hear from my research analysts later on, but there are a few bright spots. So I think one area would be the value-driven strategies. I think for many years, right, when interest rates have been low, in the last 10 to 15 years, it's difficult for value investors or value strategists to actually outperform because everyone just wants to go into growth during low interest rate environment. But what we're saying is that because rates are going to stay high for longer, value strategies and value-focused funds and unit trusts will tend to outperform in this kind of market condition. And in terms of regional economies, we're more positive on Japan. And for some of the thematic sectors, we're looking at bright spots such as ASEAN. So like I said, long-term, we're taking a defensive position on China. You probably read a little bit about our content. You'll hear from my head of research later on why. But essentially, I covered a bit of the reasons. Essentially, the long-term competition, US-China, is going to lead to a lot of measures that will maybe not favor China. And also internally in China as well, all these changes that we have seen politically, I think it's going to be long-term positive for state-owned enterprises generally, not so much for private enterprises, and I think that's going to have a negative effect on the entrepreneurship spirit of businesses and business people in China in the longer term. So for bonds, it's now easier, as you know, to take lesser risks and actually get decent returns, as you have seen in the last few months. So today, if you look at the Singapore Treasury bills, obviously coming from Singapore, so it's considered a risk-free asset, right? So the auctions that they do every 2 weeks, the last one, the cutoff yield, it's at 4.2%. So it's a very decent kind of yield for a risk-free asset that we have not seen in the last 10 to 15 years, obviously because of very low interest rates. So now we can get quite decent returns for risk-free assets. So it's interesting for investors because then for you, if you're looking to have certain, safer investments, then Singapore Treasury bills, Singapore government securities or something you could look at, and those are available for you to trade on FSM1. The other point, of course, is that you can also experiment and DIY your own portfolio, what we call the cash management portfolio. Our research team covers this idea every quarter, so we give different ideas on how you can do it. I'll have one slide on that later. And the last 10 to 15 years, I think a lot of us here may have some exposure to S-REITs. So S-REITs, of course, in a low interest rate environment, are attractive because they give us 4%, 5% per annum, right, in terms of yield. What we're saying is because rates will stay high for longer, the kind of yields that we can expect from S-REITs and different investments where we have to take certain additional risks, right, is perhaps not so attractive anymore. The compensation we should get from taking more risks should be higher yields, higher returns, right? So I think if we're looking at, let's say, 4-5% from things like S-REITs, it's perhaps not too worth the risk because we're getting 4+ from a risk-free asset like the Singapore government bonds. So I think that's one implication for you if you do have too large an exposure to things like that. And also for bond funds, you'll hear from my research analyst, Hui Shi. She will give you an idea. Basically, look for those that are focused on unconstrained strategies, those that are looking for shorter duration bonds, and also those that are looking for a higher quality. Higher quality would be the investment grade type of bonds as opposed to the high yield or junk bonds. So in 2023, perhaps not a surprise based on how I've been presenting so far, we favor fixed income versus equities as part of the asset allocation point of view. So this time, what is not different, I also wanted to cover that. It doesn't mean that, higher rates for longer, it's a huge difference for us. It's a huge impact for us. But there are things that don't change. And I think some of these things will not change. The benefits of regular savings plan, I don't think that changes. In fact, I really like the discipline behind how I invest a sum of money every month into the different asset classes that I like, and how that can snowball into something meaningful. Meaningful could be different for all of us. In my case, meaningful could be goal setting for retirement. It could be goal setting for my children's education. For some of you, maybe it's about travel expenses. So you can't take maybe too long term. You are looking at 6 to 6 months. So maybe a government bond could be interesting for you, or even our FSM auto sweep. So like a well-oiled football team, since we just finished the World Cup and so on, I just want to say that we need the defenders and the strikers in place to position our portfolio in a solid position. We can't just have strikers scoring goals, but don't have defense, and vice versa. So I'll give you an idea here of what I mean. An idea of a global balanced portfolio from our portfolio management team. So this one is an example of a balanced portfolio. Balance means is right smack in the middle in terms of the risk profile, 50% in equities, 50% in bonds. So if you look at the fixed income breakdown, essentially it's diversified across global bonds, different regions, Asia, but also credit risk like investment grade and so on. It's also diversified across equities, so you can see US, Europe, and so on. And also there's a couple of sectors like digital economy inside. And then of course there will be the products and the weightages inside. So that's one example. Happy to talk more about it, later on. And I talk about the DIY cash management portfolio. So here, essentially, determine the risk profile for yourself, the kind of yield you want for yourself. You can mix and match the different funds, and also diversify across the different funds and fund managers. So in here, I gave 2 examples: Sing dollar and US dollar DIY cash management portfolios, where you have an anchor fund, where you can have a higher weightage. And then the yield enhancers would be lower weightages, but essentially you could be looking at 4.5 to 6% kind of yield. That varies, of course, and comes with certain risks compared to your Singapore government bonds. But I'm essentially sharing with you that you can create something that could be quite attractive, especially versus your savings account rates and your fixed deposits. Investment in knowledge pays the best interest, so Benjamin Franklin said that. So I just wanted to wrap up with 3 slides. Investment Academy, so that's something we have for our clients. We are big on investor education. That's why we organize the FSM Invest Expo every year. We also organize other events like ETF Festival and so on. So these are some of the courses where our research team and our investment influencers that we partner with provide the different courses. Some are more tactical, some are more basic in terms of 101 education. So you can see which one suits you better. And there's the QR code for you if you need to, go land on the page. Rewards program, I just want to tell our clients that, we want to provide the best services for you. And also, as part of that, we have the rewards points. So whenever you invest, you earn rewards points. Whenever your assets stay with us and grow over time, your rewards points also grow. And you can redeem your rewards points for different things: unit trusts, bonus units, retail, and also perhaps your favorite charities as well. And as part of this whole concept of rewards, giving you more rewards, we launched in September last year the FSM debit card. So you can sign up for the card on the web or our mobile app. And exclusively just for today at the FSM Invest Expo, if you sign up for the card today, we can help you at our booth later. You can get 8% cashback during the promo period. So it's very exclusive to all of you here today. And the benefits of the card is, of course, you get cash back. Secondly, you can use it to spend globally online, but you can also use it to go to other countries. And we have just launched the physical card today as well. And the main point also, I think, in terms of the benefits is better FX rates versus the bank's kind of FX if you're going to use, your card to buy things overseas or on Amazon US and so on. So with that, I just wanted to thank you for your presence. I hope you enjoy the event today. Good luck for all the prizes, lucky draws, and all the games. And I hope to catch up with you later. Thank you very much.
All right, so truly very insightful, and what a great way to start today. Now, ladies and gentlemen, throughout the entire day, as you would see on the program, on your flyer as well, do use it to guide yourself around the hall and also with the talks that we have. Because if you have seen it, you can see that the talks are back to back and they are truly very engaging. So talking about that, ladies and gentlemen, right now we have another talk for you. So this title will be Stop Dreaming About 2% Inflation. Time to start getting prepared for an era of high inflation and mortgage rates. So once again, ladies and gentlemen, how do we better position ourselves? We would like to introduce our speaker for today on the topic, Assistant Manager, Research and Portfolio Management, iFAST Singapore. Let's welcome Tan Te Jin, CFA.
All right. Good morning, everyone, and welcome to FSM Expo 2023. So I remember very clearly that the last time that we held this event was actually back in January 2020, right before COVID-19 shut everything down. So it's been a good 3 years since we saw everyone already. And on behalf of the team here at FSM1, I'd like to welcome everyone back. It's really good to see you guys again. So my name is Te Jun, and I'm with the research team at iFAST. And to kickstart today's presentation, I will be sharing our investment outlook for 2023. And as you can see on the slide over here, we have prepared a total of 10 points for our outlook this year. But unfortunately, because of time constraints, I will not be able to go through all 10 points in detail. However, the good news is that many of these points, they will be covered by my colleagues in the sessions later on, so please be sure to stick around for them. So my objective today is actually very simple, and that is to give you guys a better understanding of where we are in terms of the global macro environment, what to expect going into 2023, and more importantly, I will also be sharing some tips on how you can position your portfolios given what we are expecting. And hopefully after this, it will leave you in a better position to manage your own portfolio. So without further ado, let's get started. So before we jump into our outlook for 2023, I want to do a quick throwback to our mid-year review event that was held in July last year. So what you're seeing on the screen is actually a screen grab from the event. That is actually me sharing the investment outlook as I'm doing today. And if you look to the right-hand side of the screen, you can see that the title of my presentation at the time was, Your Mortgage Rate is About to Spike to 5%. And at the time, we were doing some analysis on interest rates, and even though we thought that the 5% mortgage rates projection was slightly aggressive, it was nonetheless appropriate given the unrelenting pace of Fed rate hikes. But since then, what we have seen is that many banks, they have started to pull fixed rate mortgages off their shelves only to reintroduce them at higher rates. And if we fast forward to today, fixed rate home loans, they are currently as high as 4.5%. And with the 3-month SORA crossing the 3% mark in December last year, floating rate loans, they are not far behind either. So as a matter of fact, one of my colleagues just shared with me earlier in the week that her monthly mortgage payments have gone up by about $1,000 from the beginning of last year compared to this year. And that is a substantial increase during a period of 1 year. And I'm sure that those of you here who have bank loans will be able to relate to this as well. And judging by the way things are going, 5% mortgage rates may soon become a reality. So I think the question on everyone's minds now is, how did we get here? And the short answer to that question is because of inflation. And that leads me into the first point of our investment outlook, and that is inflation and interest rates will likely stay higher for longer. Now, there are two parts to this point, so let's talk about inflation first. So you might have heard of the saying that inflation is the #1 enemy of central banks. And that is certainly the case throughout the past year and a half, as many central banks, they struggled to bring down inflation in their economies. So in the US, you can see that consumer price growth, they grew at a rate of 9.1% in July last year. And even in the Europe, consumer prices, they were still in the double digits at about 10.6% in October last year. So this surge in inflation is actually driven by a number of factors, such as the excessive amounts of pandemic stimulus, supply chain disruptions, and of course, the Russia-Ukraine war. And even though inflation has since moderated in the recent few months, it still remains well above the central bank's target of 2%. And while some market participants, they are under the impression that inflation is going to fall magically back to the target rate of 2%, we don't think that is likely. So we think that inflation is in a structural shift, and the decades of low inflation, they are probably gone for good. In other words, inflation is going to stay higher for longer. And here are a few reasons why. So first of all, let's have a look at the energy sector, in particular the oil and gas industry. So since the start of the Russia-Ukraine war, oil prices, they have pretty much gone on an uptrend, reaching as high as more than $120 per barrel back in June last year. And even though oil prices, they have come down notably since then, they still remain significantly higher compared to pre-pandemic levels. And aside from one of the obvious reasons driving oil prices higher, that is the Russia-Ukraine war, another reason keeping oil prices higher is also because of a structural underinvestment in oil and gas assets. And if you look at the chart over here, you can see that in 2021, the annual investment in upstream oil and gas assets amounted to $350 billion US dollars. So make no mistake, $350 billion, it is an incredible amount, but it still pales in comparison with the amount that was invested back in the early 2010s, as you can see over here. And this is considering the fact that fossil fuels, they still account for 80% of the world's energy. And the reason for this underinvestment is largely due to ESG concerns, as more countries are starting to move away from fossil fuels and towards clean energy. While I personally think that this move is certainly a step in the right direction to meet our climate change goals, it is unrealistic to expect that these changes will materialize overnight. So for one, the generation of renewable energy has not been keeping pace with rising energy demand. And until this transition is complete, the world will still have to depend on fossil fuels for the time being. And on top of that, the green transition is also likely to contribute to longer-term inflation, as it is likely to create a huge boom in demand for rare earths and strategic metals that are used in electric vehicles and also other forms of renewable energy. So moving away from energy and onto food. So food prices, we think that they are also going to be higher for longer. So the Russia-Ukraine war is obviously one of the key drivers of food inflation as well, as both countries, they combine to supply nearly 1/4 of the world's wheat. So back in November last year, both sides actually agreed to a 4-month extension of the Black Sea grain deal, and that has actually brought some relief to food prices in recent times. But what we have learned multiple times in the past is that these changes, things can change in an instant, and there is no guarantee that food prices will not rise again. And to make matters worse, food protectionism is also on the rise as governments, they try to safeguard local food supplies, adding to inflationary pressures. So if you think back to last year, there might be a point in time where you walked into NTUC and you realize that the price of chicken meat has gone up by 20, 30, maybe even 50%. And the reason for this is that Malaysia actually implemented an export ban to stabilize domestic prices. So aside from this, Indonesia's ban on palm oil and also China's fertilizer ban, these are some examples of how rising food protectionism can actually add to food inflation. And last but not least, extreme weather patterns, the impact of climate change, they will also continue to challenge agricultural use and contribute as a long-term driver to food price inflation. So last year, we have seen many instances of extreme weather patterns such as droughts in the US and also severe heat waves that wiped out hundreds of acres of crops. And finally, shortages in the labor market, they are also giving rise to wage inflation. So even after several rounds of rate hikes, the US labor market, it continues to remain resilient. As of November last year, there are nearly 1.7 jobs available per person registered as unemployed. Job gains, they continue to beat expectations, and the unemployment rate remains low relative to historical standards. So thanks to this resilient labor market, workers, they have greater bargaining power, leading to wage gains. Rising wages also means that the increased cost of labor for companies, they will eventually have to be passed on to consumers in the form of higher prices, thereby fanning inflation. Now, we've talked a lot about inflation. Let's move on to interest rates. So a resilient labor market and stubbornly high inflation leaves the Fed no choice but to continue tightening. In a span of 9 months, the Fed has actually raised rates by a total of 425 basis points, making the 2022 rate tightening cycle the most aggressive since 1980s, as you can see from this table over here. But aside from the Fed, central banks across the world, they are all tightening in unison. as inflation in many countries hit multi-decade highs. As a matter of fact, monetary policy has never been so overwhelmingly tilted towards rate rises in the past 5 decades. And synchronized tightening, this can be extremely hurtful to an already fragile economy, especially when consumers and businesses are already under immense pressure from higher inflation and borrowing costs. Now, with both inflation and interest rates likely to stay higher for longer, this brings me to my second point, and that is a global recession is likely unavoidable. So across the world, tighter monetary policy is starting to bite. Over in the US, the leading economic indicators index has been on a downtrend since June 2021. On the other hand, CEO confidence, which is another measure of the health of corporate America, is at one of the lowest levels since the GFC. And as a matter of fact, there are 98% of survey respondents, they are actually expecting a US recession to occur in the next 12 to 18 months. Things are even worse in Europe, with more than 99% of respondents expecting a recession there. So both these measures, they suggest that economic growth is likely to deteriorate further in 2023. However, the US is not the only economy to face a slowdown in business activity. With global growth slowing, PMIs across most major markets are also on the decline, as you can see from the chart over here, which shows you the global composite PMI index under the 50 line, which indicates a contraction. And this also reflects the headwinds that are faced by many countries in the global economy. And to make matters worse, consumer spending, which accounts for roughly 2/3 of US economic growth, is expected to decelerate as households, they continue to face a mix of high inflation and soaring interest rates. So if you draw your attention to the blue line on the chart, you can see that the savings rate in the US has actually fallen to a low of 2.3% in October, and that is way below the pre-pandemic levels of about 9%. So if you're wondering why the savings rate actually spiked in early 2020, that is because those were the early days of the pandemic. Most people were stuck at home, they were unable to travel, go out and spend, which is why you see savings shooting up. But since the US economy started to reopen, that's why you see savings coming down to the level that it is today. Now, if you draw your attention to the yellow line on the chart, it shows you that credit card balances in the US has actually reached a high of $925 billion in the third quarter of last year. And that is actually close to the all-time high that was set back in 2019. So what this tells us is that inflation-wary consumers, they are starting to rely on credit and savings in order to keep spending. And this is a trend that we think is not sustainable, especially if inflation and interest rates are likely to remain high. Furthermore, the yield curve, it remains deeply inverted and it signals a recession. So since 1980, every recession in the US has been preceded by an inverted yield curve. So if you look at the chart, the 10-year minus 2-year Treasury spread has successfully predicted all 5 recessions in the US with only one false alarm in 1998. The 10-year minus 3-month Treasury spread is even more accurate, having predicted all 5 recessions also, but this time without a single false alarm. An inverted yield curve, it is considered to be one of the most consistent and reliable indicators of a recession, and the likelihood of a recession, it tends to be greater the deeper the inversion and the longer the curve stays inverted. And as you can see, as of December, the 10-year minus 2-year Treasury spread is currently at about negative 50 basis points, and it has been inverted since July last year. On the other hand, the 10-year minus 3-month Treasury yield curve is also inverted at negative 65 basis points. And if you look back to 2008, you can see that the magnitude of the current inversion is actually already deeper than 2008. How long will the curve stay inverted for? Only time will tell. So outside of the US, Europe continues to struggle with high levels of inflation, with consumer price growth still in the double digits as of November last year. So the ECB has since responded to high inflation with multiple rate hikes, marking a shift away from the negative interest rate regime that it has adopted over the past 10 years. And this is a move that will likely weigh on growth. So Europe is also in a precarious position given its heavy dependence on Russia for energy. And with the Nord Stream 1 pipeline to remain shut indefinitely, and as we head deeper into the winter months, an energy crisis looks increasingly likely. And if one materializes, we can expect massive production cuts to hit Europe's manufacturing industry, and that will inevitably result in lower economic growth. So China, on the other hand, it is also not in a position to boost global growth. After the conclusion of the 20th National Congress back in October last year, there are signs that China is starting to lean towards a more state-controlled economy as opposed to a free market economy. On top of that, geopolitical tensions are also escalating dangerously as China goes head-to-head with the US over issues such as trade, semiconductors, and of course, Taiwan. On top of that, COVID cases in China, they are also on the rise after China basically abandoned its COVID-0 policy overnight. However, vaccination rates among the elderly is low, and the healthcare system is not equipped to handle a large surge in hospitalizations. As China becomes increasingly isolated from the world, coupled with weak domestic demand, its economy also faces stagnation. So all in all, with most major economies on a much weaker footing than before, we think that the question of a global recession, it is no longer an if, but rather a when. And with global growth slowing sharply, our base case is for a recession to occur in 2023. However, this upcoming recession, it is unlikely to be as severe as the one that was experienced back in 2008, as the balance sheets of households and businesses, they remain strong. On top of that, the financial system itself, it is also on a much stronger footing than before. And last but not least, inflation-driven recessions, they tend to be milder compared to credit-driven recessions. Now, with points 1 and 2 out of the way, let's talk about some ways that you can position yourself given the environment that we are expecting. So going into a recession, we believe that a more defensive positioning is warranted. Therefore, in terms of asset allocation, we have a preference for fixed income over equities. So widening credit spreads, combined with monetary tightening, have pushed bond yields close to levels that were last seen during the GFC. And as of December last year, the yield to worst on the Bloomberg Barclays Global Aggregate Index is about 4%. And this much higher than normal yields today, it actually creates an opportunity for investors to receive higher total returns over time. And on a relative basis, the valuations of fixed income, they have also turned much more attractive compared to equities. So if you look at the chart over here, it shows you that the spread between earnings and bond yields have contracted substantially, and it is now at about 3.2%. And that is one of the lowest levels on record, and also more than 2 standard deviations away from its historical average. So what this chart tells us is that at this point in time, equities, they are relatively less attractive compared to bonds, which is why we favor fixed income over equities. And within fixed income itself, we prefer investment grade over high yield and short duration over long duration. So let's tackle the credit quality first. So going into a recession, we believe that a more defensive positioning, it should be important. And investment grade bonds, they are likely to outperform their high yield counterparts, as the latter is likely to experience greater credit spread widening as economic conditions continue to deteriorate. And in terms of duration, our preference here is actually for short duration bonds. So the reason is because yields on short-term bonds, they have moved up significantly higher compared to longer-term yields, which implies that investors can actually receive higher total returns over time without having to take on greater duration risk. So in Singapore's context, just think of our T-Bills, where T-Bills are offering you 4.2%, while the 10-year Singapore is about 3 plus 4%. So that's what I mean. So more details on our fixed income outlook will be shared by my colleague Hui Shi right after this. Now, moving on to equities, we expect value stocks to continue outperforming growth stocks in 2023. Value stocks, they tend to do well during periods of high inflation and rising interest rates. And during this, in a rising rate environment, we think that investors should actually look to reduce the equity duration of their portfolios by favoring stocks that derive the majority of their valuations from current fundamentals, aka value stocks, rather than those that depend on earnings that are way out into the distant future, aka growth stocks. The current macro environment, it also remains supportive for value stocks, but challenging for growth stocks. And we do expect this environment to persist, especially as inflation and interest rates are expected to stay higher for longer. Furthermore, value stocks, they have been a lot more resilient compared to growth stocks, as they have experienced much smaller negative earnings revisions compared to growth stocks during this economic downturn last year. Last but not least, value stocks, they continue to trade at a wide discount to growth stocks, and that further increases their attractiveness. And even though we think that investors should adopt a value tilt in their portfolios, that does not mean that you should ignore growth stocks entirely, especially given the sharp sell-off in growth stocks last year. So tech stocks, which constitute a huge universe of the growth stock universe, will remain relevant in the long run, especially as the world we live in becomes increasingly digitalized. So that's it. Investors who wish to retain some exposure to tech stocks, growth stocks, should opt for high-quality tech names with strong profitability and balance sheets. So moving on to point number 6, following our downgrade of Chinese equities, developed markets, they now look more attractive compared to emerging markets. So within the developed market space, we have a preference for US and Japan. Japan, it is currently our top pick because of its accommodative monetary policy, the positive impact from reopening of its borders, strong pricing power of its companies, and of course, attractive valuations, all of which favor an upward re-rating for Japanese equities. As for the US, even though we are expecting a recession to occur in 2023, it is likely to be mild, as I have explained earlier. So for investors who wish to retain exposure to US equities, you can consider a value tilt for the reasons that I've highlighted in point number 5. Meanwhile, Europe will most certainly enter a recession in 2023 and is the least attractive market amongst developed markets. High inflation, rising rates, and the threat of an energy crisis will inevitably result in lower or worse negative economic growth. So moving on to China. As some of you may already know, we have recently downgraded China to a rating of 2 stars, not attractive, back in November last year for a number of reasons. So first of all, China is leaning towards a top-down state-controlled economy as opposed to a free market economy. And with SOEs now prioritized over the long-term profitability, the private companies, the long-term profitability of the private sector is now at risk. Secondly, geopolitical tensions with the West, they are also escalating dangerously as the US goes head-to-head with China over the issues that I've mentioned earlier. And with China abandoning its COVID-0 policy, hospitals, they are overwhelmed, people are staying home for fears of contracting the virus, and along with a property crisis, domestic demand remains weak. So overall, investing in China today comes with significantly higher risk, and that is why we have factored in a higher country risk premium for China. So more details on our outlook for China will be shared by my colleague Wei Ren in a session later on. Moving on to point number 8, we have 3 tactical ideas for you to consider for your supplementary portfolios. So the first is ASEAN equities. So ASEAN is one of the regions that will benefit from a shift in supply chains away from China. Despite an economic slowdown, the region's economic data has remained robust, and we expect growth in the region to remain relatively resilient amidst the reopening and recovery. So ASEAN inflation is also relatively milder compared to other major economies such as the US and Europe, and thus we expect a less hawkish response from ASEAN central banks, and that should be more supportive towards ASEAN growth as well as its equity performance. So for our second tactical idea, we have commodity-linked equities. So given our expectations for commodity prices to remain higher for longer, we think that investors should get some exposure to commodities. So energy prices, like I've explained, they are expected to remain at elevated levels as demand remains constrained thanks to years of underinvestment in the sector. Meanwhile, the mining sector, it will also be supported by long-term structural trends such as the green transition. And with regards to food prices, they are also likely to stay elevated as repercussions of the Russia-Ukraine war, rising food protectionism, and of course, climate change that is affecting agricultural use. Last but not least, we have defensive sectors. So with a global recession likely unavoidable at this point, we think that investors should add some exposure to sectors that are relatively more resilient in a recession, such as healthcare as well as consumer staples. So moving on to point number 9, we expect India to benefit from a less constructive outlook for China as investors rotate into Indian equities within emerging markets. So India is a prime location for international supply chains thanks to its wage advantage, pro-business environment, and government incentives. The nation, it also benefits from secular domestic tailwinds, such as a rising middle class and a relatively young population, both of which should support the long-term growth story of Indian equities, especially its consumption story. In addition, economic reforms such as a reduction in corporate tax rates and also a production-linked incentive scheme should help to drive foreign investment as well. However, despite the many positives of India, the biggest drawback for Indian equities is that its valuations are lofty right now. And with that said, we think that now might not actually be the best time to invest in India. However, given its fundamentals, we think that investors should still keep India on their watch list and look to invest when valuations become more attractive. And finally, to point number 10, we expect the USD to peak in 2023. So the USD has had an incredible run last year. The dollar index has rallied by as much as 19%, and that is actually driven by a sharp rise in policy rates. So thanks to the wider interest rate differential between the US and also the rest of the world, US assets, they have managed to provide a much higher rate of return, thus increasing the demand for the USD. So, and aside from the higher interest rate differential, the robust economic strength of the US relative to other countries has also increased the USD's attractiveness as a safe haven currency. But moving forward, with the Fed expected to slow the pace of rate hikes in 2023, the main catalyst behind the USD's appreciation, it is effectively lost. And secondly, with a weakening US economy, it should also lead to a weaker USD, and this effect is amplified, especially if global growth weakens less than the USD. And last but not least, the wider trend of de-dollarization may also eventually lead to lower demand for the USD in the future. So, last but not least, you can also see that from the chart over here, based on valuations, after a sharp rise in 2022, the strength of the USD has hit its ceiling already. Based on the real effective exchange rate, the USD is now trading at more than 2 standard deviations above its historical average, and that is a level that has proven to be unsustainable in the past. And with the USD expected to decline, investors should avoid USD share classes wherever possible. And with that, I've covered all 10 points of our investment outlook. I genuinely hope that this session has been useful to all of you. Once again, thank you so much for coming down bright and early for FSM Expo. And before I go, I'd just like to wish everyone here all the best in your investing journey, and I hope that everyone can make lots of money this year. Thank you and goodbye.
Thank you. So, thank you very much, Durchin, for that very insightful talk. Can I just highlight everybody that the main thing and takeaway out of all of this year is to be able to rotate and to reposition, because this year it's different. So, the good investors will be knowing what to invest from the previous years, looking at the back. The great investors are the ones who are constantly knowing that what is in the past may not be relevant for right now and towards the future. So this is why you're here today, and we are so excited. So, talking about that as well, right here, how can we know about the different things to invest? So, right now, we will be having a talk about how stocks are no longer the only option. Here's why fixed income is returning to the forefront. Ladies and gentlemen, let's welcome Senior Research Analyst, Research and Portfolio Management, IFAS Singapore, Yo Hui Shi.
Hello everyone, welcome again. So my name is Hui Shi and I'm from the research team at IFAS. So you just heard from my colleague Durchin about how we are starting to see attractive value emerging within the fixed income asset class. For many decades, the world had enjoyed low inflation and an accommodative monetary policy. This also meant that interest rates were extremely low and bond yields offered little returns. As a result, many investors saw stocks as the only viable option to generate reasonable returns for their portfolios. Back then, we were in an investment landscape that was also called the TINA market. Now, TINA, it is an acronym. It stands for There is No Alternative. And this is made in reference to investors seeing no viable alternative other than stocks to put their money in because interest rates were just so low. But today, that is actually no longer the case. We have entered into a different investment landscape, one that is categorized by a structurally high inflation as well as higher for longer interest rates. And with this, the bond market is becoming a more interesting place for investment. We no longer have to rely only on stocks to generate nice returns for our portfolios. And I think it's time for us to say goodbye to TINA. And in fact, new acronyms are beginning to take its place. For example, there is an acronym called BORROW, which stands for Bond Earning Real Yields, lovely. And we also have TERA, which is an acronym for There Are Reasonable Alternatives. And we have BUB, Bonds Are Back. I think there's a presentation by a fund house later on with a similar title. There are even more examples, but I won't go through them one by one. I think you can pretty much call it what you want. Just get this important point which I'm trying to put out here, which is that fixed income is now providing higher yields, and this is providing investors with the potential to receive better or lovelier returns. And I think that is underpinning the growing attractiveness of fixed income as an asset class today. So if you take a look at the global bond yields now, they have climbed to nearly about 4%, similar to what was seen during the global financial crisis back in 2009. And today's higher bond yields, they can be mainly attributed to monetary tightening, as well as widening credit spreads as markets price in an economic slowdown. And in the past, there were plenty of negative yielding debt, meaning that investors who bought into this kind of bonds, they actually lose money. But today, thankfully, this is changing because the world's pool of negative yielding debt has shrunk to a 7-year low due to higher interest rates. And meanwhile, credit fundamentals across the global credit universe remain in good shape. Debt metrics have experienced a meaningful fall from their peaks during the COVID-19 pandemic. Corporates hold ample liquidity with strong interest coverage ratios after taking advantage of the low interest rate environment over the past few years to refinance their debt at lower rates. So such healthy credit fundamentals combined with today's higher bond yields is providing investors with a fairly attractive entry point. And this should also enable fixed income as an asset class to play a more relevant role in enhancing the risk-reward ratios of our portfolios. And on a relative basis, fixed income has also become more attractive. So simply compare the yield of global bonds against the earnings yield, which is equals to the inverse of the PE ratio of global stocks. And you will find that the surge in bond yields has far outpaced the increase in earnings yield, causing the yield spread between equities and bonds to narrow further over the last few quarters, reaching around 3.1%. And this 3.1% is actually its lowest point on record since 2009, and is actually now over 2 standard deviations below the 10-year average. Now, what this suggests is that equities have become relatively more expensive as compared to bonds, and that investors are now actually poorly compensated for taking on equity risks. And therefore, we believe that there's no clear need for investors to rush into risk assets, such as equities, to chase yields or returns any longer. With the days of TINA clearly over, we think that now is the time for investors like yourselves to start going back into fixed income. Furthermore, we expect the global economy to sail towards a recession in 2023. And the implication of this is that risk assets like equities will face headwinds as companies will experience slower earnings growth. And we also believe that inflation is in a structural shift categorized by shortages in commodity and labor markets, as well as deglobalization. So companies are likely to see their margins increasingly under pressure. And if you put this together with a slowdown in earnings growth, we think that equity returns are likely to moderate moving forward. Now, with the return of relative attractiveness for fixed income compared to equities, as well as taking into account the headwinds to risk assets against an uncertain macro backdrop, we urge investors to take on a more defensive positioning by overweighting fixed income relative to equities in your portfolios. And within fixed income, we prefer to move higher up in quality, which also means that we're actually currently not too keen on high-yield bonds. While high-yield bonds, they do offer attractive income, we think that a defensive positioning may be more important in a recessionary or even a stagflationary environment. For riskier credits like high-yield bonds, slowing earnings growth as well as dampened margins are likely to significantly raise credit as well as default risks, paving a way for a further widening of credit spreads. So if you look at the credit spreads of global high-yield bonds right now, as shown on the screen, they remain quite narrow at about 550 basis points. So this is below its historical average, and also it's quite a stretch away from past recessionary levels. Overall, the greater sensitivity of high-yield bonds to the economic outlook suggests greater room for spread widening, and hence a relative underperformance as compared to investment-grade bonds. So this is also why we prefer investment-grade bonds over high-yield bonds, because an allocation to safer segments within fixed income would allow investors to capture the higher yields from the asset class without having to take on too much credit risk. Now, in terms of duration exposure, we actually prefer short duration bonds. So, the yield shape of the US yield curve actually right now is quite flat, with the inversion seen between the 2-10 spread and also the 3-month as well as the 10-year spread. So clearly, yields on the shorter end have moved up a lot higher as compared to yields on the longer end. And as a result, short-term bond yields, they are more competitive. So if you take a look at this chart shown on the screen here, a year ago, investors can get a decent return of up to 0.9% by moving away from the 1 to 3 year maturity bucket. But today, if you move along the yield curve, you can hardly get any yield pickup. So in other words, going short duration means that investors can receive attractive yields without having to take on greater duration risk. And besides that, there are also other important reasons why we prefer short duration. While long duration bonds, they do historically outperform during a recession, we believe that this time will be different. Because we see the potential for long-term yields to move up even higher as we think that markets are underestimating the persistence of inflation. So right now, markets think that the Fed will cut rates significantly as soon as 2023 in order to combat a recession. But this is where we differ. Even if a recession comes, we don't think that the Fed will cut rates this year. And the Fed officials have also expressed their intentions of keeping rates higher for longer in order to fight inflation. And we think that markets have not woken up to this reality yet. And without a rate cut, the slope of the yield curve is not expected to steepen meaningfully. And that also suggests that now is not yet the time for investors to shift towards longer dated bonds. And moreover, short duration bonds, they can benefit from the pull to par effect, meaning that even as short duration bonds experience mark-to-market losses because of market volatility, they should still produce some upside for investors along the way as their prices approach par value upon maturity. And meanwhile, longer dated bonds, they typically do not benefit from this kind of pull effect because the maturity date is too far away to provide investors with a reasonable amount of certainty regarding principal repayment as well as the market yields. Now, considering all of the different points that I've just mentioned, we think that the best place for investors to be right now is, in fact, in the short-dated investment-grade bonds. In summary, higher interest rates have enabled bonds to present attractive yields which are not seen in more than a decade. Investors can no longer complain about bond yields being ridiculously low. And with the higher yields today, we think that bonds are now able to serve as a viable alternative to stocks. And from a portfolio perspective, we actually prefer fixed income over equities. And this defensive positioning comes as fixed income has finally regained its relative attractiveness compared to equities, as well as the expectations of the global economy sailing towards a recession that will slow earnings growth, as well as a structurally high inflation that will dampen companies' margins. Now, within fixed income, we believe investors should stay up in quality by opting for investment-grade bonds, allowing investors to get higher yields from the fixed income without having to take on too much credit risk. And in terms of duration, we believe that it should be kept short. Value is to be found in short duration bonds as investors can receive attractive yields without having to increase their duration risk. And furthermore, we hold the view that a Fed rate cut in 2023 seems highly unlikely even if a recession comes. So this also means that now is not yet the time to shift towards longer dated bonds. So at this point in time, I hope that you will start to pay more attention to fixed income if you haven't already. And to help you get started with investing within this asset class, in the next couple of slides, I will also share with you some of our recommended bond funds. Now, the first fund that I've highlighted here is called the United SGD Fund. This fund aims to achieve a yield enhancement over SGD deposits with a long-term view to preserve capital by mainly buying into investment-grade bonds. The fund uses a 3-year bond ladder approach, meaning that it staggers its bond investments with different maturity dates across a 3-year time frame. So this ensures a steady stream of cash flows while enabling the fund to take advantage of higher interest rates in the rising rate environment. And looking into the fund's composition, we observe that it is diversified across different Asian markets. But any foreign currency exposure is actually hedged back to the Sing dollar in order to mitigate the risk of currency fluctuations. Now, considering China's sizable role within the Asian fixed income universe, the bond's largest market allocation is actually to China, but only at about 24 or 25% of the portfolio. Within China, the fund has a preference for bonds which are issued by state-owned entities, also known as SOEs, whose economic values are driven by state policies as well as they are of great importance to the Chinese government. And now overall, the fund has an average credit quality of BB+, which is investment grade. Its duration is short, and in the current environment of rising interest rates, the fund has reinvested into higher yielding bonds, allowing its portfolio yield to climb to over 5%. And the next fund that I've highlighted here is called the Lion Global Short Duration Bond Fund. Now, this fund invests mainly in SGD-denominated bonds of investment-grade quality to lower overall default risk. So in other words, this fund targets investors who wish to earn a higher yield compared to fixed deposits or money market funds by taking on slightly higher credit risk. In line with its investment objective, its largest market allocation is to Singapore at close to around half of the portfolio. And again, all of the non-SGD positions are actually hedged back to the Sing dollar to mitigate currency risk for local investors. And the fund has an average credit rating of BBB, and its portfolio also produces a yield of around 5%. The duration exposure is short and is targeted to be kept below 4 years. And third, the next fund that you should really check out is the Nikko AM Shenton Short-Term Bond Fund. Now, this fund seeks preservation of capital and liquidity, so it invests in a diversified portfolio of good quality short-term bonds as well as money market instruments. And with such high-quality investments, the fund has an average credit quality of A-. It is also diversified. China makes up the highest allocation, but only at about 20% to 23% of the portfolio. This is followed by Singapore and Hong Kong, which are the second and third largest markets respectively. And similar to other funds that I mentioned, non-SGD positions are hedged back to the SGD. The fund's duration is very short, at only about 1 year, and is expected to be kept short due to the deployment of additional cash towards bonds of around 1 to 2 years maturity. And with this current positioning, the fund has achieved an attractive portfolio yield of 5%. Overall, I believe that such funds will appeal to conservative investors who are looking for a yield pickup over money market instruments. The fund's allocation to high-quality, short-duration credits not only limits downside risk during market volatility, but also is able to generate a steady stream of cash flows. And out of the 3 different funds that I've just mentioned, I believe that this particular Nikko AM Shenton Short-Term Bond Fund will probably stand out to you as it is the safest option as measured by its average credit quality. So what I've shared so far, their funds focus on SGD-denominated bonds as well as the Asian fixed income market. Now, moving on to global bonds, which is another segment that we quite like. A recommended bond fund for the global bond market is the Allianz Global Opportunistic Bond Fund. What is unique about this fund is that it uses an unconstrained bond strategy, meaning that it is different from traditional bond funds in a way that it is not managed against a fixed income benchmark, but rather a cash-based index. And therefore, the fund has higher flexibility when it comes to its choice of fixed income assets. It seeks to exploit the best opportunities from global fixed income markets across the cycle and provide investors with decent returns regardless of the interest rate environment. Now, in view of the weak economic growth, inversion of the yield curve, as well as high inflation, markets have become risk-averse. And in line with this, the fund's credit asset allocation has actually gravitated towards developed market government bonds, the majority of which are US Treasuries. And as a result, the fund has a very high average credit quality of AA. Its portfolio produces a yield of over 4%. Duration exposure is currently at about 3 years, though due to its unconstrained nature, its duration exposure at any point in time can actually range from as short as near 0 years to as long as 9 years. We believe that investors should look beyond traditional bond strategies, which lack the ability to adapt to the ever-changing market environment. Unconstrained bond funds, such as this fund shown on the screen, is able to react quickly to changes in market circumstances while striving to seek out the best opportunities from global fixed income markets. Now, putting everything together, fixed income is becoming more attractive, and we hold a favorable view on high quality as well as short duration bonds. Now, in the short duration bond space, our recommended funds, the Nikko AM Shenton Short-Term Bond Fund, United SGD Fund, and the Lion Global Short Duration Bond Fund currently hold portfolios that yield around 5%. And over in the global bond space, we prefer an unconstrained bond strategy, such as the Allianz Global Opportunistic Bond Fund. And this is because unconstrained bond funds can react quickly to changes in market circumstances, such as adjusting their duration exposure along the interest rate cycle. And also, moving into 2023, we expect the US dollar to peak, and therefore we advise investors to hedge their USD exposure where possible. And that is also the reason why we have opted for the SGD hedge share class for the Allianz GOB fund. And with that, I've come to the end of my sharing for today. Thank you so much for your kind attention.
All right, so now that has expanded our horizon on what to invest in and what to look out for. With that said, we talked about earlier that this year it is different. So one of the main topics is that it's going to be on China itself. Ladies and gentlemen, right now we have a talk that's going to be talking about the China of the next decade will be vastly different from the China today. And this is bad news for investors. Let's find out more. Ladies and gentlemen, please put your hands together and let's welcome Senior Portfolio Manager, Research and Portfolio Management, IFAS Singapore, Yu Wei Ren.
Hi, good morning everyone, and thank you so much for joining us here today. My name is Wei Ren. I'm part of the research team at IFAST, and today the focus of my presentation will be on the Chinese equity market. The China of the next decade will be very different from the China today, and this is bad news for investors. We are, of course, no fortune tellers. We can't tell you how China will exactly be like in 10 years' time. But what we are seeing in China is certain structural trends that have affected the long-term investment case for Chinese equities. And for those of you who have always been closely following our investment views, you probably would have known that we have always been bullish on China all these years. But we have seen certain things that worries us. There are certain red flags in China's equity market, and we have also taken the recent difficult decision to downgrade our outlook for Chinese equities, which is going to be the focus of my presentation today. I'll be going through the rationale behind why we have recently downgraded our outlook for Chinese equities. A lot of it will be centered on the long-term structural trends of China, but before I can even talk about the long-term outlook for China, I need to first address the short-term outlook. And in the short term, China is dominated by news about its COVID-19 policy. And I think, as all of us here may already know, China has basically dismantled its entire zero COVID policy. This was a policy that they have resolutely implemented for the past 3 years. But in just 2 months' time, policymakers in China, they have made a sudden U-turn on their zero COVID policy. They have removed pretty much every single one of their testing, quarantine requirements. They have also aggressively rolled out policy measures to rescue their property market. And I think more recently, they have started to reopen their borders to the world. So investors, they have clearly welcomed all these changes, as you can see from the strong rally in the Chinese equity market over the past 2 months. MSCI China up by more than 36% in just 2 months' time. The Hang Seng Tech Index has jumped by close to 45% over the same period. So investors are clearly very bullish over the prospects of Chinese equities. But for us, we are quite cautious even amidst this bullish consensus forming for Chinese equities. And I think there are reasons to believe that this rally will actually not be sustainable. And that is largely because the positive impact from China's reopening, it will not be felt immediately. China has eased its zero-COVID policy too fast, and it has not undertaken the preparations that will be necessary for a safe reopening. So if you look at some of the examples of countries that have previously pursued zero-COVID, for instance, Australia, New Zealand, Singapore, we have also pursued zero-COVID in the past, but these countries implemented zero-COVID not as a way to completely eliminate the virus. These countries, they pursued zero-COVID as a way to buy some time in order for the governments to properly protect their populations before they started to open up. So that involves vaccinating the population, that also involves stocking up on antiviral drugs, and also to expand your healthcare resources so that your hospitals are able to cope with the surge in hospitalizations. So China had 3 years to do all these things. But guess what? They've wasted their time away. So up until the point when they started to reopen their borders, China has actually not done any of these things. So their elderly population, it's still relatively under-vaccinated. Just 40% of those over 80 years old, they have had booster shots. So just to give you a bit of perspective of how low this number is, in Singapore, this percentage is actually 90%. So we made sure that our vulnerable people are well protected before we started to open up. But for China, only 40% of their elderly, they have had booster shots. China, they have also not approved the use of the more effective mRNA vaccines, and they have also not done anything to address the vaccine hesitancy amongst its elderly population. Its healthcare system, it's also not equipped to handle a surge in hospitalizations. And we can see very clearly in terms of the ICU beds that it has in China. China has less than 4 ICU beds per 100,000 people. And that is a lot lower compared to the 30 beds per 100,000 over in the US. And already we are seeing news reports of China's hospitals, not just their hospitals, their crematoriums are being overwhelmed in China as well. So quite clearly, they are not prepared. And for people who want to self-medicate, they want to manage their own COVID-19 conditions at home, they go to the pharmacies only to be greeted by empty shelves. China has the second largest pharmaceutical industry in this world, but yet they have not stockpiled enough antiviral drugs for their population to deal with this COVID-19 outbreak. And I think the worst part about this is that so far, the waves of COVID-19 that we've been reading in the news, they've so far been confined to the more developed areas such as Shanghai and Beijing. The rural areas, they have not seen the peak of the COVID-19 wave yet. But this is about to change because Chinese New Year is just around the corner, which also means that millions of people, they are going to travel back to their hometowns to celebrate Chinese New Year. And they are going to bring the infections back to the vast rural areas of China. And these rural areas, they are not well equipped at all. If Beijing and Shanghai don't have the resources to cope with a surge in hospitalization, much less these rural areas, which are less equipped in terms of their medical and their healthcare systems. So a wave of deaths is likely to come. So I'm not sure if they have had a clear exit strategy when they decided to reopen its borders to the world. I don't think so. I don't think they actually had a plan. But even if they did, so far, everything points to signs of a mismanagement and also a planning failure for the Chinese government. And for those people who think that maybe, perhaps, by reopening, I could see a potential boost to economic growth that can offset some of the costs to China in terms of human lives, they will also be disappointed because China's economy, it remains under pressure. It will be some time before the positive impact from reopening, it will be felt in the Chinese economy. So in the short term, there will be some disruptions because people are going to fall ill. Some people may unfortunately pass away from COVID-19 infection. And this has already created short-term major disruptions in industries like healthcare, in financial industries where workers, the shortage of workers has been so severe that even those who are tested positive, they are expected to come back to report to work. And what about parents who have to stay home because lessons have moved online? And for those people who have elderly relatives at home, they also have to stay back home and take care of their elderly relatives as well. So in the short term, there will be this business disruption. And for the rest of the general population, I think most of them are actually quite afraid of contracting the COVID-19 virus because for the past 3 years, the government's propaganda on the COVID-19 virus is such that COVID is something very scary, it's very dangerous. They talk about the high number of deaths in countries that have decided to live with COVID-19. They talk about the long-term impact, the effects of long COVID. And they have painted COVID-19 to be so dangerous that China needs to be locked down in order to eliminate the virus. For 3 years, they have been doing that. Of course, now in recent times, they have changed their messaging to say that, oh, actually COVID-19 is not that scary after all, just like your common flu, nothing to be afraid of. But for 3 years, they have been saying the opposite. So people are hesitant to believe their new messaging right now. And also, especially since on social media, there are so many stories, there are so many pictures of people dying, body bags piling up in crematoriums, and also long queues outside hospitals. So all these things, they hardly reassure the population that COVID-19 is actually not that dangerous after all. So some people, they have decided to just go into self-imposed lockdowns, even in the absence of COVID-19 restrictions. And these things are starting to show up in several data points, such as the subway traffic in China's 4 largest cities. So after China has eased their zero COVID policy, subway traffic has actually plunged very substantially. Movie ticket sales, which is also a gauge of people's willingness to go out of their homes. So this has also plunged substantially as well from the same period 1 year ago. And China is opening up at a time when the rest of the world is slowing down and potentially heading into a recession. So that also means that its exports industry is going to come under pressure. And that also means that domestic consumption will have to rebound very strongly in order to pick up the slack that is left behind by its exports industry. I'm not sure if there will be a strong rebound in consumption because at this point, consumer confidence is still relatively low. Youth unemployment is chronically high at 20%. Qualified young graduates, they are jobless in China. And for those people who are able to find jobs, the lucky ones, they find themselves having to settle for much lower pay as well. These young people are so disillusioned in China that they are now talking about lying flat. Some people are talking about letting it rot in China. They are so disillusioned that they are now giving up on their career prospects in China. So in this kind of an environment where people are generally very cautious, where people don't really have a very bright outlook of the economy, it is very difficult for consumption to rebound very strongly in this coming year. And guess what? COVID-19 is not the only thing that China needs to worry about. Even if the COVID-19 situation stabilizes in China, they have to worry about a lot of other things. The property market is one thing that they need to worry about, which is, of course, undergoing a crisis. So the Chinese government, they have been rolling out a lot of policy measures. Just yesterday, they were thinking about rolling back their 3 red line policies that have hampered the real estate property for the past few years. So they have been trying very aggressively to rescue their property sector, but so far, they have not succeeded in reviving the property market. And the key reason for that is because there is a confidence crisis in China's property market. The home buyers, they are not even convinced that the properties that they buy will indeed be completed by the property developers. So there is this lack of confidence because if you look at the completion statistics, only 60% of homes that are sold between 2013 to 2020, they have so far been delivered to home buyers. And I really don't blame them for having this lack of confidence towards the property developers. And let's just say, even if they are, the confidence manages to return to the property market, buyers may also not feel secure enough about their own financial situation now in order to commit to a property purchase because the outlook is very uncertain and property prices have been falling continuously. And then there is also the wealth effect because housing makes up 60% of household assets in China. So if property prices keep falling, if confidence takes longer than expected to recover, so this will have a psychological impact on consumers because they now feel perhaps poorer and less secure about their own financial situation. So that will have implications for China's economy. Now, I've so far been talking about the shorter-term outlook. Okay, now it's time to spend a bit of time to talk about the longer-term outlook for the Chinese equity market. So for us, we think that the long-term investment case for China, it has been affected recently by the recent leadership changes that has been announced at the National Party Congress last year. So President Xi managed to secure an unprecedented third term as the leader of China's Communist Party. But I think what was really unexpected was his picks for the party's standing committee. Because for decades, the standing committee is actually made up of politicians from all factions of the party. China is not known for their checks and balances. They are not known for that. But within this standing committee, this power-sharing structure across all factions of the body, all factions of the party, actually ensured that there is some power sharing, ensured there are some checks on the leader, and it also ensured that there is no one single person in the party who will dominate policy decision-making in China. But this has clearly changed last year because President Xi has eliminated pretty much all his opponents within the party, and he has installed all his allies within the standing committee. So he now has a lot more power, a lot more control over policy making, and he is perhaps the most powerful leader since the days of Mao Zedong. So for us, this is a red flag because while we have been bullish on China over the past few years, I think there are certain structural trends that we see due to this consolidation of power that has led us to become a bit more defensive on Chinese equities. So what are some of these structural trends? One of which is in terms of the economic direction that President Xi is taking China towards. He is moving China away from a market-oriented economy to a top-down, state-controlled economy, which is an irony because the reason why China has been able to achieve high economic growth over the past few decades is largely because of its embrace of a free market economy. But under the leadership of President Xi, he has in fact been pushing the economy in the opposite direction towards a state-dominated growth model. And at the center of this state-controlled model are China's state-owned enterprises, your SOEs. So SOEs, they have long been criticized for being inefficient in their operations. A lot of the zombie companies in China, they are SOEs. So, which is why over the years, China, they have implemented a lot of reforms to privatize them, to make them more efficient and more competitive in the marketplace. But again, all these reforms are being undone by President Xi because he thinks that SOEs should be the backbone of the Chinese economy. Because SOE, they are always there to help stabilize the economy when times are volatile. They help to develop key technologies, and most importantly, SOEs help to support government initiatives. The private sector, on the other hand, they have been seen as extremely greedy in the eyes of President Xi. They have strayed very far away from the traditional values of the Communist Party, which is why the government has in recent times been wanting to increase their control and influence within the private sector, starting with the crackdown on China's technology sector. But outside of the tech sector, there is already signs of increased influence in the private sector because the government, they have been taking board seats inside private companies. They have also been setting up party committees in private companies to discuss things like ideology and party values. So this gives the government increasing control and influence over the corporate strategy of private companies, and it enables them to mobilize private sector resources to achieve national objectives. So there are several implications from this shift to a more top-down, state-controlled economy, one of which is the fact that China's economy will likely enter a low-growth period because now the government has pretty much full control over all economic resources in China, and this will allow them to mobilize all of these resources to achieve national objectives, such as achieving self-sufficiency, achieving social stability, and some of these objectives may not be favorable to China's long-term economic growth. Second, the long-term profitability of private companies are now at risk because private companies in China, they are now expected to prioritize national objectives ahead of profitability. And the last implication of this is that policy mistakes will be higher because policy-making decisions, power is now concentrated in the hands of a few politicians, or maybe arguably in the hands of one politician. The other structural trend that we see is rising geopolitical tensions. And I think 2022 has illustrated very clearly that peace in this world is no longer something that can be taken for granted. And at the center of this new geopolitical environment is actually rising tensions between the two largest economies in the world, US and China. So with President Xi in charge of China, I think it's very unlikely that he is going to moderate his foreign policy stance. And he will likely steer China away from reconciliation with the Western world. Even if he decides to reconcile with the West, the issue with this is that the trust and goodwill that has been built up over the last few decades with their Western partners, it has already been shattered by the many years of aggressive wolf warrior diplomacy under the leadership of President Xi. So countries now are starting to reassess their economic dependence on China, because China has, in the past few years, showed that it is willing to exercise its economic might. It is willing to weaponize its economic power on countries that disagree with them or on countries that criticize them on the world stage. So this is what has been happening over the past few years. So the trust has already been broken. For businesses, China now becomes an increasingly challenging place to do business in. For the past 3 years, they have to deal with COVID-19. They have the zero COVID policy. They also had to deal with an uncertain regulatory landscape in China. And now they are caught in the middle between US and China tensions. And businesses in general, they don't like to deal with uncertainty because they need to plan ahead for the longer term. So with this kind of an uncertain geopolitical environment, I think it is very likely that businesses will start to relocate part of their operations, if not all of their operations, away from China. They are willing to bear the risk of incurring higher costs of production just to make sure that they go to somewhere that provides them with a bit more certainty in terms of their production processes. So the shift away from China, it is likely going to accelerate. So I think my key point here today is that I think China is now a market that comes with significantly higher risk. And the fact that there is no obvious successor in the standing committee right now, it also suggests that President Xi is probably eyeing a fourth term as the leader of China as well. And this means that he's going to be around not just for the next 5 years, he is going to be around for the next 10 years and possibly beyond that time frame as well. So even though valuations may be cheap, I think the long-term investment case for China has been permanently damaged. China now comes with increasingly higher risks, okay, because of some of the structural trends that I've talked about just now, and also that there is this lingering issue of Taiwan. China is likely going to take a harder line approach on Taiwan, and it has also not ruled out the use of force to reunify with Taiwan if necessary. And I think this is something quite alarming because China's armed forces, they have reportedly been told to be ready by 2027 to reunify with Taiwan. That is actually just less than 5 years away. So we can no longer rule out the possibility of conflict between China and Taiwan. And when that happens, China will become uninvestable overnight, as we have seen in the example of Russian equities. So nobody thought Russia would invade Ukraine until Russia actually did, until actually started the invasion. So investors woke up the next day only to realize that their investments in Russian equities are suddenly worthless overnight. This risk also applies to Chinese equities right now. And because of that, I think if you want to invest in China, you need to factor this into your investment consideration as well, and perhaps require a higher margin of safety before investing in Chinese equities. Okay, so just to sum up whatever they have shared just now, I think amidst the bullish sentiment for Chinese equities, I think for now we prefer to be a bit more cautious. We're still unconvinced with the investment case for Chinese equities because they now come with much higher risk. So our recommendation for investors is to underweight China in their portfolios. So for investors who have a high concentration of Chinese equities in their portfolios, and if you also agree with us that perhaps the right thing to do for your China exposure is to underweight China in your portfolios, Don't go ahead and sell everything at one go because that is dangerous. Because in the short term, there can be very strong rebounds. You have already taken a lot of losses from your China exposure. So the last thing that you want is really to miss out on all these strong rebounds in the Chinese equity market. And in the past 2 months, we have already seen a very strong rebound. So this could be the time to perhaps consider reducing some exposure, some China exposure within your portfolios. For investors who disagree with us, and if you still want to invest in China, I think that's okay. But it now means that it is now more important than ever for you to align your China exposure with the objectives of the Chinese government. So that means investing in areas like SOEs, which are favored right now, and also investing in industries that are favored, such as your hard technology, green energy, electric vehicles, and also advanced manufacturing. But then again, there's also a risk that China could change their mind overnight and render some of these industries invalid in the long term. There is this risk. Investing in China is now essentially a bet on the China's leadership, a bet on their ability to manage the economy well. But as we have seen over the past few years, they have successfully turned a health crisis into an economic crisis, a real estate crisis, a youth unemployment crisis, and amidst all these crises, the health crisis is still unresolved and perhaps could be escalating in the months ahead. So we're not convinced by this track record. We don't think it's reassuring, which is why we have decided to downgrade our long-term outlook for Chinese equities. So with that, I've come to the end of my sharing. Thank you so much for your time.
All right. Thank you so much, Wei Ren, for that outlook and context about what China is going through and what they will eventually go through in the coming years. Ladies and gentlemen, right now, as we have seen the context and heard the context, we want to go for a little bit more juicy things, which is going to be a shopping list for everybody. And what exactly is the shopping list? Now, just to highlight, the next talk coming up will be that the recession drumbeat is getting louder. But here is a shopping list for equity markets. Ladies and gentlemen, let's welcome Assistant Manager, Research and Portfolio Management, IFAS Singapore, Colin Low.
Hi everyone, I'm Colin, Assistant Manager of IFAS Research Team, and it is good to see everybody back here again after a long battle with COVID. And last year was a great year when it comes to COVID for Singapore, but it wasn't that great for equity markets at all. I'm sure many of you guys know that as well. And unfortunately, last year was a roller coaster ride, and there were many ups and downs in markets, and also for investors' emotion as well. But mostly, this roller coaster headed down. So with central bank expeditiously hiking interest rates, we think that the recession is an outcome, unfortunately. And with that, many investors may think to themselves, okay, what other markets are we going to invest in? And especially if we are downgrading our long-term view on China, our long-term positive view on China, then what other markets are there to invest in? So with that, today I'm going to share 3 ideas that we are positive and we are excited about heading towards 2023. So let's begin. All right, but first, let us take a quick look back at equity markets last year, and there were several defining moments that shaped equity returns last year. As you can see from the slides here, we do have the Russia-Ukraine war, which is unfortunately still ongoing. We have the persistently higher inflation, and that drove the Fed rate hike as well as the rate hike cycles around the world, and that led to a global growth slowdown. And unfortunately, elsewhere around the world, we also have troubles in China with COVID issues, with the real estate issues. So collectively, these factors dragged global equities down by 20% last year. And in fact, across the world, most markets delivered negative returns in Sing dollar terms. And if you can see from the chart right here, only 2 markets stands out, Brazil and Singapore. They were the top performers and only positive returning markets under our coverage. The other markets all delivered negative returns between -1% all the way to -29%. But that said, after this heavy drawdown, equity markets are right now trading much cheaper entering 2023. And while the risks are still present and the risks are still prevailing, and we do see opportunities in several markets. So let me share the first market that we're positive about. Starting off with Japan, which is one of our top picks entering 2023. So the first reason why we like Japan is the reopening tailwind, which we expect to keep consumption strong and thereby supporting economic growth this year. And we see this playbook in US and in Europe, and we believe it will repeat itself again in Japan. So driving this reopening tailwind is a very strong tourism spending. And this is important because Japan's tourism sector is an integral part of the economic growth, which, as shown on this chart right here on the left, you can see that it contributed about 7% of its GDP in 2019 alone. And the jump in the tourism, inbound tourism in Japan is almost 5 times compared to last year as of the end of October. And based on tourism projections, it is likely that tourism spending itself will be full-blown this year. And this will directly support the already resilient economic domestic consumption in Japan, which have started to accelerate when the state of emergency ended last year. So this is shown on the chart on the right, where you can see that the growth of consumption has sped up after the end of the state of emergency. So with consumption nearly 2/3 of Japanese economic growth, we think that the consumption-driven recovery itself in 2023 will keep the economy resilient at a time when global growth is softening and global export demand is weakening. And the next reason why we like Japanese equities is because of its balance sheet strength, and which we believe will be extremely valuable when global growth slows down, as Japanese companies can deploy this massive cash reserve not only to defend, but to recover operating expenses. And Japanese corporate balance sheet strengths are in a strong position. As shown on the chart by the right, you can see that the sum of cash and cash equivalent and its ratio to current assets have surged over the past decade to a near record high. In fact, close to 50% of the Japanese listed companies are net cash, as shown on the chart by the left. And you can see why this is impressive, because this is almost double that of US and European listed companies. So the next reason why we like Japanese equities is because of its very attractive valuations. So the region itself right now is currently trading at a gaping 22% discount to its long-term average in terms of its forward PE ratio. So valuations right now, as we find, are abnormally cheap, and as such, low entry valuations, this sets up for potentially attractive longer-term returns, which is hard to find even in today's environment. So lastly, Japanese equities, we believe, should benefit from currency tailwinds, and we expect the yen to march higher against broad currencies in 2023 from a deeply undervalued level. And as shown on this chart right here, the yen right now is trading at its all-time low since 1980, and on a real effective exchange rate basis. So while a stronger yen, some may argue, may dampen overseas earnings, we think an appreciation from the current extreme level will not materially hurt Japanese corporates, at least not in the near term, because the effects tend to lag and companies do hedge their FX. And overall, we do see that this tailwind itself may drive the FX return, enhancing the overall Japanese equity return. So to summarize, these are the 4 reasons why we like Japanese equities, and we see a steeper than expected global recession, as well as a faster pace of BOJ tightening as key risks to watch out for. But looking ahead, we do expect an upside potential of 40% by the end of fiscal year 2025, which is by March 2025. So for investors seeking exposure to Japanese equities, we also do recommend an unhedged share class due to our views on the yen. So next up is US equities. While many may agree that the region has been hit very hard last year, we do see better performance this year, and let me share some of the reasons why. So firstly, we are less pessimistic on the US growth despite a potential recession. While we expect growth to slow, we do not think it will slow like what we've seen in 2008 or even at the start of COVID. So we believe that US consumption, which is a major growth driver, is likely to buffer against a deeper slowdown. And there are several macro indicators pointing to a resilient US consumers. But today, I would just like to highlight the current strength of US household balance sheet. So in a nutshell, simply put, the household liquid assets, which comprise of your checkable deposits, your currency, your money market funds, and all that together, they have climbed to an all-time high, giving consumers greater ammunition to spend. And at the same time, there are lesser immediate liabilities for household despite higher debt. As you can see from the chart by the right, debt servicing costs as a share of disposable income have fallen significantly, especially after COVID when the income of the US consumers went up. So net-net, we do think that US households are definitely in a better position now than in 2020 when COVID hit, and that should buffer against the drag from a deeper recession. So on the topic of a recession, we find that the median drawdown of a US recession from peak to trough for US equity prices was around minus 25%, as you can see clearly from this chart right here. And this is in line with our expectation of a mild recession. And with the US already declining about minus 18% from last year's peak, we do think that a lot of damage has already been priced in. And it is likely that there may be further market weakness coming from corporate earnings decline as we move ahead with the year. But if history serves as any guide, we do think that further drastic drawdowns might be limited. And comparing that against last year, this means that the risk reward for US equities have actually improved. So regarding Fed funds rate, we expect it to peak around 5% before going on a pause for the remainder of the year. And you can see that with the Fed fund rate forecast that we have right here on this chart. And this is important for US equities given its larger concentration of longer duration assets, or you guys might know it as growth assets, which have a large amount of cash flow accumulated over a longer term period. And this makes US equities very sensitive to changes in policy rates. And therefore, equity weakness driven by higher rates should subside if rate hikes are removed from the equation. So to be clear, the pressure on growth stocks will likely stay, but may not worsen when the Fed hits a pause button. So nonetheless, we do see that this factor should be enough for equity prices to find support. So to illustrate this, here is a chart of the 10-year US real rates and S&P 500 forward PE. As you can see clearly right here that whenever the real rate spikes, which is denoted by the green line right on the chart, the forward PE, denoted by the purple line, compresses, and equities take a hit as a result. However, with an impending Fed pause and a potential peak in nominal yields, real rates may ease this year, and equity valuation may see less pressure. So to summarize, unlike Japan, where we see several tailwinds, the case for the US centers more around the fading headwinds. And the fact that a lot of the damage has been priced in makes us more optimistic regarding the risk-reward moving forward. And we see an over-aggressive Fed as a key risk, as this raises the odds of a deeper recession. But nonetheless, looking ahead, we do expect an upside potential of around 11% over the next 2 years. And we do think that investors should fare better with a value-focused strategy because US value right now is still supported by the high inflation, the interest rate high environment. And it also faces less risk from the upside in inflation as well as less risk from an overly aggressive Fed. Right, so after turning negative on China, as illustrated by my colleague Wei Ren, and after downgrading several key Asian markets like India, like South Korea, and even Hong Kong, we have decided to dial back our optimism for Asian equities. However, ASEAN is definitely a region that we still like, and we find it to be a more resilient expression for Asian equity exposure. And let me share a couple of reasons why. So first, we think that ASEAN should see relatively stronger economic growth and milder inflation headwinds this year. We expect ASEAN to grow at a stronger pace compared to major economies, supported by a few factors, mainly China's reopening, Thailand's tourism-led growth, and also Indonesia's commodity support growth. And furthermore, ASEAN inflation is also less dire than what we see in the West. And inflation in ASEAN right now, across the major economies, are either peaking or has already peaked. And as a result, ASEAN central banks have been and will continue to adopt a less hawkish response, and that should be less damaging to the region's growth. Since COVID hit, ASEAN earnings have lagged regional peers and consensus have remained rather pessimistic. As you can see from this chart right here, EPS estimates have barely rebounded since 2020, and they are only right now slightly above the historical low. And on top of that, you can see that for the fiscal year 21 and 22, they have been revised downwards. So all that are indicators of how pessimistic the consensus have been regarding ASEAN's EPS. But we believe that the consensus has definitely priced in a significant negativity, which becomes obvious when you compare against the ASEAN's economic outlook shown on my previous slide, where things are still very rosy. So when you compare both, we do see that there is a wide disconnect between both. So given how pessimistic estimates are for ASEAN EPS, we see very limited room for EPS to fall further as we head into a potential recession. And this means that there could be a smaller magnitude of earnings-driven downside for ASEAN equities this year. And the other reason why we like ASEAN comes from a portfolio perspective. So we like ASEAN as we find it to be a more resilient expression for Asian equities. So let me highlight two supporting data. Firstly, comparing to Asia ex-Japan, ASEAN demonstrates half the correlation to China, but almost the equal correlation to US and global equities. So what this means is that for investors, they can substitute ASEAN for Asia ex-Japan to cut correlation to China by half while maintaining equal correlation to the US as well as global equities. So this can significantly reduce China-related downside risks. And we believe this is helpful given our negative view on China itself. So secondly, Asian equities is more volatile than ASEAN, as you can see from the chart by the right. The 12-month volatility for the equity return for ASEAN is almost half that of the Asia ex-Japan equities. And as you can see quite clearly, and the reason why AXJ or Asian equities is so volatile is because of China. And then China's volatility, equity volatility has surged over the past couple of months especially, and that has driven the Asian equities volatility so much higher. So with that, you can see that these two factors strongly support the fact that ASEAN equities are definitely a more resilient equity exposure when it comes to the universe within Asian equities. And lastly, we believe ASEAN will be one of the biggest beneficiaries from the shift away from China. And according to US trade data, since 2018's trade war, the greatest export beneficiaries have been ASEAN countries. As you can see from the chart by the left, exports to the US from Cambodia, Vietnam, Laos, Thailand, and even Indonesia have all seen a sizable jump. And this trend is also not limited to just the US. In fact, both Europe as well as China have also been importing more from ASEAN as well. And overall, we see this as a long-term tailwind for the region as the shift of supply chain away from China and to ASEAN economies is arguably only still at its early stages. So to summarize, here are the 4 reasons why we like ASEAN equities, and we see a steep global recession as a key risk, especially if Asia's export demand is severely hampered. But looking ahead, we do expect an upside potential of around 20% by the end of fiscal year 2024, making ASEAN one of the more attractive equity region upside-wise alongside Japan. All right, so with that, I've come to the end of my presentation, and I will leave you guys with this summary slide on the 3 markets and the recommended products to go along with it. But before I conclude, I would just like to say that yes, the investment environment have definitely changed. No longer we are in the low rates and a low inflation environment. And if policy rates and inflation remains higher for longer, perhaps 2022 was just the opening chapter and 2023 might not get easier. That said, not all chapters have a bad ending and not all chapters have a bad narrative. Equity markets may face more challenges walking into a recession, but as per every recession, there will be a recovery. And with that, I've come to the end of my presentation. Thank you, and have a great year ahead. Thank you very much, Colin. Thank you.
All right, ladies and gentlemen, you have got a lot of insights so far, all the way from the beginning since 10 a.m., and we really want to thank each and every single one of you for taking time to come down today. So, as you can see, right, we are about to set up for a panel discussion, and just a show of hands, everybody, how many of you are benefiting from the talk so far today? Anybody? Yes, 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 yes. Thank you so much, everybody. I love it. I love your enthusiasm, and I definitely love how you are really engaged here today, taking down notes, taking down the photos, and talking about all the talk so far. There is a recurring theme that you've seen so far, right? About how we're shifting away from certain countries, and then we're allocating or underweighting, and then we will be looking at where we can overweight our portfolios as well. So it's all about your portfolio allocation. Make sure that you invest smartly. Now, having said all that, the panel discussion here is going to be very, very interesting indeed. So for the panel discussion itself, it's going to be what's changed in 2022? Simple, but very poignant question indeed. Ladies and gentlemen, right here today, we have a total of 3 panelists and 1 moderator. We would like to introduce our moderator once again. We have General Manager, FSM1.com Singapore, and we have none other, Jean-Paul Wong. And follow up, we have Investment Director from iFAST Singapore, Kenny Jan, Dr. Wealth, Alvin Chow, and the Smart Investor, Chin Hui Leong. Ladies and gentlemen, please put your hands together to welcome these 4 gentlemen. Thank you very much. Have a good time, everybody. Thank you.
Thank you, ladies and gentlemen. Welcome to the panel discussion before we have the break. So the topic title is What's Changed in 2022? So I'm happy to have Chin, Alvin, and Kenny to share their views. I'll share a few slides as the background to the discussion. So first of all, we've been talking a lot about interest rates. So, and I think it's quite an important topic because this is one of the things we believe is here to stay in terms of the implication for all investors, for all our portfolios as well. So as we know, very quick recap, in just 9 months, the US Federal Reserve raised rates by 425 basis points. So that's like the steepest we've seen in 1 year since 1988. And the US is not the only central bank basically that is doing that. It's across the board, mostly around the world. And what it also means then is when interest rates go up so fast in a short time, right? It's tough for businesses, it's tough for us if we have mortgage loans when the rates go up. And there are signs that, a recession is coming. So people are not really debating whether it is. It's more of like when is it coming and how severe and how long the recession will be, right? So because of this topic, I just wanted to bring it to my panelists. Happy to have all of them. So I'll start with Alvin in the middle. So Alvin, do you agree that the rates will actually go sharply down? Because some market participants seem to be alluding to that. Do you agree with that view? And what's your view and how should we invest in 2023 as a result?
So for me, I don't think the Fed is likely to cut rates in this year. But I do think that they may stop raising rates by the first quarter, because they are about 4.5% right now, and the Fed projection of the peak interest rate in 2023 is about 5.1%. So from 4.5% to 5.1% is not a lot of distance for them to maneuver. And I think probably 2 more rate hikes in the first quarter, and they are pretty much done for the year. That's my view. And I think that with 5.1%, if it really stay there, even for the rest of the year, I think it's already a good sign for the markets, because now investors have more stability. They feel that, oh, now I understand, okay, this is the rate that we're going to work with and do our projections of future growth of the valuation of the stocks. Because right now, as interest is going up, it's very difficult for investors to pinpoint what is the true value of these growth stocks.
Any favorite idea off the top of your mind in terms of what we can do then?
I would generally think that the tech stocks should have a reprieve if the interest rate stabilize. So I think in general, the US tech stocks would be an area to look at. Okay,
thanks, Alvin. So I'll move on to Kenny. Kenny, this current environment that we're looking at, right? Does it remind you, for example, of the period in the 1970s, especially the late 1970s, when the US Fed chairman back then, Paul Volcker, he had to increase rates all the way to 20% in the US, right? So nothing as scary that we're projecting like this now, obviously, but do you think that is one episode, or is there something in the past that reminds you of the current environment?
Yeah. actually, the period of very low growth or recessionary period and also a high inflationary environment, those were not very occurring very frequently in the past. So as you pointed out, in the late 70s, in the early 80s, we have seen a recessionary period in the US and also interest rate shooting to a double-digit level. But then having said that, I think if you were to look at the closer period, we are actually seeing inflation at a more subdued level, anywhere ranging from 3 to 5%. That is what we consider high. But currently, our inflation is at like 7-8%. So I think we will be in an environment whereby there is not a lot of history that you can actually refer to. But having said that, I think if you were to look at the past episode of such environment, typically bonds will do better than equity as an asset class. In fact, in all the scenario that I mentioned earlier, in all the periods that I mentioned earlier, more than 2/3 of the period, we are actually seeing bond as an asset class doing much better than equities. So I think from an asset allocation perspective, I think this is something that perhaps investors can bear in mind.
Yep. Thanks, Kenny. So Chin, coming to you, you're known to be a value investor at heart. I hope I'm not wrong when I say that, but you can correct me. But do you think that this higher inflation, higher rates for a longer period of time, right, is actually good for value investors?
Okay, so I think that the idea of value itself, I'm a bit more, I think it's interpreted differently by different people. So for example, my co-founder David Kuo, he's a dividend investor. To him, value is the income which he receives from the stock, right? And that's what he focuses on. So long as that dividend continues to be paid, there's a business behind it which can support that dividends and keep it at that level, that's what he's interested in. So in this current environment where share prices might be falling, he's actually getting more excited because if you're relatively sure that dividends will be maintained, so example, maybe Singapore Exchange would be one company, then you would focus where if the share price goes lower, you get a better yield, which is a good thing, right? For myself, I'm actually more of a growth investor, where I see more on the free cash flow being generated by the business itself. So I think that a good example would be iFAST, where they have been growing free cash flow per share. They have a new contract coming up next year for the Hong Kong EMPF. So I'm interested to learn how much they can actually generate in terms of free cash flow.
Yeah, thanks for the clarifications. Yeah, on value versus growth. So that topic comes up quite a bit, I think, for investors. So I'll move on to this next topic. So you may have seen this earlier on from one of our analysts. So essentially, this slide is trying to say that the yield spread between equities and bonds has narrowed. So when that happens, right, then it's narrowed to about 3% or thereabouts, and it's like the lowest on record since 2009. So a very long time. And in fact, it's about almost 2 standard deviations, I believe, below the 10-year average. So this kind of chart basically tells us investors that if we are poorly compensated in a way for taking on equity risk, which is a bit of the backdrop for our views on why we think we should have an overweight in bonds compared to equities for this year. I'll just start with Chin right away here. Do you think then that's a very tough environment for equities this year? Because you were talking about some of the ideas, you mentioned growth. Maybe you can expand a bit more on that, give us a couple of high conviction ideas. Yep.
Sure. So I think that especially for growth stocks, right? I'll just share 3 numbers from last year. In January 2020, 40% of Nasdaq stocks were down 50% or more. So that's significant. As JP mentioned, interest rates have been rising at an extreme rate, right? The last time interest rates increased to 2%, it took 36 months. The same increase of 2% happened in less than 6 months last year. So that's how extreme that this growth has been. And finally, there were less than 120 days where there were positive gains in the stock market. So in a way, I think that stocks have taken a beating, but that should not distract you from what investing is about, right? you want to focus on the business itself. And I truly believe that, as I shared in my presentation just now, that if the business can grow its free cash flow per share over time and have it grow by multiples over time, that will be the key driver of growth and not just the multiple itself. In the short term, things may be volatile. Economic indicators are a bit like staring at the sun. You want to get a sense of it, but you don't want to stare at it because you're not going to be a lot smarter staring at it and may turn you blind to everything else.
Yeah, thanks, Chin. Maybe I'll just talk a bit about some of the equity and stock market outlook. So I'll ask Alvin for his views here, because I do know that you recently wrote something. You said two is a crowd when it comes to the US and China fighting for basically the leadership position, whether it's strategically, militarily, and so on. So how do you expect this to play out, and how are you personally managing your portfolio to take this long-term tension into account? So, for example, are you just very pro-US, negative China? Yeah, tell us more.
Okay, so that's a very good question, right? And we know that this geopolitical tension is not going to go away anytime soon, and I don't think it's going to go away in the next 10, 20 years. So it's going to be the new normal that we're going to operate in. And now they're entering a phase where previously was globalization, right? Where a lot of manufacturing were outsourced in China. That's one aspect of the globalization. But now we are talking about decoupling. Okay, so which means that US will want to find their allies to do their own things. China want to do their own things, right? So with that in mind, it does change the way that I invest. It means that I'm not siding any side. I do think that both US and China have good investments to look at. And the only thing that changes the way that I approach it is that if I want to buy a US company, I make sure that the US company has no exposure to China. And if I want to buy a Chinese company, I want it not to have exposure to the US. So in a sense that I want to decouple the portfolio earlier than the world decoupling itself. So that is, to give some example, I would probably be more risk averse when it comes to a company like Tesla, where you have about a quarter of its revenue generating from China. So what if that tension goes worse and China just says, okay, you can shut down your factory, right? So it will have a very big impact. One quarter of revenue is gone. And in fact, it's not just from China, but that vehicles are exported to within the region. So in this case, geopolitical issues can really translate to individual companies' impact. So that is one example of how I would actually decouple the portfolio first.
That's a interesting way of looking at it. In a way, it also supports the thesis that deglobalization could intensify and probably will, right?
I don't think it's the deglobalization. There will still be some part of deglobalization. I don't think we can go back to the world where every country just do their own things, right? Just that the supply chain will be rewired among the two different factions. So they will have their allies, and then they have their allies. So there's still some degree of globalization, just that it's decoupled into two halves.
Two different camps, yeah, with all their allies and friends. Okay, maybe I'll bring in Kenny to talk a bit about IFAS research views, because you probably heard about our views earlier today from Wei Ren, for example, our head of research on China, where we're basically a bit more defensive. And when we're defensive of China, right, it affects a lot of things, because China is so big in terms of weightage in Asia ex-Japan equities and also in Asian bonds, Asian high-yield bonds as well. So in terms of asset allocation then, what does that mean, Kenny? What should we do?
Yeah, I think from a broader asset class perspective, if you look at last year, both fixed income, both bonds and equities market fell sharply. Actually, this is very, very unique if you were to look at the past history. Even during the global financial crisis, equity market were down like 30%, but the bond is only down less than 5%. So last year, we have both double-digit drop in both asset class. So what does that, offers opportunity to investors? I think from investors' perspective, let's say if you look at the broad asset allocation between fixed income and bond, for those people who are very light on bonds, I think it actually presents a good opportunity. I think one of the charts you can see the bond yield relative to equities, which I think JP has shared with you, definitely would imply that bond can be actually considered a very attractive investment this year, especially for safety of capital. I think a lot of people here also want to preserve capital. So, but preserving capital and getting 5-6% yield, I think it's possible this year by investing in a fixed income portfolio. So from that perspective, I think for those who are very light, you can actually reallocate some of your money into fixed income, especially on the safety investment grade fixed income. And from the equity space, I think it's very difficult to time the market, as I think two of our panelists mentioned. I think we need to be disciplined. With regards to, I think in the past, a lot of people were questioning whether a 60-40 portfolio, like 60 equity, 40 would work, because you can't actually get anything out of the 40. But now you can actually get 5 to 6% from the 40% allocation to the bond. So from an equity perspective, I think you can then, gradually look at companies that actually provides you with a strong cash flow. And I think that actually span across quite a number of regions. I think from the US, if the market correct further, I think that they actually offer quite interesting opportunity for you to look at some of those markets here. I know IFAS have a very negative view on China. I think Wei Ren has shared with you. But again, I think investing is not like a love-hate relationship sometimes. So from a tactical perspective, if you see progress, especially if you look at it, whether at a COVID policy or whether it's from the property market resolution, which the China government is trying very hard to do it, I think there are opportunities that you can actually look at.
Yeah, thanks, Kenny, for this. I'll move on to this part of our discussion. As you can see from this slide on the left, right, so the STI has outperformed the proxy for the FTSE ST REIT. So I bring it up as one example of many of our investors looking for income ideas over the last 10, 15 years. It's been a popular theme. We all want to have a good yield, right, in our portfolio. Like Chin alluded to, we want a good dividend yield as well, right? So, but now that we're entering a new phase in terms of the outlook, where we don't need to take so much risk, but we still get 4%, for example, from government bonds. Then what does that mean for the outlook for Singapore REITs? So I'll just bring that question to both Chin and Alvin. We'll start with Alvin. So if we assume higher rates for longer, and a forward distribution yield of, let's say, about 6% for Singapore REITs, right? Do you agree that actually this distribution yield has to be higher to be attractive and worth the risk for Singaporean investors to take?
One way to look at it is that I find it useful. SGX publish the REITs chart book every month, and they have this 10-year average yield spread between the 10-year bond and the REITs S-REIT yields. So the last time I seen the yield spread is about 3.9%. So which means that the REITs should give additional 3.9% above the 10-year bond of Singapore government securities. So currently the Singapore 10-year bond is about 3%, so you add another 3.9%, so it's about 6.9% that you should demand in general for REITs. But of course, we also know that there are higher quality REITs, lower quality REITs, so you have to tailor there a little bit. So which means that you can't probably get 6.9% for high quality REIT, but low quality REIT definitely I think can surpass that. But it is like a benchmark for you to work on, and every month you can just see, because this yield spread will change, the Singapore 10-year bond yield will also change. So it's good to recalibrate every month, and that will give you a bit of sense whether it's worthwhile to go into REITs.
Thanks, Alvin. And for Chin, what's your view on this? And maybe also, do you have a favorite REIT sector, for example, in mind?
So I'm just going to talk about bonds versus REITs or stocks, if you will. So I think that what you choose as an investment is a vehicle to get you to where you want to be, right? The same way that you won't take a plane to fly to Johor Bahru, or you won't take a bicycle to ride to China, because that would be too slow, right? So I think that maybe among the crowd today, there are people who have done really well. And if you have a massive amount of money and your concern is more about maintaining what you have and just making sure that it's keeping pace with inflation, then I do think that bonds is a good vehicle to maintain what you have, right? Especially when yields are pretty good. But if you are looking for something more, then you have to invest in stocks, which will be riskier. But if you have a long-term mindset in mind, I think that you can actually make really good gains. I'll give you an example. The last time we had a major crash, not the one in 2020, the one in 2028, November 2028, you could buy shares of Starbucks for $4, right? $4 US. And Starbucks today is paying $2 in dividends. So you could buy it at $4, and today you'll be receiving $2 in dividends, which means your yield to cost, if you bought it when things are bad, and hello, we are in a downturn today, you could actually be earning yield to cost of 50% on the yield. Now, even if you have done a bad job or you time your entry incorrectly and you bought it at $8, with $2 per share, it's still a 25% yield on cost, which is not too bad. I haven't seen anyone crying over a 25% yield on cost situation yet. So I think that you don't have to be perfect, so long as you keep looking at whether or not that company can generate the amount of free cash flow, and if they can grow it and keep on sharing that dividends to you, then I think that that will give you good returns over time.
Yeah, thanks for that, the sharing and the example. Yeah, I think people should be happy if they caught it at the bottom in 08, right? Yeah. So we'll wrap up with one last question for our audience, and I'll throw that question to all three panelists. So what has really changed, I guess, from 2022, and how should we really, what's the key takeaway for all our investors as we position ourselves for 2023 and beyond? So perhaps I'll start with Kenny.
Sure. I think one of the key changes is that, inflation, interest rate is likely to stay higher than a lot of people would like it here. For example, in the past, we are so used to a very low interest rate environment, low inflationary environment. But if you look at the what has happened since 2008, this is not going to be the case. And even if interest rate were to peak sometime this year, we are unlikely to see it going down to the level that we were used to since the GFC period. So I think one piece of advice in terms of how you should look at in this year, for example, 2023, I think you just have to be very disciplined. So you know what you want to, in terms of, as what Chin mentioned earlier, you must know your risk appetite. And if you're comfortable with a yield of, let's say, 5-6%, then you don't have to take a lot of risk. But then if you want to also position it on a longer term basis, then perhaps a 60-40 kind of allocation may not be a bad choice for investors. And you can actually start, investing towards that target this year.
Yeah, thanks, Kenny. Alvin?
I will just leave with one message for you guys is that usually recession, when it's officially announced, is a market bottoming indicator. If you take a look at the statistics, right, whenever there's an official announcement in the US, if you look at S&P 500 returns, 1 year, 2 year, 3 year, 5 year, up to 10 years, you have 90% chance that you will get a positive return. So it is very likely that actually bad news is the good news. If they officially announce recession, it's actually your last chance to buy at cheap prices.
Okay, and Chin?
I love that answer. So I think we're coming into a period where in 2020 and 2021, there was so much love for stocks, right? Stocks were bidded up. And then coming into 2022, early on, that love turned to hate. But the thing about it is, the opposite of love is not hate. It's indifference. Right? And as the market downturn actually stretches on, I think some of the people are starting to be indifferent about the stock market. You're no longer looking at the business and so on. And I think that's dangerous, right? You need to be focused. And you don't have to do anything special because all you have to do is to keep a calm mind. And that's my main focus. If you can keep a calm mind and do the average thing when everyone is losing their mind, that is how you come out ahead. That's a quote from Napoleon, by the way. And that's my key takeaway from 2023.
Thanks a lot, Chin, Alvin, and Kenny. We'll still be around to talk further with you at our booths in the Connect Zone. So do catch up with us if you would like to with more questions. So thank you so much for your time, and I wish you all a very happy, healthy, and a hot year, hopefully for your investments. Thank you.
Thank you very much, gentlemen. You may take your leave as well. Here you go. So with that, very insightful things that have been shared, and really one of the key takeaways, not about love or hate, love and indifference. So make sure that you're always positioning yourself well and constantly re-evaluating. Ladies and gentlemen, we're going to be taking a short break right now, and then we'll be going for our lucky draw coming on back at about 12:50 to 1 o'clock. Make sure you come on down and get ready for your lucky draw. And on top of that, please feel free to enjoy your time here with the different booths. You've got the wonderful Connect Zone to make sure that you really network, because as they always say, your network is going to be your net worth. Make sure you take the opportunity to really connect with people. This is a time to really grow. Now, on top of that, we got the Vote and Spin and Win. Make sure you go on there to find out the different offers that we have for all of you. And once again, just to highlight for the FSM, they have the new card. So if you want to take on the card and get yourself the bonus that they have for you today, it is something that you can definitely check it out right here at the Invest Expo 2023. With that said, see you back here for our lucky draw in just a few minutes, about 12:50 to 1 o'clock. See you here, everybody. will be starting the lucky draw at 12:50. Once again, we'll be starting at 12:50. So do come on back, and if you have not placed your lucky draw stubs, please make sure you do so right here. There is a translucent box for you. Make sure you place in your lucky draw stubs. And you have to be here in order to win the prizes that we're going to give away. So make sure that you're around the area. We will be starting at 12:50. Thank you. And hello everybody! Once again, thank you so much for joining us at FSM Invest Expo. And as much as you've given your time today, we also want to give back to all of you with our lucky draws and the many prizes. Now I hope you have enjoyed all the coffee, the ice cream, and many of such things. And of course, joining on stage, thank you Wei Ren for joining us back, and of course for the insightful talk previously. And right now, he's going to also give you beyond insight, but gifts. Actual $100 FSM 1 cash credits. So having said all that, let me just highlight a few things before we continue on. Now, attendees who open an account with FSM Invest Expo can receive $20 FSM 1 cash account credits. And of course, those who have opening with their SingPass, you can also be just a few clicks away, and it's so simple to open. Beyond that, there's also a refer a friend, where you can also refer a friend to open an account at FSM Invest Expo right here. Then you can receive $20 of the credits as well. So both the referrer and the account opener will receive the $20 credit. And with that said, you can once again, with SingPass, you will be able to actually put in a lot more information very quickly, very swiftly. So right here today with the lucky drawer. As you can see, people are still putting their lucky draw tickets because they want to win the $100 credits together right here at the Expo. So with that said, let's go on with our very first round of the Expo itself. So, oh, there's some more people coming? Come on up, come on up. Okay, so one, two, and we're in our very first draw. It's gonna go to dun 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 dun, and lucky number 1674. Wing Fei, mobile number ending with, wow, what a nice number, 8800. What? Here we go. And once again, lucky number 1674. Are you here? 1674. Going once. Going twice. Going, and redraw. Here we go. Make sure you're here, everybody, so that you can have the lucky draws for you. Now, for those at the back, we do encourage you to pay attention because right here is the moment for the lucky draw. Let's go on with next draw of lucky numbers 2, 5, 5, 6. Are you here? 2, 5, 5, 6. 2556, and the person's name is Heng Ka. Mobile number ending with 6690. 6690, mobile number, and going once, twice, and not here. Wow, okay. Wow, if they don't want it, I want it. Meet you too. Okay, here we go, Aaron. And next lucky draw number 2781. 2781. Very quickly, going once, going twice, and redraw. Okay, with that said, well, you're very busy, Wei Ren, today. Okay, now, next number, 0431. 0431. Yay! Congratulations! All right. And we got Jonathan Yap on stage over here. Do bring up your lucky draw stub so that we can confirm your lucky draw stub right over there. And 0431, congratulations! Here you go. And you have a photo taking as well right in front. Here you go. Take off your mask, please. Thank you. Well done. Here you go. Ready? Take a photo. And we're good. Congratulations. Now head on over to your right-hand side as we're going to take out your details to give you the credits. All right, everyone, we got one down. We got 9 more to go. So let's see who will be our lucky winner next. And lucky numbers, it is going to be 1137. 1137. We have Gary Tan. Mobile number ending with 7657. Going once, twice, and redraw. Wow, very fast, okay? No chance to wait. Here we go. And we got our next lucky winner, which is going to go to the numbers 1622. 1622. Are you here? Going once, we have Ho Ping. Ho Ping, 你在吗? 1, 2, 3. All right, redraw. And next one, we have lucky numbers. Wow, I love this. One of our first few early birds. Lucky number 0049. 0049. We have Yong Chi Min. Yong Chi Min. Lucky number 005. Congratulations. All right. 0049. Just to double check. And congratulations, sir. Just take a photo. Thank you very much. You can face towards the front over there. Well done. Congratulations. Head on over to your right-hand side. Thank you. All right, so we're on 2 down. We got 8 more to go. Here we go. And lucky numbers 1758. 1758. Phyllis Low. Phyllis Low or Phyllis Go. Are you here? Yes? Yes? Okay, come on up. Here we go. 1758. Congratulations. Well done. Here you go. Just to confirm the numbers, 1758. And you have your lucky draw slips over here. We have 1758. Just to double check. Congratulations. Well done. Here you go. Congratulations! With that said, here we go with our next lucky draw winner. We got 3 down and then we got 7 more to go. Next one, 1897. 1897. Chong Wen Sing. Chong Wen Sing. And we have 1897. Wen Sing, 你在吗? Wen Sing once, twice, and redraw. Wow. Next number, 110. Oh, Wen Sing. Yay! All right, very good, very good. So we have our lucky winner, 1897. Just double check. Here we go. We got 1897. Congratulations. Go over to the center. Thank you. Now, with that said, you will be winning the $100 FSM1 cash account credits, and we have our next draw, and it's going to be the one that you picked up previously, which is 1112. 1112, and is Tan Hong Bun. Are you here? 1112, going once, twice, and oh, yes. I love it. Oh, you like to play, huh? Like last minute, going once, going, hey, it's me actually. Yo. Let's have a good time here today as we are learning about investing and also giving you the prizes. Can I see your tickets? Yes, very good. Congratulations. So once again, if you hear your number, just immediately come on up, because coming up at about 1 p.m., which is just a few minutes time, we want to be able to go on with our next series of talks as well. So right here, we got 5 more to go. We got 2896, Lu Ming Ho. 2896, once. Yeah, let's go. Congratulations. Well done. And just to double check, yes, 2896, here you go. Well done. You can take off your mask to take a photo as well. Congratulations. Thank you. Here we go. Congratulations. Head on over to your right-hand side. Thank you very much. We got 1, 2, 3, 4, 5, 6, 4 more to go. Wow, we're getting close, huh? And right here, the last $400 to give away. 2066. 20. Hey, congratulations, Mike Tan. Well done. Thank you so much for coming on up. All right. Yes, I love the enthusiasm as you're running up, man. Well done. Just to double check as well, your numbers. Very good. Congratulations, Mike. Well done. You may want to take off your mask as well. All right. Good stuff. With that said, congratulations. And we're going to come on back with our next draw right over here. 3 more to go. 3 more to go. And wow, this one. too enthusiastic until he ripped up the number as well. It is 0226. 0226. Yeah, well done. Congratulations. David, yeah? 0226, just to double check. And we have that. Congratulations. Wow. You guys are getting really, really enthusiastic with this. I love it. Right over to the right-hand side. Thank you very much. I love all of them are coming up faster and faster. They really want the prize. With the FSM, of course, the $100 credits. Now we're going to go to 1123 Fu Kok Jong. Yes? 1123. Yeah. All right. I love it. A lot of the winners coming from the left side. The left side got chi. The draw is not rigged. Yes, it is not. 1123. Congratulations. Well done, everybody. Here you go, Mr. Fu. Thank you for coming on up. Take your time. Don't worry. Just be careful. All right. So 1123. Yes. Well done. Congratulations. Stand over to the center, sir. You can take off your mask as well. And you can take a photo. Here you go. Stand over to your right just a little bit. Thank you. Well done. One more, sir. One more. Here we go. Here we go. Stay at the camera. Well done. Stay over to your right-hand side. Thank you very much. Just a few more to go. Here we go. 1, 2, and 3, 4, 5, 6, 7, 8, 9. 1785. 1785. Wendy Pua. Are you here? 1785. 1785. Going once. Two. Hey, congratulations. Here you go. 1785. Well done. And here we go. Wendy. Yes, 1785. Come on up, come on up. Yes. Yes, congratulations. Here you go. With that said, thank you, Weiren, for giving out all the prizes. All 10 to begin out. Let's give that a big round of applause for winners. All right, so right here, ladies and gentlemen, we got another series of talks that's coming on right up. So with that said, at 1 p.m., which is coming up right now, we do invite you before we start to actually pack it in towards the center a little bit because we know there are a lot of empty spaces, but there are a lot of people standing around as well. So for those at the sides, can you do us a favor to move towards the center if you see empty seats in between? Once again, do pack us into the center as we're about to move on to our very next series of talks as well. So coming up at 1 p.m. right here, right now, the title is going to be The Time is Different. Really? Really? So, right here today we have our Chief Executive Officer of Provident Limited. Ladies and gentlemen, please put your hands together and let's welcome Christopher Tan. Thank you. Enjoy.
Mic test. Okay, very good afternoon to each one of you. I hope you all can hear me. First of all, thank you so much for being here. I think it's been a long while, a couple of years since we ever have a physical event like this. So it's great to see so many people coming for this talk. Now, I really only have got 20 minutes, so I want to get on with it. But just before I start my talk, I just want to say that because I only have 20 minutes, there are a lot of things that I don't have time to say, and I can only offer something that is at a very high level, conceptual. So please do not take this as advice because all of us, our circumstances are different. Some of us, we are accumulators. Some of us, we are retiring. And so, you cannot take a 20 minutes talk like that and just apply it to your situation. Yeah, but I hope in these 20 minutes, it gives you some idea on how you can approach your investing. In money management, it is really a balance between investing and cash flow management. I'll say that again. In money management, it is really a balance between investing and cash flow management. If we don't have cash flow, it is very difficult to invest for the long term. But if we don't invest today, we don't have cash flow in the future. Right? So it's really a balance. And as I was preparing for this, there were so many things for me that I wanted to say, but I've only got 20 minutes, so I'm just going to restrict to a lot more on the investing side. Now, it's interesting that the title or the theme for this entire expo is this year it's different. So when I saw this, I tried to be a bit naughty and I say, this time is different. Really? Is this time different? So what I did was I went back to history. I hope you can see some of the events that has occurred. Of course, I can't put down all the events, but some of the events that has occurred in history. I just want to show it to all of us. Okay, I can't see it very well, so I'm just going to go to the side here. Okay, so if you see 1974, I was only 4 years old in 1974, right? There were a few key events that happened in 1974. Firstly, the collapse of the Bretton Woods system. In simple terms, this was the time whereby the US delinked themselves from the gold standard. It's no longer pegged to gold. And then there was the devaluation of the US dollar. And if you remember, for some of us who are more senior, the oil crisis. Right? There was an oil embargo led by Saudi Arabia against those countries whom were supportive of Israel. And as a result of that, oil prices went up. And we all know what happens when oil prices goes up. When oil prices goes up, things become more expensive. Inflation happens, market crash. And that led to the crash of 1974. Right, and of course, I realize there's a TV here, so I can stand here. And then, of course, in 1980, because of all the policies that were put in place by the US decades ago, like, for example, the pro-employment production, as well as the maximizing of the purchasing power policies in the 60s put together by the US. Meaning to say, after the Great Depression, the US started putting policies to support maximum employment, to support spending. And you know what happens when central banks start to support spending? Inflation starts to rise. And again, because of the collapse of the Bretton Woods, the oil crisis, that led to inflation peaking in 1980. Right? And you see inflation was 13.5. We are not even there today. But that was what happened in 1980. And that, of course, led to the market crash as well. Then, of course, in 1990, many of us will remember, because Iraq wanted to acquire the reserves, the oil reserves in Kuwait, and also because they wanted to cancel the debt that they owe, or the money that they owe to Kuwait, they invaded Kuwait. And that started the US-Iraq War #1. Okay, and for a short while, the market crashed. Okay, and of course, a few months later, when US invaded Kuwait, very quickly, just after a few hours, the investors realized who is going to win the war, and the market recovered again. Then 2003 was the second Iraq war. That's now the President George Bush Jr. who led this war. Now, so let's take a look at what happened in 2003. Now, because even though the US won the first war, they let Saddam Hussein continue to reign in Iraq. But they wanted to undermine, or US wanted to undermine Saddam Hussein's power, and so they waged a second war. And of course, the US claimed that, Saddam has got weapons of mass destruction. Many years later, they discovered they actually don't have. And of course, there were a lot of theory why US went in, and I'm not here to talk about that. But that was what happened in 2003. And again, that led to the Iraq war. And when people heard of US wanting to go into Iraq to wage a war, the market fell. But the minute the war started, they remembered the first war. They knew who is going to win, and then the market recovered again. And then, of course, nearer to us today, many of us will never forget the 2008 global financial, the GFC, the global financial crisis. Falling US prices, a lot of subprime borrowers who were not supposed to borrow money, the bank lend them anyway. And then when the market, or when the houses price, the houses fell, the price of the house fell, right? They were in trouble. They couldn't top up the difference of the loan. They couldn't repay the loan. Many of them defaulted. And there were a lot of structures built around all these subprime mortgages. And as a result, it caused the 2008 GFC. And I'm sure many of us remembered. Well, the GFC, the start of the GFC really was in September of 2008. Of course, all the subprime borrowing, all that happened like in 2007. But in September 2008, the market started crashing, and you remember Lehman Brothers collapse, Bear Stearns, and all that. The markets continued to fall until March of 2009, 6 months later, right? And then in April of 2009, the market recovered and continued to recover until December 2021, right? And then of course last year the market fell again. And so we have 2002, which is really last year. If you have been investors last year, realize that last year is a bad year. I mean, if you invest in the markets, you would have lost money everywhere, except if you have invested in STI, maybe STI would have done well. STI was up 4% last year, and commodities did well. Other than that, everything else failed. So 2002, what was the problem? Excess liquidity because of the pandemic. Again, the central bank in US printed money. Okay, and because of excess liquidity, a lot of money in the system, well, the stock, it caused inflation. Yeah. So inflation happened because of that, but inflation also happened because of supply chain disruption due to COVID-19. Primarily China, the supply chain was disrupted. So supply came down. There were a lot of demand because of excess liquidity, inflation. And then plus, it got worsened because of the Russia-Ukraine war. I never knew that Ukraine was the largest exporter to Europe in terms of corn, sunflower seeds, and all that. And they're the second biggest exporter of oil and the biggest exporter of natural gas. So when there was a war in Ukraine, again, lack of supply. Inflation happened. So last year, markets fell generally. If you invested in the US market, the S&P fell close to about 20%. NASDAQ was even worse. Right, so these were all the events that happened in history. So is this time different? Is 2022 different? Well, I'll say this. The events that led to the market collapsing can be different. They have to be different because the world is a very uncertain place. But the motivation behind these events happening are always the same. Countries quarreling with each other, a war happening, central bank printing money, excess liquidity that led to inflation. They are almost always the same. But the one thing that is always the same is that after a collapse, the market always recovers. And this history goes back to not just 100 years. In fact, if you read Jeremy Siegel's book, Stocks for the Long Run, this history goes back all the way to more than 100 years, that it always goes up. So I'm just going to show you this chart. Right? If you have read some of the articles that I've written, you have seen this chart many times. So if you look at this, this is the MSCI World Index. The MSCI World Index consists of 23 countries of the developed market. Singapore is in it, by the way. Yeah? And if you look at the MSCI World Index from 1970 to 2020, the stock market has gone through different events, geopolitical events, natural disasters, wars, inflation, market collapse, a pandemic, 2022. But the market always goes up. 5 minutes? It's 10 minutes here. I cannot finish in 5 minutes. There is no way I can finish in 5 minutes because I'm following the clock here. I'll do my best. Okay, so now, a disciplined investor looks beyond the concern of today to the long-term growth of potential markets. So, well, if you are disciplined investors, you look beyond the short-term volatilities and you take heart that the market will recover. Now, I can't do it in 5 minutes because there is an article that I want to show all of you. Not many of us have read this article before, and I'm going to show you an example. It's important because in the midst of volatility like this, people, you will always hear stories from managers, fund managers, media. And this is what the media said in 1979. This is a legendary article from the Business Week. It's part of Bloomberg, by the way, now. Okay, so in the Business Week, I hope you can read it. Okay, it says the death of equities. They predicted that the stock market is going to die. Okay, and this is the synopsis. The masses long ago switched from stocks to investments having higher yield and more protection for inflation. Now, the pension funds, the market last hope, have won permission. Okay, I'm just going to summarize it and say this. The pension fund, the government gave permission for the pension fund in the US to invest out of stocks into other things, such as diamonds. Okay, that was what it was said here in 1979. And it says that Wall Street Now they're not interested in stocks anymore. They are more interested in options, futures, and buying into insurance. So let's look at some of the excerpts very quickly, okay? So if you look at this, you just look at what I've highlighted, okay? Basically, it's saying here that you can take a picture and read it slowly. But it says here in the article that yes, they have given permission for pension fund to go into gold and diamond. I mean, gold I can understand, but diamonds as an investment, in 1979, that was what they said it's going to happen. And then in the article, they said that only the old people were interested in the stock market. The young people are not interested because passé, stocks no longer in favor. So if you look at what I've highlighted, okay, it says here, we are running the risk of immobilizing a substantial portion of the world's wealth in someone's stamp collection. Basically, it's saying, not interested anymore. You can keep it. If stocks, it's like a stamp collection. It's old thing. Okay, now, some more excerpts. Okay, it says here, just look at the one that I highlighted. You can take a picture and read the rest later. Today, the situation has reversed, with bond yielding up to 11% and stock averaging a return of less than 3%. So what Business Week is saying is that bonds is better, stocks is lousy. That's very short term, because if you look at the long term, the equities have always beaten bonds. Now, what else? Further, this death of equity can no longer be seen as something of a stock market rally. It says here that no. Don't always think that, when the stock market crash, it will come back. No more. Okay, that's what Business Week say. No more, right? Now, the last part, only the elderly, the old people, who have not understood the changes in the nation's financial market or who are unable to adjust to them are sticking with stocks. That was like before last year. Stocks, lousy, better buy crypto. And then the older people say, I don't understand crypto. I better stick to what I understand. That was exactly what happened in 1979. You're saying the old fogies, they don't understand. So they are still investing in the old thing like stocks. Only the elderly remains. Some more, okay, the range of investment opportunity is so much wider now in the 1950s. Why stick to stocks? This was 1979. You are probably hearing the same thing today. There are a lot more options. Why just stick to something so boring? Last part, okay? Wall Street has learned that there are more profitable things besides stocks to sell. Among them, options, futures, and real estate. This is scary because, well, the Wall Streets are just selling what is profitable for them. And it stays there, well, it may be reversible someday, stocks, but not anytime soon. Okay, then they interviewed this guy, okay, a professor from this South Methodist University Business School. We have entered a new financial age. The old rules no longer apply. Okay, people no longer think of stock as an inflation hedge, and based on experience, that's a reasonable conclusion for them to have reached. 1979, Business Week. We are all thinking shorter term than our father and grandfather did. We are all thinking shorter term. The second bullet point. Have you been to an American stockholder meeting? They're all old fogies. The stock market is just not where the action is right now. But take a look at what happened after this article was written. The article was written August 13, 1979. But the market went up thereafter. Most of the time, the media is wrong. So, in the midst of volatility, as you hear many of these things, I know the time is up, I'm just going to follow this clock. 5 minutes. Okay? Most of the time, you will hear of all these things. But be careful what you hear. Look for evidence. That is more important. So why do stock market goes up in the long run? Why? Because earnings. The primary factor that drives the long-term returns of stock market is earnings. What drives earnings or profitability? Demand. What drives demand? Human needs and wants. As long as we human needs have want, last year can be a bad year. If your phone is spoiled, you buy a phone. If you want to drink a coffee, you buy a coffee. As long as humans are still around and the world needs to trade each other to fulfill human needs and wants, well, the stock market will go up in the long run. It's as simple as that. But in the short run, many things can happen. Like now, everybody is quarreling with China. But this is not the first time the world is quarreling with China. They will quarrel all the time, right? And there will be wars all the time. In the short term, we just don't know exactly what will happen and when it will happen. And even if you know when it will happen, there is no way you will be able to guess how the market will react next. They said that if Donald Trump wins the election many years ago, the stock market will crash. If Hillary wins, the stock market will go up. Well, Trump won. Even if you got it, that Trump won and you got a market, the market reacted differently because the stock market went up. It's very, very difficult to guess. So you either choose to invest for the long term, or you must be able to guess exactly what is going to happen for the short term. And like many professional managers, and I say this with a bit of fear and trembling because I'm in the midst of many professional managers, they try to guess the market in the short term. I'm going to show you, this is from the Financial Times, 11 October 2020. It says here, most active managers cannot beat the market. 2020, November, active managers struggle to prove their worth in a turbulent year. January 2022, most of these active managers, stock pickers, they failed. And then I saw this, September last year, and I said, wow, the active managers come back, finally. But take a look at it, you're not going to be able to read this, so I'm going to show you this, okay? So I expanded it, and that was what the article said in Financial Times. It has so far been a slightly less terrible year. They come back because it was less terrible for them. Not that they have done well, okay? A mere 51% of the large cap funds have underperformed the S&P 500. And they come back because previous year was worse. 85% failed. So today, 51%, so better. You get what I'm trying to say? It's very difficult to try to guess the market. So you're going to hear many, many market outlooks for the rest of the year. What's going to happen to inflation, interest rate, will the war go on and all that. Now, you are not going to be able to decide whether the future forecast is going to be right. So what do you do when you are unsure? Let me just give this advice. When you are in the dark, look at what has already been revealed in the light. Ken? When we are in the dark, look at what that has already been revealed in the light. What has been revealed in the light? These are the evidence. This is from 1970. You can see in the long run, the stock market always gives you that positive return. But I have to say this. I don't have time to say this, but I have to say this. Positive doesn't mean enough. Sometimes, even if it gives you positive, because of the period you invest in, you might not get enough returns. I don't have time to expand this. Yeah? But I just have to insert this in. But I hope you draw courage and encouragement. I mean, you can ignore all this noise and all these predictions. Anyway, most of the time, the predictions are wrong. If you invest in the long term, you are going to get enough return. Today, if I'm the weatherman and I tell you that it may rain today, what do? Well, I'll say go to work, but bring an umbrella. You are not going to listen to the weather forecast, man, and just because it says it's going to rain, you're going to stay at home and you're going to call in and tell the boss, I'm not going in. Why? Because the weatherman says it's going to rain today. Your boss will tell you, don't come in tomorrow. The weatherman may be wrong, but we listen to weather forecasts because we just want to prepare ourselves. We still go to work if we need to go to work, right? But we bring a good umbrella. What is a good umbrella? And this is my last slide. Okay, what is a good umbrella? This is the personal wealth equation that I've developed some time back. Very simple. All of us earn an income. After we take away our savings, our fixed expenses, we are left to spend on things that are not necessary, variable expenses. Our savings, if we invest it, compounded by the returns over a number of years, it will help us reach our future goal. The left side is the short-term financial planning. The right side is the investment. If you are invested for the long term, stay invested and keep investing for the long term. But the only way you can do that is that you have to keep your left side very strong. What do I mean? This may not be the best time to change your job. Maintain your emergency fund. Optimize it. You can put it in FDs, SSB, T-Bills if you want. This is a good time to rebudget. Is there a possibility to lower your expenses? Be prepared for higher expenses in mortgage repayments. Consider repaying some of your loans if possible. Review your insurance portfolios. A lot of Singaporeans spend a lot of money buying unnecessary and unsuitable insurance policies. At the end of the day, premiums very high but not adequately covered. So review your insurance portfolio, be adequately and comprehensively covered, get rid of unnecessary insurance to lower your costs, reduce premium payment if possible. And if we do that, that is the left side. That is the good umbrella. Okay? Now, I just want to end with this, and I'll disappear because you're not very happy already. You will hear a lot of predictions. You will hear. History and evidence have shown most of the time it is wrong. But does that mean that these predictions are of no use? They are useful. It's just that we use it wrongly. The predictions are not meant for us to change our investment strategy. It's not meant for that. Predictions are always short-term. Investment strategy is long-term. We shouldn't use short-term information to help us make long-term decisions. That's wrong. We use short-term information to help us make short-term decisions. What are the short-term decisions? Our daily financial planning. If I know that the next 12 months, 24 months is going to be tough, I make sure that I tighten my belt. I make sure that I save. I live a simple life. I must make sure I can go through the next 12 months to 24 months. Because if I can survive the next 12, 24 months, I'm not worried about my long-term investments. Am I okay with that? With that, thank you very much. I hope you have a good day today. Thank you.
All right, ladies and gentlemen, truly insightful, and the article will really give you context. Since 1979, fast forward 40 years, 30-ish years, that right here we're in a very similar situation. So really, let's have a good think about that, right? Now, ladies and gentlemen, for the next series of talks, we would like to welcome our Managing Director, Jonathan Liang.
Hi, it's Mike. Hi. Hello, Singapore. Very happy to be here to share with you JP Morgan's outlook on the bond markets. So, this is the first time I've done a FSM1 event. And I have to say, I'm very impressed with the setup. I also quite like the theme of the conference, which is nostalgia. Now, you know who I'm nostalgic about? I'm nostalgic about my hometown hero, Bruce Lee. And the reason is, Bruce Lee, to me, he's a true innovator of the martial arts. And he explained his philosophy in a very famous quote. He said, "Be water, my friend." And what he meant by that was that he felt that the traditional practice of martial arts was a little bit stiff and not nimble enough, because if you were to train in the traditional martial arts, oftentimes they'll emphasize the firmness of your stance, right? So you might be taught to do this horse stance, right, where it's immovable and then you punch from there. But Bruce Lee, he emphasized the fluidity of movement. So instead of the horse stance, more likely, you will likely see him do this more likely. Now, Bruce Lee's martial art was both fluid and firm, dynamic and adaptive, but most importantly, effective. And I bring this up because we at JP Morgan have certainly had to be like water to navigate the very tough markets last year, to outperform the markets. Because you see, last year was the worst year on record for fixed income, for bonds. So what you're looking at here is the calendar year returns of stocks and bonds. The green is equities, stocks. Blue is bonds. Now, most of the time when the green goes down, bonds are supposed to provide that defensive characteristics and stay up. But you can see for the first time in the last few decades, both those lines are down a lot. And so that has made managing a bond portfolio very, very tricky. The risky parts of your portfolio was down. The safe part of your portfolio was also down. So we've really had to be very fluid in how we manage our strategy. So what we're looking at here is our positioning over time in our flagship income strategy. And you can see it really is like water. The black line that you see here is our strategy's interest rate sensitivity. Now, interest rate sensitivity, for those who don't know about bonds, works in reverse with price. When interest rates go up, bond prices go down. And that black line is the interest rate sensitivity of our strategy. The higher that line is, the more sensitivity we have. And I would like to draw your, there's a lot of information here, but I'd like to draw your attention to our recent history on the right-hand side of this chart. And you can see right after COVID, when the Federal Reserve had restarted its money printing machine and did a lot of QE, it pushed US Treasuries to all-time lows, the yields. And so beginning around the second half of 2020, we began shorting US Treasuries. Those are what the blue bars are. And then came 2021. Not only was the Fed printing money, but now they're giving the money to the US government, who in turn was now writing checks to Americans. And we thought that was highly inflationary and would likely end badly, even though the Fed back then was telling us that inflation is likely transitory. Remember that? So instead, we deepened our shorts. So coming into this year, we had like one of our largest US Treasury short position in our strategy, in the history of the strategy. And that had been the key driver of how we outperformed the bond markets in 2022. Now, how did we get it right in that we were shorting Treasuries during that particular time? We've come up with this framework to help us understand when do stock-bond correlations break down and when do they go the right way. We call it the 3 phases framework. And clearly, we have just gone through phase 1, the yellow box. That was 2022. Phase 1 is characterized by when the Federal Reserve has just done a lot of QE and is pivoting to QT, quantitative tightening. From printing money, they're sucking money out of the system now. And that causes bonds, stocks, credit, everything goes down at the same time. And that's why the only thing that works is to be short the market. And that's what we did. But the good news for everybody here is that we think phase 2 is what's coming next this year. That's the green box. The green box is characterized by when the Federal Reserve is still tightening, still raising interest rates, and still sucking money out of the system. But the tightening now is finally causing the economy to slow down and to even enter a recession. And so that in that environment, when the economy enters a recession, Treasury yields tend to come back down. And so right now, we have once again reduced, we have got rid of the shorts, and now we have positive interest rate sensitivity in our strategy. Now, in this environment, stocks and weaker parts of the credit markets could remain volatile. Volatility could remain high, but we do think that interest rate sensitivity, once again, can help you dampen down your portfolio volatility. So that was the past, recent past. What's next? Going forward, we expect that the US recession will likely enter a recession by the middle of this year. So at JP Morgan, every quarter, all of our fixed income investment professionals have a full day meeting, all 300 of us, and we debate everything that is going on in the fixed income markets. One of the summary outputs is this chart you see here. So what this is that every quarter, we would assign a probability to each of those 4 scenarios: above trend growth, sub-trend growth, recession, and a crisis. And this is the output from the last 4 quarters. And you can see the recession part is now our base case scenario. And this is a 6-month forecast. And so we think that by the middle of this year, the US it will be quite apparent that the US has finally entered a recession. And in addition, we do think that inflation has likely peaked. So when we look at a series of indicators, we are clearly seeing previously very high numbers starting to roll over. So here's a few examples. On the left-hand side, that's the price of core goods in America, clearly rolling over. Top right-hand chart, that's shipping costs out of China to Europe and US, again, clearly rolling over. And the bottom right-hand chart is used car prices in America, again, clearly rolling over. And therefore, because inflation is rolling over and we think that the US will enter a recession, we think the Fed may continue to hike a few more times this year, but will likely so-called pivot or turn back to rate cuts in the second half of this year. The chart on the left-hand side, on the top left-hand corner, that is our outlook for Fed policy. The blue line is where the Fed has been. That's all the 50 basis points, 75 basis points hikes you saw this year. The yellow line is what market is forecasting, and the dotted line is what JP Morgan is forecasting. So we think that they will probably take the short-term Federal Reserve rate to about 5%, keep it there for a little bit, and then once they realize, oops, inflation has already rolled over, US is entering a recession, unemployment is rising, they'll then begin cutting towards the tail end of this year. In the interest of time, I'm going to skip some of these slides. So what are we doing in the portfolio? Right now, US housing is quite expensive. It's quite unaffordable for many Americans. So what's happening is that more and more Americans, they don't have a choice, they have to rent instead of purchase a home. Because mortgage rates are at 20-year highs in America, housing prices have breached previous 2006 peaks. So rental demand for apartments is very strong in America. And there's a type of bond that is backed by property developers that develop properties that are just for rent. And so these guys are minting it right now because rents are going up, their costs are fixed. And so the value of their properties are going up quite a bit. And so the credit risk of these securities are quite solid. And so we have some of these securities in here. We also have some corporate bonds in here. And right now, we are targeting to produce a yield of around 8%, keeping the strategy investment grade, which we think is actually not a bad deal. Now, finally, all of you know that the fixed income market's performance was horrible. Yields rose a lot. But because yields have now risen back to an attractive level, the forward return for the bond market is now actually looking quite attractive. The risk-return profile of many different fixed income sectors are now looking quite attractive. So what we're doing here, remember I said, when interest rates go up, price goes down. When interest rates go down, price goes up. So what we did was we did an exercise looking at different fixed income sectors. The blue line is a simulation of what happens to returns if yields go down by 1%. Now, if the reverse is the gray bar, what happens to returns if yields go up by 1%? So you can see the blue lines are clearly longer than the gray lines. And in addition, in some sectors, it's actually still positive, even when yields go up by 1% in that particular sector. Take, for example, US high yield, which is the fifth row from the bottom. If yields go up by 1%, you make almost 14% 1 year later. But if yields go down by 1%, you make 14%. If yields go up by 1%, you only make 5.5%. So the risk return for certain fixed income sectors have gotten very interesting, and we think 2023 is going to be a very interesting year and rewarding year for bond investors. So in summary, there are still risks out there. There are still some uncertainties out there. And so active management, staying fluid, is still going to be very important. So I'll leave you with the same advice I gave at the beginning of my speech, and that is be water, my friends. Thank you very much.
So, with that said, we've heard very insightful things once again about how we can really be able to be prepared for 2023. Now, with that said, we have a whole series of lineups of talks once again. We're going to go forward with our very next talk itself. Ladies and gentlemen, the next one is going to be titled Invest in Asia Sustainable Bond Opportunities with a Total Return Strategy. Now, with that said, we want to invite our portfolio manager, fixed income eSpring Investments, Go Rong Ren. Have fun.
Hi everyone, my name is Rong Ren. I'm a fixed income portfolio manager with eSpring Investments. And for those of you who are unaware, eSpring Investments is actually a fully owned subsidiary of Prudential. And we actually manage assets in excess of 200 billion, which makes us one of the largest regional fixed income fund managers in Asia. So without further ado, I'm going to spend the next 15 to 20 minutes today actually sharing you, introducing to you ESG, as well as the underlying strategy, the Asia Fixed Income Fund, which actually applies ESG considerations in its investment framework. So as a quick start, maybe I'll just give you a short introduction as to what ESG is really about. I think we hear a lot about it. And I think the fact of the matter is it's very broad in nature. But what has been increasingly in focus over the last couple of years is related to the environmental part of ESG. It relates strongly to climate change. You know, the likes of Greta Thunberg actually making prognostications about the death of the Earth because of human activity. And of course, water scarcity issues, floodings, adverse weather patterns. These are environmental issues that are tackled in ESG. And then, of course, something that we probably, if you are a seasoned investor, you will be well aware of, it relates to governance. It talks about how, you know, company management actually manages a company, how transparent they are to their investors, and how well they actually treat their employees. You know, all these things actually translate into actual company performance. So, you know, ESG is very broad. I could spend an entire day telling you about what ESG is really about, but I'm just covering, you know, what essentially is in focus or what is relevant when we actually apply ESG evaluation in our fixed income investment process. So at the end of the day, when we actually try to apply ESG considerations in fixed income, that means when we buy the bonds of a company, we actually want to evaluate the risk. Because, you know, when you buy a bond at par, after maturity, you expect to get your money back together with clipping the coupons. And you know, the last thing you want is for a bond to default. That is when a company gets into trouble in the middle of you holding its debt and for reasons which were not identified earlier on. So what I'm trying to actually share with you here is that ESG risk is actually a real risk that may not necessarily be covered in the conventional financial analysis that is being done across the industry right now. So for example, you know, on the environmental front, we have seen the floods in Pakistan, as well as the droughts, as well as, you know, some sort of flooding in select cities because of adverse weather changes. These are risk factors that we need to actually take into consideration in terms of where a company actually has its businesses actually running. On top of that, you know, in terms of governance, I think over the years, you have seen how, you know, corporate governance issues related to the lack of transparency, such as Sino-Forest, or even more recently, FTX, how money is being shifted around without proper controls. This actually results in major financial losses for the investors. So all these ESG risk factors that you actually see here on the chart, as well as what I've just described to you, it translates into consequences for companies. We need to find a way to have a structure in place to actually evaluate these risk factors, which are not in the conventional evaluation framework, so that we can actually assess its risk and whether the company is actually ready to tackle this risk before we actually buy their assets, be it their securities or their equities. And this is what ESG assessment is all about. So as we all know, 2022 has been an extremely challenging year. The financial markets have been beset with a lot of setbacks. First of all, you have your Fed hiking rates by close to 4% and then some, another 1 to 1.5% this year. You had the Russia-Ukraine crisis, which caused the energy prices to actually spike up. And we also had a lot of uncertainty on this uneven COVID-19 recovery. We just had China, just reopening and suffering its first major bout of surge in cases, which has shut down, major cities. So it's been a challenging year. And as you can see on the chart on the right, no asset class is actually spared from the challenging year that was 2022. Equities, bonds, all sold off in tandem. And this is why, we advocate a flexible approach, a flexible way to invest. And that is what the total return strategy, that is the Asia Sustainable Bond, is about. That is, we actually take all these challenges as well as opportunities into consideration when we actually invest in the fixed income space in order to actually deliver the kind of return that we want to in our investment objectives, which is between 4 to 6% each year. And how we do it is, number one, as I mentioned, I think we are very risk focused. We evaluate the ESG risk factors which are not conventionally captured in your financial evaluation framework, number one. And number two, we actually try to limit excess volatility in such a portfolio by actually enforcing some parameters, right, that prevent this from happening. Like, for example, rates have been going up a lot, but this portfolio was not particularly hurt by it because we kept the tenors of the bonds that we actually bought, right, much shorter than what the average market is. The average tenor of the bonds in the market was around 7 to 8 years, but we just bought bonds that were in the 3 to 4 year bucket. So even as rates rise, right, our bonds, right, actually drew down, right, by a much lower amount. And then we do not just invest in, the just names, right, in all the benchmark universe. We actually explore opportunities. We look at both high yield, IG. We take into consideration the prevailing investment environment in determining whether we want to actually go more defensive, invest in the safer credits, or to actually go into something that probably can give us more potential upside. So for example, in 2022, we decided that it was going to be a challenging year, so the portfolio became a lot more IG focused, and as a result of that, we avoided a lot of the defaults, right, which a lot of other funds, fixed income funds, actually suffered. And last but not the least, we actually have not just investments in hard currency dollar bonds, we actually invest in local currency bonds as well. Some of these actually give a significantly higher pickup than your dollar bonds. For example, the IG bond in the dollar space gives you perhaps something 4 to 5%, but something that in the Indonesia space actually gives something in the region of 7%. So these are the opportunities that we actually seek out in this particular fund, right, in order to deliver the strong returns over the market. So as an example, in 2022, these are some of the things that we did. You can see between the red as well as the black line. The black line is the average duration, which is the tenor of bonds which an average fixed income fund probably will be buying, right, in this space in the course of 2022. For the red space, that's our Asia Sustainable Bond strategy. We actually significantly reduced the duration of our fund over this period. And this actually helped mitigate a lot of losses, right, in our fixed income fund. And at the same time, we did not compromise on the returns even as we actually reduced the tenor of the bonds that we actually bought. You can see from on the right side, the yield to maturity of our portfolio actually kept pace with the broader investment environment as rates rose. So you still can continue to capture, the yield opportunities available in the fixed income markets, even as, we reduce the risk appropriately, right, taking into consideration the market environment. And I think on this particular slide, what I'm trying to show you is, even as we invest in investment grade bonds, there is a white space. You have your very, very high quality space, your AAA or AA's. You're talking about the likes of Singapore government bonds. I think, we actually do a risk assessment of all these different bonds, and we see where the best opportunities lie. For example, in the BBB space, because the spreads have widened a lot this year, we decided to plow into it, and it has given us a good mix of good combination of good returns as well as a relative safety, because these are still investment grade, predominantly investment grade securities. Now, when I talk to you about ESG consideration, it's not something random that we do on every individual security that we actually buy. We actually adhere to a very strict framework, something that is easy to understand even to retail investors like yourself. So it's kind of similar to, I'm sure I see a lot of parents here in the audience, how the PSLE scores, right, have been moderated from absolute score, be it 270, 280, to different bands instead. I think bands are a better way of actually understanding risk as well as preparedness. So the way we like to think about ESG risk is, if it's high, it means that there are material risks, right, that we need to take consideration. If it's low, it means that we probably are not so particularly concerned about the ESG risk profile of this particular company. Then when we look at the preparedness, we assess whether the company has controls, has frameworks, or has resources in place to actually address this risk. And this is how we come up with this matrix over here. Every single issuer in our investment universe is actually assessed. And those in the green space, which you actually see here in this matrix, right, are the ones with the good ESG scores. These are the ones, right, where the ESG profile shows that the company, right, is ready to deal with the risk that can potentially materially affect its performance. And of course, the ones in the pink and red space, right, is the ones that you want to avoid, because it just shows that the company doesn't have proper processes or frameworks or resources in place, right, to actually address it. Like, for example, a company, operating in a region where there's frequent flooding, but they don't have mitigating measures in place for that. I think this is probably a company that you do not want to buy, because all it takes is one flood to actually wipe out its operations and potentially, right, lead the company, right, to actually go bankrupt or to run into serious financial difficulty. So at the end of the day, the proof is in the pudding. When I actually represent to you this matrix, what I can show here is that if you actually look on the left-hand side of this matrix, you can see that, in terms of the ESG profile of our investment holdings in this particular fund, is greatly skewed towards the green part. And that what this means is we consciously try to avoid the ones with poor ESG risk and preparedness scores. And I think this is very important because it ensures the integrity of your portfolio over the medium to long term. Ultimately, when you invest in a fixed income fund, right, I think this is something that you want to be very concerned about. You want to be able to sleep at night. You leave the worrying to us. We will evaluate all these ESG risk factors, right, that can actually affect the long-term performance of your bond portfolio. That's what the sustainable bond strategy is really about. And if you are not familiar with our framework, I will actually refer you to the scores provided by legitimate as well as authoritative external ESG score providers like MSCI. As you can see here, in the dotted box, that is the ESG rating score of the portfolio which I manage, which is an A. And it's actually 2 to 3 notches above the BBB, which is the investment universe that we are in. So, after having said so much, I think what I really want to deliver to you is why do you want to invest in an ESG-focused strategy? Number one, I think, as I mentioned to you before, we use a total return strategy, which gives us a very flexible approach towards investing. We can invest in different types of the fixed income space, right, to actually generate the desired return while trying to minimize the downside risk. We capture all the opportunities without being subject to the constraints imposed by, for example, benchmarks. Number two, I think with ESG investments, you really gives us an opportunity to actually identify investment opportunities way ahead of the market. Like, for example, 3 years ago, we started investing in renewables. That was before, this whole transition story actually came about. So with that in mind, I think that, a forward-looking strategy such as a sustainable bond fund, right, is really something that's essential, right, into your investment portfolio. And lastly, I think a lot of people get this misconception. When you invest in ESG, it means that, you are impact investors, you are just trying to do good. That is not the case at all. We invest in the same investment universe, right, as the conventional bond funds. So you are not expected to actually compromise on any performance. In fact, what we have done, right, is with the ESG evaluation, we give you the additional enhanced return, right, from actually the angle of finding more opportunities and minimizing risk. And this is what it's all about. It's about actually enhancing performance when we actually do ESG evaluation. So the next few slides actually gives you a sense of, how the sustainable bond strategy has done versus, the same investable universe that we're invested in over the past 1.5 years. This is the red line, and it's very clear that, over the last 1.5 years to 2 years, right, the sustainable bond fund, although it has suffered drawdowns in tandem with the fixed income market, it was significantly less than that of the equivalent Asian markets. And if we actually, and we are not, of course, we are not the only ESG-focused fund strategy based in Asia. There are several of them as well. But what I can share with you is we are one of the first to actually launch an ESG-focused strategy, and we are one of the best performing ones as well. As you can see from the red line over here, compared to the rest of our peers, the further left you go, it means the worse you are. And we are actually much further on the right. So it just shows that, you know, we are much better performing, right, than the rest. Ultimately, as investors, I think return performance, right, is one of the most important considerations. And the same applies. It's not just as a comparison against, you know, our ESG fund peers. If you compare it against other fixed income funds, right, we do much, much better as well. And no small part of it is because of our ESG lens. Okay, this is just an example of environmental pivots that we actually take. For example, you can see we have a strong, what you call home bias here. Singapore actually makes up a large part of our investment opportunity set. And one of the reasons is because, you know, Singapore, as one of the most forward-looking economies, right, has invested a lot, both in terms of regulation as well as in terms of investments, right, into ESG-related initiatives. So it makes perfect sense for us to be parking our money here because I think, you know, in terms of realizing the returns from ESG investments, right, Singapore is actually one of the most well-placed investment opportunity sets right now amongst all the ASEAN as well as Asian economies. Okay, and then lastly, I think something that I need to emphasize to all of you here is there's no compromise in performance, which is why we are able to consistently deliver a 5% historical dividend payout to our investors in this fund. And I just want to remind you that 5% dividend payout doesn't mean that the returns is 5%. We have a running yield that is way in excess of 5%. At the moment, what we have here is something in the region of 7 to 8%. We distribute 5% to you, we keep the remaining, right, to actually grow the fund and deliver even better performance to you guys. So my message to you is that, you know, we target a return that is higher than actually the dividend payout of 5%, which I would argue is actually quite generous if it's over a medium-term horizon. Lastly, just a final introduction to Eastspring Investments. We are not new to the game. We are a fully owned subsidiary of Prudential, which makes us a very strong asset manager. You can trust your money with us. And most importantly, we are also award-winning. We have the fixed income strategies that we run are some of the biggest and strongest in the region. So if you have any further interest in, you know, our other suite of funds, or if you have any other questions related to ESG or to the sustainable bond strategy, which I actually run, you can actually run to us over at our booth somewhere in the middle of this exhibition hall. My colleagues and myself, we are most happy to actually tell you more about the Eastspring Asia Sustainable Bond Fund. Okay, thanks a lot.
Welcome back, everybody. Thank you so much for joining. And now talking about the ESG, you can definitely go over to the booth Eastspring and find out more about how you can really invest in this new trendy topic that is ongoing and how to catch the first wave. Having said that, we still got more lineups for you to have more insights about 2023. And I hope you're enjoying it so far. A lot of information. And thank you for staying engaged. And with that said, we will also be having our lucky draw later on as well. Make sure you stay tuned for that. Now, having said that, we will now be going for a panel discussion, which is going to be talking about what you need to know before investing in SSB and T-Bills. As you know, in the market right now, in the news, we're constantly talking about it. So what is this Singapore Savings Bonds? What is this T-Bills? Good or not? Let's find out today. With the people sharing with us, our panelists will be from IFAS Singapore Senior Manager, Cash Management and Treasury, Joshua Chim, CFA. And we also have Senior Research Analyst, Global Fixed Income, IFAS Singapore, which is Lim Teng Chong, followed by Senior Research Analyst, Research and Portfolio Management, Yo Hui Shi. And last but not least, our moderator for the day will be a Research Analyst, Global Fixed Income, IFAS Singapore. And we would like to welcome Wong T. Ming. Ladies and gentlemen, please put your hands together to welcome our panelists.
Good afternoon to everyone. Hope everyone has been enjoying the talks, the prizes, and the game so far. I think by now you've probably heard quite a fair bit about the use in have changed over 2022, especially in Singapore, over the past few presentations. In summary, we have seen inflation overheating and it's been extending into 2023. But at the same time, we also seen interest rates spiking up to really record high levels that we didn't really expect at the start of the year. So for us, let us do something different. We are going to look at alternatives that you can actually consider before jumping into the Singapore government bonds. What you need to know before investing in SGS, SSB, and T-Bills. So for today, Teng Chong will be representing the good side of SGS and SSB, Singapore Government Securities and Singapore Savings Bonds. Joshua will be representing on the attractiveness of our cash management and also auto-sweep accounts. And last but not least, the most important one, Hui Shi on the prospects of fixed income funds. The first question will be an easy one. Just a quick refresher for everyone who has just been listening over the past few presentations. How has the use exactly changed in 2022? And how do you think it will go from here?
Thanks, Daming. Maybe I can take this question first. So since last year, we saw global interest rates rising as many economies around the world grapple with high inflation rates. So when central banks raise their interest rates, this will also lead to bond yields rising as well. So last year, we saw global bond yields rising past 3%. And this is comparing it to 2021, which was at 1%. In Singapore as well, we also saw bond yields rising up to past 4.5% compared to 2021, where it was around 2.5%. So evidently, we can see that bond yields have surged quite significantly as interest rates rise. And right now, definitely we are in an environment of higher interest rates, and even government securities such as SSBs and T-Bills are already yielding at decade high levels. So the last auction, we saw T-Bills coming in at 4.2% for just only 6 months. So definitely as we tread through this higher environment of higher interest rates as well as higher bond yields, bond yields are making a comeback and are definitely looking rather attractive and interesting again.
Perhaps I can add on some of Teng Chong's points. So as we all know, clearly interest rates and yields have risen across the board, but short-term yields have actually picked up a lot higher as compared to long-term yields, which is also why you see the 6-month T-bills giving you a yield of 4%, which is higher than the SSB 10-year average of around 3%. And another thing that we notice is that the market seems to be pricing in Fed rate cuts in the second half of 2023. But we think that this is unlikely to be the case even if a recession comes. And so with this, we also expect long-term yields to move up even higher as we think that markets are underestimating the persistence of inflation. And overall, we think that interest rates should remain higher for longer, and the Fed has also expressed its intentions of doing so. And I think for interest rates in 2023, we think that it will stay at around 5%. And for the 10-year US government bond yield, I think we can expect yields to pick up as well and move closer towards the 5% level.
Right. So on one hand, right, given with the information, we are expecting the yields to stay at least around the current level or go up a little bit. But on the other hand, given how we expect there will be a global recession incoming for this year and the likelihood of a recession, do you think that the popularity of these alternatives will continue in this year?
Yeah, so definitely. So for bonds, traditionally and historically, bonds have performed well during times of recession. This is because bonds can still provide stable and reliable cash flows to its investors, despite a slowdown in economic activity as well as a recession. So definitely for bonds, we will continue to see higher demand as investors flock towards safe haven assets in order to mitigate the downside risk of inflation, and while also getting stable income from the coupon payments from bonds. For safer bonds such as the government securities, which have lesser risk, definitely for short terms, for the shorter tenor, such as T-bills or even 1 to 2 year SGSs, with higher yields right now, definitely we will see continued demand as investors take advantage of the higher of the inverted yield curve and take advantage of the higher short-term interest rates that we are receiving right now. So definitely for bonds, we continue to see higher demand, especially even during a recession.
For me, I'm from the cash management team, so it's a natural thoughts that to keep at least 10 to 20% of your positions into cash account or FSM account or auto sweep account in FSM. Just giving a simple analogy, so having cash on hand is actually having bullets with you when you enter into the jungle and aiming for your price assets. You don't want to have a scenario when you have the best weapon with you, like your research articles or your watch list or fancy charts. But if you do not have your bullets with you, how can you hunt down your price assets? Especially what Diming said, that we are actually expecting mild recessions or recessions this coming year. Yeah. So another thing about that is comparing to T-Bills, okay, definitely T-Bills are giving you quite attractive yield at 4.2% as compared to the auto sweep yield currently at 2.7%. You're actually giving out almost 1.5% yield, but if that's for per annum basis, so if you divide by 2 because of 6 months bills, so you're actually giving out 75 basis points, 0.75. But what you are missing out that there's a golden opportunities for you to go down and hunt for good opportunities when markets pull back. And you can easily make a 10-20% gains. Okay, naturally you may think, oh, okay, I don't put in T-bills, I just put the money inside the bank. So when I see a good opportunities, then I go and transfer money to FSM. But this is actually equivalent to you having a weapon. You want to hunt down your price assets, but you say, oh, hey, my bullet is actually in my car boot. Let me go back to my car boot, go and recharge, reload, come back. But then your price asset has might saw 10, 20, 30%, and it becomes more dangerous for you to chase the opportunities. That's why I always advocate to have at least 10 or 20%, depending on your risk appetite, to put in the cash account at any point of time.
Yeah, for me, I think that against this kind of uncertain macro backdrop, fixed income as a whole should continue to gain interest from investors as they take on a more defensive portfolio positioning. And for bond funds, I think this is something that is still a viable option because bond funds, they are usually diversified across different markets and sectors, which helps to mitigate some of the risks. And active management is also involved, so fund managers, especially during periods of market volatility, they do have the discretion to actually take on less risk and to protect their portfolios from the market drawdowns. And on our FSM1 platform, we also do have a large number of funds available across the different risk spectrum. And I think that in particular, funds of lower risk, such as your money market or your investment grade bond funds, they should appeal more to investors in this kind of challenging environment.
Right, so very good points provided by our panelists. We have Ting Chong talking about like having our government bonds being a lot more stable. Then we also have Joshua speaking about how liquidity is very important during this period. Also not forgetting how diversification through the funds are also very important for lower risk amidst this period. So next up, the next question might be a little bit more specific. I think there's a larger focus on investment grade issues now. Do you guys think that high yield issues will still have a place in 2023?
I think as we head into a global economic slowdown and also potentially a recession, definitely we do not advise investors to take on much credit risk. This is because, number one, I think yields have also risen quite substantially. So for investment grade yields, they are now yielding about 4 to 5%. And the spreads between, comparing the yields between high yield bonds as well as investment grade bonds, we have seen that the spreads between them have not risen to levels as seen as compared to past recessions in 2000, 2008, or even during the COVID recession. So we think that there's still room for spreads, high yield spreads to actually increase. So therefore, we don't advise investors to actually take on much credit risk and actually invest into investment grade bonds or even bonds of shorter tenors in order to mitigate interest rate risk, as they are less sensitive to changes in interest rates. So so during a recession, we prefer investment grade over high yield credits.
Yeah, so for the reasons that Ting Chong mentioned, I think from a portfolio perspective, investors should be underweighting high yield bonds in their portfolios and allocate some of this allocation towards investment grade bonds. And I think in particular, we do advise our investors to gradually reduce their positions in Asian high yield. So if you did did listen to one of our presentations earlier in the morning, we don't think that China's property market will see a recovery in the near term, despite the recent policy easing, because we think that China's property market is currently undergoing a confidence crisis. Home buyers, they are not even convinced that developers are able to deliver their homes on time. So home buyers, they're actually quite afraid to enter the housing market, and we don't think that housing prices will start to recover from here. And I think that confidence, which is now lost, is very hard to regain. And I think that recovery, a meaningful recovery, would definitely take some time, and we are still quite far away from that.
I think in a general summary for what Ting Chong and Hui Shi said, it's very important for us to really consider the risk of the current moment, and you have to really see whether if the risk to reward is worth it, especially currently seeing how we are expecting a recession. Things might change drastically in the next few months or even 1 year, so we don't exactly know. So investors really do have to take note of their risk and to see whether things are worth it. On the other hand, right, Joshua, I have next question for you, I think because you're our specialist in our cash management and auto sweep. Are there any particular currencies you might favor and recommend investors in looking at?
Disclaimer first, I'm not an FX expert, so I do not have any short-term favorable views on any FX pair. But of course, like everyone here, I really wish that SGD strengthen so that we have more purchasing power when we go to JB for shopping, or when we're buying other foreign currencies investment products, it'll be cheaper or less cheaper in SGD terms. But I think more importantly, you need to ask yourself, what is your investment objective? Are you someone that likes to invest in the US market? If yes, definitely you need to have some balances in your USD cash account. Or do you like Hong Kong market, China market? That's where you should put some Hong Kong dollars or CNH balances. Or you are someone that likes the STI counters, then definitely having SGD balance there is always beneficial. But if you're someone that likes me, that like to invest across all the universe, one good products that we have on FSM is actually the SGD Auto Sweep. So this product actually allows you to invest immediately using the balance inside, as well as give you attractive yield, 2.7 now, the indicative yield, as well as allow you to invest directly into all the foreign currency products. So we actually handle the FX procedures for you when your trades get filled. So you don't need to be think so much or hustle regarding the FX stuff.
Thank you, Joshua. I think ultimately we all really do hope the SGD continue to strengthen. Then we go Malaysia, can buy a little bit more things with our purchasing power. But then, coming to the last question of the day for this panel, the most important question of all, we are diving a little bit deeper into what you are representing today. After all the things that you mentioned, can you all give us one pro and one con about the product class you are representing over the conventional products, for example, like fixed deposits?
Okay, I go first. So it really depends, like what they always say, low risk, low return, high risk, high return. So putting your money into the cash account or auto sweep, it yields decently, but it's actually putting you at the lower risk spectrums. So the good thing is you don't have so much volatility as compared to your bonds funds, but at the same time, you are not so restricted if you're put inside the T-bills. So there's some of the flexibilities that I think is very beneficial to having the balances in your cash account or auto sweep, so that you can use it anytime to hunt for your golden opportunities.
Yeah, so for me, for bonds, I think one of the pros comparing to traditional assets such as a fixed deposit, I think number one is the ability to sell bonds in the secondary market. So definitely investors can take advantage of the rise in bond prices. If the price of a bond rises, then definitely investors can still sell their bonds in the secondary market and before their maturity date. And also looking at the downside, this is also one of the cons because as interest rates rise, it will actually negatively affect bond prices. So in order to mitigate this interest rate risk and the volatility of bond prices during this time, we definitely do recommend investors to consider shorter tenor bonds, as these bonds are less sensitive to changes in interest rates, and this will help to mitigate some of the changes in interest rates.
For me, for bond funds, I think a con would be that bond funds are slightly riskier because the average credit quality of most of the bond funds out there, they're actually much higher as compared to relatively risk-free assets such as T-bills. So there's a risk of capital loss, especially during periods of market uncertainties because of the mark-to-market impact. But I think a pro here would be that higher risk, they can potentially imply higher potential returns. If you look at, for example, the investment grade short duration bond funds that some of our fund houses here offer, they can give you portfolio yields of around close to 5%. So that's actually quite a decent yield pickup over your risk-free T-bills as well.
Okay. Thank you so much to our panelists for what you mentioned. I think a very key point for this panel that you have listened to is ultimately for us to really consider our risk profile and to see whether if the risk to reward is really there for us to really take on the risk, especially current given this period where are we considering high yields, investment grades, even the risk-free rates. Each of it has their own benefits, but at the same time we do have to consider the risk downside, whether it will be worth it at the end of the day. Meanwhile, for Ting Chong also highlighted something very important. Ultimately, we see the government bonds as something really stable, it's always there, but we do have to consider the downside, which is the liquidity. Is the secondary market going to be easy for us to tap into the money itself? Also, ultimately, for cash management, the liquidity will be a very important point as we continue to see 2023 to be a pivoting year, whereby we might see some more opportunities in the equity market. And in terms of liquidity, we might need to tap on the cash just for that additional investments we might want to do. Once again, thank you all to the panelists, and thank you all for listening to our panel. Hope you all have gained something from what you need to consider before jumping into the Singapore government securities, Singapore savings bonds, and T-bills. I'm Timing, and thank you once again representing for all the panelists. That's all for today.
Thank you.
Thank you.
Thank you.
Thank you. Well, thank you very much, the team from IFAS Singapore. Once again, just a quick summary, really considering your risk appetite and what you want to invest in. And just a key takeaway, just make sure that you really calculate what you can invest is essentially what you're able to lose. So that is a good benchmark on how to really manage your risk. Now, with that said, we're talking about a world transition. We mentioned briefly, it's a pivoting year. So the next topic is very interesting. Investing in a world in transition. Today, we have Investment Director from Capital Group. Ladies and gentlemen, we're about to welcome our next speaker, and he's none other than Andy Budden. Enjoy.
Yeah, good afternoon, everyone. I think that investors have a pretty good reason for feeling really quite scared right now. Last year, we saw rising rates, rising inflation. We've got the prospect of a recession next year. And also, we've got some pretty scary geopolitics as well. I think investors have good reason to feel quite scared. In addition, we had negative returns from global equities and global bonds. The last time we saw that was 1969. The last time we saw that before then was 1934. So these are unusual times, but my main message today is that this is actually a good time to be investing in global equities, and I'm going to explain why. But first, let me quickly introduce the firm I work for, Capital Group. So Capital Group is a specialist asset management company. All we do is manage money for our clients, and we've been doing it since 1931. So we had our 90th birthday just a couple of years ago. We manage about $2 trillion of our clients' money. Most of that is in equities, and that actually makes us the largest active equity manager in the world. So those are the credentials that I'm representing today. But now let me explain why it is that I think this is a great time to be investing in equities. And so this is the roadmap that we're going to work through today. So firstly, I'm going to try and put what's happening in markets right now in context. So I'm going to give you a framework for how to think about these scary times. Next, I'm going to talk about opportunities. And in particular, I'm going to talk about very powerful long-term trends and how that can lead to individual companies to invest in. And finally, I'm going to talk about outcome-focused investing. And I'll give you a tease. The short version of that is focus on the long term. So let's start then by trying to put what's happening right now in a framework that makes it a bit easier to live with. So it is likely that we're going to be having a recession next year in the US and in quite a number of larger markets. In fact, in Europe right now, we're probably already in a recession. But the question is, what does that mean for equity markets? Well, this is a situation where I think history can be quite helpful. History doesn't always repeat itself, but it does provide quite a handy guidebook. And what we're looking at here is data from the last 70 years. And in the last 70 years, we've seen 11 economic cycles. So basically, we've seen 11 recessions. And I think there's a few important lessons here. So the first lesson, if you focus on that green line, which is basically the economy, the first lesson is that recessions don't actually last that long. The shortest recession was 2 months. The longest recession was 18 months, but on average, it's around about 10 months. So might be painful when it's happening, but actually they don't last forever. The second lesson is that markets tend to see recessions coming. So the blue line is equity markets, and basically markets forecast a recession around about 6 or 7 months before it happens. And in addition, they also forecast the recovery. So markets start to recover around about 6 months on average before the economy recovers. So what that means is you've got to be early. And the third lesson is that the typical sell-off in equity markets lasts for 11 months. And let me put that in context, that this sell-off so far actually has been going on for 12 months. So I think the takeaway from that is that yes, we might see some more weakness in equity markets, but we're much closer to the end than we are to the beginning. So this is a time to be thinking about investing in equity markets. And remember that going through a recession and going through a bear market is nothing new. I mean, equity markets are always volatile in the short term, but in the long term, they have always gone up as well. So what this chart is looking at is looking back over the last 35 years, and the shaded blue area is the equity market. And all those words are highlighting the different crises that we've experienced. And there's a lot of crises which drive short-term volatility. We've got 2 Gulf Wars. We've got 2 attempts by Russia to invade different parts of Ukraine. We've got 4 healthcare crises. So we've got SARS, we've got bird flu, we've got swine flu, and of course we've got COVID. And then there's a whole list of different financial crises as well. But what you can see is that while there's short-term volatility, in the past the market has always ultimately gone up. And so the message here is that the patient long-term investor does get rewarded if they can look through short-term volatility. So the message here, once again, seems to be saying, get invested and then stay invested. But the question is, invest in what? And so let me pivot now to talk about some of the opportunities that we're seeing in equity markets right now. And the one that I want to start with is secular trends, long-term trends. So if we look back over the last 50, 60 years, we've seen a number of very powerful long-term trends which have defined different eras of financial markets. In fact, they've defined the world that we're living in. And if you can identify these trends, it's possible to invest very, very successfully. So for example, back in the 1970s, it was the energy crisis. And if you were able to invest in energy commodities, that was pretty rewarding. If you jump forward to the 1990s, it was the revolution of mobile phones. It was when we first saw mobile phones. Tech, media, telecom for many years was extremely rewarding for investors. In the noughties, we saw the reawakening of China, the integration of emerging markets into the global economy. Great way to invest for a number of years. And in the last decade, it's been digital disruption. It's companies that are using the internet and technology to disrupt their industries, sometimes to actually create new industries. And so these are all good examples of secular trends. But the question is, what's going to happen next? So if we go to the next slide, I'm going to give you 3 possibilities that Capital Group is very, very focused on right now. So the first one, well, here I've called it industrial renaissance. Let me give it another name. Green energy transition. Next one would be regional supply chains. So we're seeing a lot of challenging geopolitics. The way that trade patterns work around the world is changing. That's an investment opportunity. And then finally, broad market leadership. So over the last decade, most investment game has come from a couple of companies in a couple of sectors. Moving forward, it's going to be much broader. So let me try and unwrap these a little bit more. And I'm going to start with the green energy transition. So the world is trying to commit to net zero carbon by 2050. Now, I'm not sure if we're going to make it. It might be more like 2060. But what is clear, that there are a lot of companies that are going to make a lot of money by driving this green energy transition. For example, electric vehicle manufacturers. I mean, we've seen some exciting returns from EV makers. What about the companies that make the batteries and all the components that go into electric vehicles? Renewable power. So companies that are creating power from wind, from solar, from other sources. That's an interesting investment opportunity. The companies that make the electrical grid that distribute that renewable power. But then also construction. So construction actually has a carbon footprint that is almost as big as the transport industry. And so what that means is that companies that can help lower the carbon footprint of construction, those are going to be interesting investments. It could be Caterpillar that makes big, heavy machinery. It could be Carrier that makes more efficient aircon, or it could be Sika that makes chemicals that are used in construction. So this is one potentially very powerful secular trend. Another one is supply chain reconfiguration, supply chain restructuring. So since 1990 until very recently, geopolitics didn't really matter that much because it was such a favorable geopolitical environment. But over the last 5 years, we've seen the emergence of a strategic rivalry between the US and China, and obviously more recently we see Russia back in the fray. On one hand, this is super scary on multiple levels, but on the other hand, it creates investment opportunity. We're already seeing the restructuring of supply chains, and that leads to an opportunity to invest in companies that allow new factories to be built. Think about automation companies, for example. It also means that shipping is more complicated than it used to be, so dynamic shipping companies that can provide better shipping solutions. But what about the companies that have done a really good job of looking ahead and seeing the way that the world is changing and preparing for it? For example, Tesla. They make cars in the US, they make them in Berlin, they make them in China. They're quite well prepared. TSMC, they make most of their semiconductors in Taiwan, but they're also investing heavily in Japan, in Europe, and of course in the US, in Arizona as well. So that's an example of supply chain restructuring. But I also mentioned that investment gain is going to be much broader in the future than it has been over the last 10 years. And this leads to a wide variety of different investment opportunities. The one I've called out here is actually healthcare. It's a golden era of innovation in the healthcare industry, and pharmaceuticals in particular is very exciting. Lots of things I could talk about. The one that I'm calling out here is exciting new drugs for the treatment of obesity. Obesity is, well, actually it's reaching kind of pandemic proportions. The estimate is by the end of this decade, there'll be 1 billion people suffering from obesity, which leads to cardiovascular problems, other heart problems, kidney failure. And companies are just starting to come up with very powerful drugs that really try to treat obesity. And in fact, the most powerful drug has demonstrated that it can reduce weight by 20 to 25%. Very, very exciting investment opportunity. Something else to think about in uncertain times is the importance of having really strong foundations for an equity portfolio. It doesn't always have to be exciting growth. Sometimes it's just a really solid business that can build a stable foundation. For example, Nestle. It's a company that has a very strong portfolio of food brands. It has a record of continuing to grow through every single recession over the last 30, 40 years. Produces a return 10, 11% per annum year after year. Something very different would be London Stock Exchange. Doesn't sound like a stable company, but actually today, around about 70% of their revenues come from selling data to investors like us who just need data to help with their investment decisions. And that data is sold on a contract basis. So it's renewable contracts year after year after year. Lots of stability to that business. And the final thing I want to focus on is dividends. And let me start by simply making the case for dividends. And I'm going to ask you to focus on the chart on the left-hand side of this page. And what this chart is looking at is returns on global equities over the last 30 years. and then it breaks the market out into whether or not companies pay dividends or not. So the first thing I want to highlight is that you can see that the non-dividend payers, so companies that just don't pay a dividend, they produce the worst return. So the implication is that dividends really matter. And you can see that with the dividend payers column, where it's actually produced almost the best return. But it's not simply a case of high yield. In fact, what's important when it comes to dividend investing is actually the sustainability of a dividend. So the ability of a company to pay a dividend and then grow it year after year. Those are the dividend growers. And actually, those are the stocks that have produced the best return. And by the way, the chart on the right-hand side of the page shows that these dividend-paying stocks, these dividend-growing stocks, have actually had the lowest volatility. They produce smoother returns as well. So I think dividends look interesting. But over the last decade, it's clear that dividends have not been in fashion. In fact, most of the investment gain over the last decade has come from more technology-oriented companies which perhaps don't pay dividends. And if you look at that column that says 2010s, what you can see is that only 16% of the return on equity markets has come from dividends. That is not normal. If you look across to the right-hand side of the page, you can see that over the last 100 years, dividends have usually made up almost 40% of total return, and it's likely that that's what we're going to see over the next decade, particularly as you can see in the 1970s, so that was another period with higher inflation, dividends actually made up most of the total return. So strongly encouraging you to think about investing in companies that pay dividends. Okay, so finally then, so what should you do? Well, my strong recommendation is for folks to think really, really carefully about what are your objectives. And I'm guessing that for most people in the room today, objectives are to do with saving for retirement, possibly saving to hand some money on to your kids. So we're talking about long-term objectives. And your investments should also be long-term. So let me map this out a little bit. And I'm going to start with this slide. And this tells a very clear story, which is that while we always worry about bear markets, bull markets matter much, much more than bear markets do. So what we're doing on this chart is looking back over 50 years or so, and you can see that the dark blue areas, those are the periods when we've had bull markets, when markets have gone up, and those are pretty big shaded areas. And then the bear markets are those small green areas. Now, of course, bear markets always hurt when you're living through them. But in the grand scheme of things, the most important thing is to make sure you're invested in those bull markets. And we got some handy numbers to summarize this a little bit more. So over the last 50 years, we've had 6 bear markets. Typically, the bear market lasted around about 1 year, so 13 months. And a bear market went down by around about a third. Very painful when it's happening, but it was just a third. Now, in contrast, we've had 7 bull markets. The bull markets didn't go on for just 1 year. They actually went on for 6 or 7 years. And they didn't go up just 35%. They've actually gone up on average 254%. So the most important thing as long-term investors is to make sure you're invested in equity markets so that you can enjoy these big bull market returns. Now, you might be tempted to say, yeah, I want the bull market returns, but I think I can time the market to make sure that I miss the bear market so I can have my cake and I can eat it too. The challenge is that timing markets is really, really hard, even for the most expert professionals. And one of the challenges here is that investment gains, they don't happen steadily over time. They're actually concentrated into just a few days. And I've tried to bring it to life with this chart where we're looking back over the last 10 years and we're looking to see what would have happened if you had invested $1,000 in the equity market 10 years ago. And the answer is, if you look at the left-hand side of this chart, the answer is you'd have tripled your money. So a pretty good outcome, $1,000 going to $3,000. However, if you had tried to be smart about market timing and you had not done a good job of it, and by the way, most people don't do a good job of market timing, and let's say that you had missed just the 10 best trading days over that 10-year period, you wouldn't have tripled your money, you'd have only doubled your money. So 10 days make that much difference. If you'd missed the 20 best days, actually, you'd have only made $600 on top of your original $1,000. Now, you might still say, okay, I still think I can do market timing. But the final challenge I'm going to lay out is that those really strong days when you make most of your investment game, they don't come easy. They're really hard to find. In fact, if you look at the 40 best days over the last decade, 30% of them didn't happen in a bull market, they happened in a bear market. And another 30%, they actually occurred in the first 2 months of a recovery. And remember, that's usually when the world is still in recession. So it's very hard to find these really hot days. And so pretty strong message here, which is saying that market timing is not a good idea, and instead being invested and staying invested is the way to go. And the final point I want to lay out here then is that actually this long-term investing approach really does lead to stability. So looking back here over the last kind of 15 years or so, if you look at all of the different one-year periods over the last 15 years, 70% of the time, over one-year periods, you'd have made money. 30% of the time, you would have lost money. But if instead you extend your time horizon to be aligned with your objectives, so for example, saving for retirement, so let's say you look at 10-year periods, 100% of the time, you'd have made a positive return. And so you can see I'm working this pretty hard, strongly encouraging folks to get invested, stay invested, and not try and get too smart about market timing. So I do want to give you just one final piece of advice. So I've spoken a lot about financial markets, but I now want to talk about fund managers. So the fact that you're here at a fund supermart event probably means that you're interested in partnering with a fund manager. And my final piece of advice is simply to be very careful about the manager that you partner with. And I'm making the case that Capital Group is a good partner. Why is that? Firstly, because our interests are aligned. We only do well if you do well. Our portfolio managers, they're not paid based upon how much money they manage. They're paid based upon investment results. They only get paid if they first make a lot of money for our clients. So I think that's the first point I want to make. And the second point is just global strength and scale. We've been managing money for more than 90 years. We have 30 offices around the world. We have 8,000 associates working to improve the lives of our clients through successful investing. Now, obviously, I would say that, wouldn't I, because I work for Capital Group. So my final word will be to instead ask you to listen to the independent experts. So Morningstar, arguably the world's, or one of the world's most successful fund rating agencies. Last year, they named Capital Group as the best asset manager in 12 countries across Europe and Asia. So I encourage you, if you won't listen to me, do please listen to Morningstar. So I close by wishing you luck, not just for 2023 investing, but actually for the next decade or so of investing as well. Happy long-term investing.
So yes, ladies and gentlemen, opportunities for you with Capital Group, and of course you can find out more over at their booth and be able to share your own experiences and connect with them to be able to make sure you position yourselves better. With that said, right now, we do have the next talk, and it's very interesting. In today's climate, we talk about smart technology, we talk about the different kinds of technology that will enable us to invest better. This topic right now is titled Embracing Artificial Intelligence of Investments, Embracing AI. And who else better than the head of Artificial Intelligence of Investments from Lion Global Investors, Ong Ai Ling.
Thank you very much. Thanks, everyone. It's great to see a big crowd today. So when I first gave this presentation in October last year, it was a very different kind of understanding amongst the mainstream crowd about artificial intelligence. And I think since October now, you see a lot of press about this new AI chatbot called ChatGPT. I don't know how many of you have seen or heard about ChatGPT. To the point where I think a lot of the mainstream press is now saying that, oh, AI is sentient. And by sentient, they say it's human-like, it's conscious, artificial intelligence, it's like Skynet, it's like it's going to come and eat us alive. They're aware of what's happening. So hopefully after today's presentation, I will convince you that artificial intelligence really is a good and important and useful tool, but we are not yet sentient. And to do that, I will try and explain and share with you how and what AI is and how we can use it. So this is how AI works in roughly 30 seconds or less, right? Effectively, you notice that every time the chicken pecks on the pink dot, so it presses the pink button, it will get given a reward. And every time it pecks on the blue button or anything else, it doesn't get a reward. So effectively, artificial intelligence is in some ways like human intelligence. It learns repeatedly from a lot of experience of experiments that every time it gets the right answer, it will get the weight of the mathematical weight of the branch higher if it gets the correct answer, and reduces the mathematical weight of the branch if it gets it wrongly. So in some ways, your AI is being taught to think for itself. It is basically like a digital Pavlovian dog. So what are some common common artificial intelligence lingo that you hear in the general press? And hopefully this will help you understand the basis of what artificial intelligence is. In the biggest circle there that you can see, the dark blue one, is the all-encompassing idea of artificial intelligence. And that's actually not new. That's been around since the 1950s, 1960s. In essence, what it means is that anything that can use machine algorithms to help you make decisions without the human constantly being there, say, yes, choose one, choose number two, that is called artificial intelligence. To give you an example, right? It uses what we call if this, then that kind of logic. It's the same way that I taught my kid how to cross the road. When you get to the road junction, if you see a green man, you cross the road. If you see a red man, you stop, you don't cross. And you say, yes, mommy, okay. Now, reality is humans, we know, if you see a green man and you start crossing and there's a car hurtling towards you at 100 kilometers an hour, will you still cross and get run over? No. This is where we move into the next circle, the middle circle, called machine learning. Because what it is instead of telling it, if you see this, then you do that, you give it a bunch of experimental results and let it try. Let it try crossing the road by itself. You may have heard of autonomous driving. That's how it works. Basically, you let it try itself, let it get into trouble, and it learns, oh, if I do this, then it's a bad idea. If I do that, it's a good idea. And it does this over and over again until it learns. To be honest, it reminds me, I'm a parent myself, so it reminds me a lot of how I taught my kid, right? When I had a baby, you can't tell the baby, hey, you do this, then you get this. The baby doesn't understand. So what I teach my baby, I said, oh, every time it cries, I give it milk. Every time it cries, I give it milk. After a while, it learns that when it cries, it gets milk, so it keeps crying. Unfortunately, the same with babies is sometimes you get the unexpected result. I don't want it to cry, but instead I get it crying all the time because it wants milk. So that's what we call machine learning. And within that, there's another, what's very popular today, and I'll talk a little bit about it in a second, what we call deep learning, which is recurrent neural networks. Sometimes some people call it slightly black box AI, because it uses many, many layers of neurons to figure out the correct answer, not just one or two layers. Okay, here are a few more terms that you might hear: supervised, unsupervised learning. For the interest of time, I'll let you read it, but it's not critical. So what is important, which we want to highlight, is why Lion Global Investors, why we're making an effort to build out our AIOI, or what we call Artificial Intelligence of Investment Capabilities. Because isn't it good enough just to have humans make the investment decisions for you? Doesn't every human, aren't we capable of coming up with our own investment outlooks? Well, if you put 100 humans in a room, you might get 101 investment outlooks. That's the issue. The reason why we think it's very important is because we think that the field of artificial intelligence is now at a tipping point. So in 2016, they said that your artificial intelligence is now as smart as a human 6-year-old. I think that is the wrong comparison. It's not about AI versus IQ. It's about how you use that IQ. A 6-year-old, if you give that 6-year-old unlimited memory space and unlimited processing speed, can come up with feats that even an adult human cannot achieve. And how is that? You might remember in 1997, IBM Deep Blue beat the chess champion, and that was a landmark win for machines versus humans. But how was it able to do that? It did that through brute force. So if you teach a 6-year-old how to play chess and you give it unlimited memory and it can process the moves faster than anyone, you all played the game tic-tac-toe, right? You all know that if you're the first person to start moving in tic-tac-toe, you will always win because you know that there's a certain number of moves that can happen. So this is what we call brute force AI. If you just move it in a certain way, you will definitely always win. So what is happening here is that since then, in 2016, we've actually developed, the artificial intelligence world has developed a new algorithm called deep learning. And that is far more impressive because it is more than just brute force. It actually learns through repeated permutations, repeated repeated games by itself, and it learns the important patterns of which areas it should focus on. And that is what we call deep learning. But for us in the asset management industry, it is particularly interesting that in 2017 and 2021, the data scientists actually developed artificial intelligence algorithms that's able to win humans on poker, Texas Hold'em poker. If you're a poker player, you'll know that chess, you see all the information on a chessboard. Go, which is Wei Qi, you also see all the information on the board. With poker, you hold your cards to the chest, which actually is much more similar to real life situations where you have imperfect information. When you look at the investment market, do you know everything that's happening there? Do you know why someone's selling? Why is the company selling or issuing new shares? There's a lot of information arbitrage that's available in there. And that I think is particularly interesting that we can use these kind of algorithms and apply them to the financial world, and that's what my team is doing. We're using artificial intelligence algorithms from the data science world and applying it to the financial world. So now I hopefully have convinced you that we have the capability, the technology to build AI asset managers. But why do you need to switch? Why fix something that's not broken? If humans can do this well, why not just stick to humans, right? So I think there are actually a lot of push and pull factors. So on the push side, I think everyone will agree. Today, how many people have a smartwatch? How many people carry a smartphone? How many of you probably use GPS when you're driving? There's a lot of data that's being collected. And all that data is like information that can be used by someone to do something, right? So we live in an age of information technology, this age of data where data is the new oil. But if you have too much oil and you don't know how to process it properly, you end up with an oil slick. So you might have heard of some funds that uses alternative data, such as drones to count the number of cars parked outside a supermarket, and then correlate the number of cars that are parked outside the supermarket to the revenue numbers of, let's say, Walmart, or in Singapore, maybe Sheng Siong, right? You go and count the number of cars in front of Sheng Siong, and then you say, oh, next month, how much is Sheng Siong going to announce for their earnings? And if it's higher than people expect, oh, you make money, right? So some people do that. And I actually used to work, I'll show you my bio later, I used to work at one of the funds, I can't say which one, that pioneered this use of alternative data when it comes to investing. But if you think about it, that is just one piece of information in the multi-factor world of information that you need that influences how a stock price moves, right? In the past, when you only have limited number of information available, when there's less data, it's easier to process it with a human brain. But when there's hundreds or even thousands of data points per single company, and you multiply that by thousands of companies out there, do you think our limited human memory will be able to deal with that amount of information? So that's on the push front. On the pull front, what we're seeing is that increasingly, what is bad for human brain power is actually really good for AI. As I mentioned earlier, the chicken pecking and all these experiments, deep learning. Google, in order to tell the difference between a cat and a dog, needs millions of data points about cats and dogs. Likewise, in order for AI to do a lot of work on stocks, you need tons of data points. So the more data points that is bad for humans is actually a good thing for artificial intelligence. And secondly, we also have now cheaper and faster computing. And in particular, cloud computing has been a big advantage for us. For us at Lion Global Investors, when we decided to build out our artificial intelligence unit, we went straight to the cloud. We went cloud native, which means that our build-out time in terms of infrastructure is much faster than someone who has to go and procure the GPUs, build out the racks. You know, tomorrow, the minute we pay our cloud subscription, we can turn it on. And best thing is elastic. In cloud computing, there's this term called elasticity of your compute. When I need more compute power, I can just rent more of it. When I don't need, I just rent less. So that plus finally, there's increasing amount of AI algorithm that is becoming open source. At the start of my speech, I mentioned ChatGPT. I don't know how many of you are familiar with ChatGPT. You might have heard that it's run by a company called OpenAI, which is co-owned by Elon Musk and Microsoft plus other investors, right? So OpenAI is an open source AI platform. So in other words, a lot of these things that power ChatGPT, for example, is actually available to my team of data scientists and any data scientists out there to take it, use it, customize it specific for our use case, and use it in investing. And if there's nothing else you remember from this talk, just remember that, you know, all that technology is out there and available for us to use. But me alone or you alone, can you go there and can you find the API to pull it and, you know, customize it? And even if you were, let's say you are a computer scientist and you're very good at doing that, but do you have the financial knowledge to do that? So at Lion Global, what we're trying to do is a confluence of two things. We've got decades of experience in making financial investments, and we're trying to use artificial intelligence to mimic how the human makes investment decisions. Let me share with you, this is just a little survey to show how important AI is in investment management. But in the interest of time, let me move on to our capabilities. Let me share with you a little bit about our journey so far. Lion Global has been doing this since 2016. We started multi-factor investing in companies that were disrupting incumbents back then. And we launched our first multi-factor fund, something that was quite new back then to the Singapore market. And in 2021, we set up our AIOI, Artificial Intelligence of Investment team, to focus on feature engineering and data analysis. Like I mentioned, our goal is to use our deep domain knowledge of fundamental investing and leapfrog beyond just simple quantitative techniques to leverage machine learning and AI to do the heavy lifting on the investment analysis. And just to mention, I think in December 2021, we did a consultation collaboration with NUS, who evaluated our investment model from a statistical and data science standpoint. And I mean, we have to say that they are third-party independent evaluators. And since the start of 2022, we have launched several live funds which employ the AIOI strategy, and we're developing more strategies as we speak. This is our current team setup. We have, one short. We actually have 5 investment professionals now and a lot of support staff. And our investment professionals are all quantitative and machine learning researchers in the finance industry. These are some of the challenges that we overcame. And then I want to share a little bit about our AIOI approach. How do we do it? So hopefully if I've convinced you that the technology is there, it's ready to be deployed, LGI has the vision. We are willing to invest and make use of this technology to make investments for our retail investors. And then now I'll just share a little bit about how we're doing it. So the markets are not as simple as just classifying, is this a dog, is this a cat, should I cross the road, should I not cross the road? Instead, the market is very noisy. As I said, there's imperfect information, a lot of noise out there, a lot of complex relationships between the different pieces of data or different data points out there. In order to be a good investor, first of all, we try to learn, first of all, we try to distill down what are the key things that makes a good investor. So to us, first of all, you need to have a lot of investment experience, right? People you always respect, gray-haired investors, because they have a lot of experience and they've seen a lot of different cycles in the market. Now, then secondly, you need to have a clear and robust investment framework. And finally, you need to be able to make a decision that balances everything out. Now, if I reframe that in an AI context, when you have lots of experience and history, that also basically means that if I can collect all that data, 20, 30 years worth of data points, I'm able to then use the AI to recognize patterns that even an experienced investor could have missed out from this historical information. In terms of making a clear and robust investment framework, like I explained already, the AI algorithm is able to recognize the rules and exceptions and know when to deviate from such rules. And finally, it is able to consolidate the information. And this is what is different between a if this then that simple quantitative strategy, which some of you might have heard of, quant strategies, versus a machine learning based algorithm that actually balances the information out there. In the interest of time, I can't go through, this is a very mathematical page explaining the difference between a simple linear regression, which is what a lot of quantitative strategies use, versus a machine learning method on the left-hand side, where effectively it elevates the data points from a two-dimensional space into a three-dimensional hyperspace. Perhaps the best way and the most intuitive way is to just give a simple example. Remember I mentioned that if you count the number of cars in front of the Sheng Siong supermarket, you can draw a straight line and correlate it to how much earnings Sheng Siong's going to have, right? That's a linear regression. We learned that in math in secondary school. But what if you feed the raw data into the AI? Your drones are there counting the number of cars, but they're not just counting the number of cars. They're also able to collect for you what type of car it is, how many people exit the car. Is it a mother with a kid, or is it a guy in a suit who's going to actually walking over to the next door office and not actually going to buy anything from the Sheng Siong supermarket? Can you see now how these kind of detailed information, which to us, humans can understand that, right? So if the guy is coming out in a suit, he's going to the office, he's not going to actually buy anything from Sheng Siong. If the mom is coming out with two young kids, you know what? She's probably going to buy more than just a young couple who's going in there to buy for two people. They're going to buy for a whole family, right? Especially if there's a grandmother with the helper and everyone, they're going to shop a lot that day. So this is information that humans can do, but how many humans are you going to need to go and count every single Sheng Siong supermarket, multiply that by how many companies there are just on SGX alone, right? And then globally, you need way too many humans. But AI with a simple algorithm can help you do all of that. So that is why I'm saying that machine learning is better than simple quantitative investing. So to try and explain how we then relate that to how we do our investing. As I mentioned earlier, since 2016, LGI has been a proponent of factor investing in the Singapore market. In the past, there were just 5 simple factors, and that's a simple but effective approach. But as I mentioned today, with the deluge of data out there, there are hundreds, maybe even thousands of factors. But I have a few issues with all these factors. First of all, the factors are never consistent. So you can say that, value over the long term, which is the blue line, value over very long term, will do well. But how many of you have been stuck in value traps? Stocks that are value and never seems to do well, right? So we came up with this approach, which is that basically traditional factor investing is static. It doesn't capture the dynamic shifts in the market. And also traditional factor investing doesn't capture the alpha that you get from combining many, many different factors. So we used machine learning to identify and dynamically combine the factors. To put it in an intuitive way, how is it emulating what I do as a PM? I've been a PM for 17 years. What I used to do was, if I noticed that, say, commodity stocks are doing well, I can buy commodity stocks, correct? But the smarter thing to do is to buy the next thing that's going to do well. How do I know what's the next thing that's going to do well? Well, I look out for stocks with very similar characteristics, such as bulk shippers. They're also capex intensive. They're also related to the commodity cycle. They have sensitivity to commodity cycle. And why would they do well after that? Because as commodity does well, your volume increases, the margin increases. So I have basically trained the AI to recognize all these kind of fundamental characteristics about a company. So when I find the stocks that are doing well, I will find other stocks with similar characteristics, but hasn't yet started moving in price. Okay. I'm so sorry, I think time is up, but these are the key features of our AIOI engine. If you're interested to know a bit more about our detailed process, we have a 6-step process, of which step 3, 4, and 5 are where the AI engine really does its magic. If you're interested to know more about the AI engine, please do visit our booth. It's just behind there, Lion Global Investors, and you can get AI to make you a cup of coffee as well. And this is an example of one of the natural language processing model that we use. And finally, we don't have, I think We've launched only one fund that is available to retail that is using artificial intelligence. We hope to launch more in the future, but in the meantime, you can scan this QR code and find out more about our first fund that has been launched using artificial intelligence. It's the Global Disruptive Innovation Fund. Thank you.
All right, everybody. So once again, we have our lucky draw. So lucky draw. Yeah, I love it. I love it, man. I love this enthusiasm. All right, lucky draw time. Previously, we gave away $100 of the FSM1 credits. Now, thanks to our beautiful sponsors, give me a moment to read out for you because our beautiful sponsors has really given a wonderful prize and they are giving away 4 Apple Watches! Come on, let's give it a big round of applause. Yes, there we go. Apple Watches. We want to thank BlackRock, Seasop Asset Management, Franklin Templeton, and Schroders, all 4 companies. Thank you very much for this sponsor. And with that said, to draw the prizes, we would like to invite our investment director from iFast Singapore. Let's welcome Kenny John. Alright, so let's step over here. You can step over on the right hand side so that you can start drawing. We got 4 wonderful Apple Watches. So, ladies and gentlemen, please come on over as we are about to draw the prize. Because when we read out your number, and if you're not here, so how, Kenny? You just have to redraw lah, huh? With that said, let's go with our lucky draw. Our very first winner, Kenny. Let's draw them out. Here we go. Dun 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 dun. And lucky winner will be, okay, first number
1
6
4
164 1649. Are you here? 1649. Are you here? Dun, 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 dun. Hey, congratulations! Alright, so just to confirm the number, 1649. Great, here you go. Congratulations! Hang on, just go more. Just stand towards the front over here. There we go, together. That's right, so stand to the front. You may take off your mask as well if you would like to. Alright, great stuff. So you can hold the prizes together. Here we go. Here you go, one good photo. Congratulations! Well done! Now, let's draw on to our next lucky winner. Go ahead and let's see who will be winning. I wish you all the best for your enthusiasm, ma'am. Right over here, we have, once again, okay, first number.
1
6
1
Okay, 161s. Are you here, our 161s? Are you here? Are you here? Okay, I see a few. Yes, very good. 1 6 1 9 1619 are here. Congratulations! Well done. Here you go. All right, congratulations. Come on over to your left hand side. There we go. Just need to see your ticket as well, right over there with the flyer. Thank you very much. And it is 1619. Congratulations. Well done. All right, feel free to step to the front once again, and you may take off your mask so that we can take a photo together. So here you go. Yes, well done. Here we go. One photo. Thank you very much. Oh, it's exciting. We got 2 winners straight away. In the previous rounds, maybe in the morning, people haven't wake up yet, haven't taken coffee. Now, the moment we read out, they are here and present. So, with that present, let's give out the next Apple Watch. Ooh la la. And, all right. So, here we go. Same thing, Kenny. First number is going to go to
1.
Wow. All the times 1. One's very lucky, yeah? 1 1
3
Okay, 113. 113, okay? 1, 1, 3, 1, 1131. Are you here? 1131, 1131. Oh, 1131. Do we have it? Yeah, congratulations. Come on up, sir. 1131. Correct? 1131. Yao Yao San Yao. 来。Amazing, congratulations, we got 1131. 来，到中间这里。There you go. Thank you very much, sir. 来，我们到中间过来，过来一点。可以。来，当你右边一点，右边，慢慢来，多一点，再多一点。好了，来，把这个手表呢放在前面这里，来给大家看一下。OK， 来，笑大一点，耶，恭喜你 ！1, 2, 3, let's take a photo. All right, exciting! We're so happy to give away the prizes, and truly, people of all ages, no matter what, we can wear the Apple Watch, and more importantly, are all here to learn, right? No matter what age you are, to be able to find out information to how to invest better, position yourself better, because as we've always said, this year, it's different. With that, let's draw our final Apple Watch prize. Here we go. Bum, ba-dum, bum, bum. And our lucky winner. You got luck today. All right, so Kenny, once again, first number.
1.
1, all right. 1, 8.
9.
189. All right, final Apple Watch. 189. Are you here? Yes, good. 1891. 1891. Are you here? Congratulations. 1891. 1891. Going once. Going twice. And it is a redraw. 1891 not here. So let's go ahead with the redraw right now. All right. Still got chance. All right. So with next up, we're going to have our wonderful conversations and topics to be able to share with you as well what other things you should look out for in today's investment world. Now, Kenny, first number?
2.
Oh, we have changed. Oh, 2s are coming out, all right? 2, 2, 2, 2. Third number?
1.
221. All right, the 1 is inevitable. It's always here, okay? 221. 9! Are you here? 2219. 2219. All right. 2219. Our lucky winner. 2219. Going once. Going twice. Going. And oh. Do we have it? Is this, someone raise a hand? Ah, you bluff me. Very naughty. Everybody also, hey, don't have okay, don't want redraw Faster count MC redraw. There we go. I can literally feel in all of their eyes, right, saying redraw. All right, so once again, we have our first number.
1.
1, 9,
3.
193. 1934. Are you here? 1934. Are you here? With Bun Hong, Tan Bun Hong. 1934. Are you here? 1934. 1934. No. Yes. Yay! Congratulations. Well done. And with that, congratulations to all winners. But coming up next, right away after this, will be our next topic. So, with that, thank you very much, Kenny, for joining us. And of course, let's give a round of applause to all our winners! So, ladies and gentlemen, just to let you know, there will be another lucky draw coming up as well towards the end, and that's going to be at 5 p.m. And with that said, make sure you put your tickets and your stubs into the FSM booth box so you can attend the lucky draw. Beyond that as well, I just want to highlight that coming up right now is going to be a topic called No Storm Lasts Forever. So why this time is different for commodities and what does it mean for investors? It's going to be by our research analyst, research and portfolio management, IFAS Singapore. Ladies and gentlemen, let's welcome Chloe Nadia Halim.
So a very good afternoon to everyone. Thank you for joining us here today. My name is Chloe and I'm a research analyst at IFAS. So today, my topic of focus will be that of the commodity sector. So to start off, just want to give some of a brief recap of the key events in 2022. So global commodity markets have surged to multi-year highs in 2022. And the world's most actively traded commodity, which is that of Brent crude, actually topped $130 per barrel in March. And this is close to an all-time record following the outbreak of the Russia-Ukraine war on 24th Feb 2022. And as seen in this chart above, many events over the past year have resulted in much volatility. However, at the back end of 2022, we started to see that the market saw a retreat as it braces for weaker economic growth. Nevertheless, despite the immense volatility experienced in 2022 as a year has been a great year for the commodity sector, especially since commodity prices have remained at elevated levels. For example, within the S&P 500 sectors, the energy sector had far outperformed other sectors by a wide margin, and is the only sector that had delivered positive returns, returning about 58% to investors. Other than the Russia-Ukraine war, I think 2022, as we all know, is a pretty significant year, as it, after all, marked an inflection point where the multi-decade loose monetary policies were being swiftly reversed following record high inflation. And you can see in the table here that the 2022 rate tightening cycle was the most aggressive since 1988. And just to put some things into perspective, rates have gone up by about 425 basis points in the span of 9 months, and it's a rate of change that by far exceeds previous tightening cycles. And despite these aggressive rate hikes, we will nevertheless be entering 2023 with persistently high inflation observed across major economies. And this unease about inflation is not new, and it's been building up for quite some time now, following the post-COVID-19 recovery as well as the persistent supply shortages due to the war in Ukraine. And not to mention, the labor market has been pretty tight, and all of this contributes to this elevated inflation being seen. And for policymakers and investors alike, these are all difficult macroeconomic conditions to navigate, and even with the aggressive rate hike, inflation remains at elevated levels and well above the Fed's 2% target. And tighter monetary policy is now starting to bite. So the leading economic indicators are pointing towards a slowdown. Your PMI indices across major markets are now in contractionary territory, and it reflects the headwinds faced by the major economy. And the health of the US economy has also deteriorated, with the US leading economic index falling for consecutive months now. And while the Fed has talked about trying to engineer a soft landing, and what this means is involves slowing an overheated economy without bringing about a recession, I think we can say that this does not inspire much confidence, as after all, the Fed has a somewhat mixed track record, and with the indicators all showing a deteriorating economy, this likelihood of a soft landing becomes increasingly unlikely. And if we take together the fact that rising prices and slowing growth are acting together, I think we'll likely see this stagflationary environment unfolding. And then stagflation has been, in terms of few extended periods of stagflation. So a last major time we saw a period of stagflation actually occurred was in the 1970s. And back then, interest rates were soaring, there was widespread food and energy inflation, and the economy was also a mess back then. But the good news, however, is that commodities, they actually tend to perform well when inflation rises, often because they are the cause of the rise in inflation. So let's take, for instance, there's actually a strong 10-year correlation between the Bloomberg Commodities Index as well as the year-over-year growth of the US CPI index. And this correlation is actually about 0.8. So regardless, stagflation or not, what we'll witness going forward is this tugging forces of a possible demand slowdown and supply tightening that will play out in full effect in the commodities market in 2023. So now markets are trying to determine the impact of a slowing economic growth on the overall demand. But while the demand risks remain, let us not forget that supply risks have not disappeared and are in fact growing when it comes to commodities. And while the short-run price movements of, let's say, your commodity prices, they are often unpredictable, especially in the short run, they are often more predictable in the long run. And with this, we'll be looking at the energy, metals, and agriculture space within the whole commodities complex. So when we look at energy, we think that prices will remain volatile, but are naturally skewed to higher prices. And it's because we see that a lot of these OPEC plus production issues continue to linger. So as a whole, OPEC has actually ignored calls from US and other key consumers to actually try to increase oil supply amidst all these higher prices and tight supply. And OPEC Plus, they actually have zero motivation to try to boost production. As they squeeze the tight oil supplies would actually benefit a lot of these OPEC Plus members who are oil producers themselves. And moreover, due to this whole weaker economic backdrop, OPEC Plus has actually announced production cuts of about 2 million barrels per day. And this would last from November till end 2023. I think more importantly, another reason why we see this is the case as the physical constraints on OPEC Plus to actually increase production. And we see that there's a consistent failure of the group to hit even their own reduced production targets. So many members are producing well below their quotas and ceilings due to a lot of operational issues, as seen in this chart throughout the whole of 2020 actually. So moving on to my next point, I think we cannot leave out the fact that 2022 was a year where China had largely been locked down. And so this whole China wildcard with China reopening is something to definitely consider. So the second largest oil consumer, which is that of China, is now trying to reopen. And this whole progress on the reopening efforts could provide some upward momentum for oil prices. And this whole rapid dismantling of the COVID-19 policy, of COVID-0 policy, has naturally prompted optimism over the longer term, especially when it comes to, let's say, your commodity or energy demand. But where it stands, we nevertheless do take note that energy consumption is actually uncertain in the near term, as a lot of the virus cases surge across the country. And I think this is the most major point of all. I think more importantly, when it comes to this idea of energy prices remaining volatile but skewed to higher prices, the main reason why we think this is the case is due to the fact that there's no long-term supply response in sight. So without sufficient capex to actually increase your supply capacity, the oil and gas will remain stuck in a state of further shortages with higher and more volatile prices. So in fact, the US and the other OECD countries, they release large amount of oils from their strategic reserves, and this is equivalent to about 1 million barrels per day since March 2022. And these releases have sharply reduced the level of strategic reserves that they have left. So let's take, for instance, your US SPR is now currently at its lowest level since 1984. And it reduces the available amounts of buffers in the event of, let's say, your future oil disruptions. And despite all these falling inventories, you can see that the private sector response in the US seems to remain contained so far. So if you look at this chart here, in terms of looking at the US domestic oil production, the US oil rig count failed to rise in line with the prices, especially when you compare that they move more in line with the prices, especially over the past years. And structurally, this whole oil and gas sector is one that is defined by underinvestment, and this has been the case ever since 2014. So why the high oil and natural gas prices are not translating to increased production is due to the investor pressure to maintain your capital discipline. And moreover, I think we can all see that there's a lack of desire and investment within this space, especially given the ongoing transition in energy markets to that of lower carbon fuels or your renewable energy sources. And with this whole green transition underway, we're unlikely to see much exploration and development of new fossil fuel sources of energy. So moving on to metals, China actually looms large for this whole industrial metals complex, as again, the country is actually the world's biggest users of metals such as your steel and copper. And this whole dismantling of the country's zero COVID policy added much optimism to the metals market and may actually get a boost from the improvements in China's economy over time as they reopen. But where it stands, I think there's a lot of uncertainty with regards to the demand and whether China will recover. And in the short term at least, China's unraveling of this whole zero COVID policy actually pose a volatility risk, and demand has yet to show meaningful signs of recovery. As after all, China's construction market had actually faced a very difficult year in 2022, and is actually faced with a confidence crisis. So the home buyers are not even convinced that the developers can actually deliver the properties that have been pre-sold, given the waves of defaults we're seeing, especially over 2022. And while the recession as well as slowing growth concerns, they weigh on the current metal spot prices, the space does look very compelling from a fundamental perspective. And not to mention, following the energy shock seen following the Russia-Ukraine war, it's actually a turning point where it would actually help to boost the shift to renewable energy and clean energy sources. So the medium to long-term outlook for metals is particularly attractive as this whole green transition becomes a priority, and it brings with it a significant driver of incremental demand for, let's say, your green metals such as your copper, nickel, cobalt, lithium, and the other metals that are associated with this whole renewable energy technologies. So for instance, this electric car, it uses about 5 times more metals compared to, let's say, your conventional car. And the same also goes for other wind and solar technologies. They are far more metals as well as minerals intensive. And governments and companies around the world, they are now trying to secure all these critical metals that will play a vital role in the near future. And as usual, we see that supply side comes into a problem as this supply side is faced with challenges, as after all, the mining projects, they do have long lead times and they require large amounts of investment. So in terms of lead times from resource discovery to production, they can average about 17 years. And what this actually brings about is that of greenflation. So greenflation increases the price of, let's say, your metals as well as your minerals that are critical towards this whole green transition. So last but not least, we'll be looking at the agriculture commodities. So agriculture commodities, they had a good, strong 2022 with the Russia-Ukraine war, as well as the extreme weather pattern conditions that are pushing the prices higher. So while the Russian-Ukraine war has gone on for more than 10 months now, we see the fact that this whole issue of food security remains very persistent and prevalent, given that Ukraine is, after all, one of the world's biggest grain and vegetable oil exporters. And this issue of food security has been brought under the spotlight given that the effects of rising food prices have been felt throughout the economy. And you can see all this from the governments imposing export bans, to price controls, to that of higher grocery prices that are hurting consumers. And while the food prices have actually come down a bit since the summer, I think they remain high by historical standards. And going forward, we see that climate change will continue to challenge this whole agriculture supply, as it's after all very weather dependent. So of late, there are no shortages of headwinds facing this food supply. With a lot of heat waves and droughts, they are taking a toll across Europe, China, as well as India. And as the planet heats up, our weather patterns will actually continue to change, and this would mean a growing drag for your agriculture output in years to come. And despite this, you see that global agriculture demand remains strong, and in terms of the supply growth side, we're faced with a deficit. And climate change will continue to hamper this food production as they lead to severe flooding as well as droughts and challenge this agriculture use in time to come. So if we take all of this into consideration, what this naturally means is that going forward, we do expect a lot of macro as well as geopolitical and climate volatility to continue into 2023 amidst a tight supply backdrop in commodities. And what this means is that it ensures that your energy, your metals, as well as your food prices, they will likely stay elevated. And even with a recession or stagflation scenario in 2023, we think that this could be pretty mild and may not be so detrimental to the commodity sector. As after all, the reason why we think this is the case is that the commodity sector as a whole has actually strengthened its balance sheet and maintained fiscal discipline. So it's been pretty heartening to look at this whole sector and see that the energy and materials sector, which has traditionally been very capital intensive, such that 5 to 10 years ago, it would be hard to imagine that these are the two industries which will have very little debt. And in a high interest rate environment, having a strong balance sheet and little leverage would actually benefit these sectors. So overall, when we look at the whole commodity sector, we do have reasons to believe that going forward, the sector will be more resilient, and there are strong secular trends in the space that would drive its growth going forward. And while the next few months may actually be very worrying, we think that in the longer term or in the years ahead, it will be very exciting for your commodities investors. And in the longer term, we think that the demand for, let's say, your energy, your transition metals, as well as your food, coupled with the increased spotlight or your focus on, let's say, your sustainability as well as security issues, it presents an enormous number of opportunities for investors in the space. And with this, I actually come to my final slide. So within our platform, there are a lot of ways to gain exposure to the commodity sector. So for ETFs, investors can actually consider the VanEck Rare Earth Strategic Metals ETF or the VanEck Agribusiness ETF for their respective exposure above. And our research team has written articles on both these ETFs before. And for funds, there are a couple of recommendations we have. So if you're seeking a dedicated exposure to the energy sector, you can definitely consider the BlackRock World Energy Fund. And for the natural resources, the JP Morgan Global Natural Resources Fund enables one to get exposure to both the energy as well as the metals and mining sector. So last but not least on the list, we have the BlackRock Natural Resources Growth and Income Fund. And this is by far the most comprehensive fund out there, as it provides one with exposure to your energy, your metals and mining, as well as your agriculture. So in a sense, it's very representative of this whole commodities sector. And with this, I actually come to the end of my presentation. So thank you everyone and have a good afternoon.
Very much, Chloe. All right, so little nuggets for you about what kind of funds that are recommended for you to invest in. And it's a great way because most people will start asking questions, which stock to pick, which one to pick. But when you go for your ETFs or your funds, those are really good amalgamations about how you can actually just get a good fund to invest in based on the industry, based on the sectors, based on the interest that you are in. Because it's always good to know what you're investing in. Now, let's move on to our next conversation for the day. Throughout the day, we have been talking about China. Is it good? Is it bad? Wow, the context of it. Now, you've heard many things already. But right here today, we want to share with you another perspective as well. So, today's topic right here, right now, is going to be about how to step through to the future of China. With that, we have our speaker for today, Head of Asia Equities, UOB Asset Management. Put your hands together. Let's welcome Colin Ng.
Good afternoon, ladies and gentlemen, and also our respected elderly. I hope over the next 20 minutes, I'm able to provide you as much information about China. I know that there are previous speakers have already spoken about a lot on China, but just let me highlight to you what I'm going to say. I'll go briefly through the macro and the policies, and of which I have to talk a bit on economic, and I'll touch on technology innovation, and as well as China Green Revolution. Okay, the point here is that I believe you all have always listened to the news to get in touch with what's happening in China. But however, I just want to highlight that certain Western narrative, you have to make your own judgment, okay? And in this case here is that, come tomorrow, China will officially open up without any restrictions, and thereby ending their 3-year self-imposed isolation from the rest of the world. The point here is that, they have actually taken what we deem as a scientific or a decision based on scientific evidence. I think all of us are also aware that the current COVID variant, whether is it the Omicron variant or the XBB variant, is actually not very fatal. So in many senses that I think what our government in Singapore, when we make the decision to open up, basically to all travel, I think there was some anxiety by Singaporeans, But I think what we also believe here is that I think what it shows is that the current variant is not that fatal, in terms of fatality rate. So while the Western media will highlight that possible 2 million deaths in China, I am sorry to highlight to all is that it's unlikely to happen. And even if it happens, I just again want to highlight to everyone is that, US have a death of 1.1 million people in US, but the stock market continues to be very high. So death, actually, the market doesn't really look at death, but markets look at business or economic certainty. So without the zero COVID policy, what it means is that the government is open up. There will be no more lockdowns, no more supply chain bottleneck, as we have all heard over the last 1 year. What it means is that there are actually more certainty for businesses. And therefore, it is actually a good opportunity, if you really want to invest in China for the next 2-3 years. You look at China data here is that there's nothing to shout about over the next 1 month, next 2 months, until after Chinese New Year. Why is that so? It's because I think at this moment the figures are very weak, but the market look forward. markets normally have to be, the way it is that they don't look at the current data now. These data are useless. They are weak data, and it's expected. But what I want to highlight to everyone is that come 2023, China's growth will be around 4.9 to 5%. That is basically the strongest growth driver of all the other countries in the world. So we talk about major countries like US, like Europe, Germany, UK, or Japan, for example. China, being the second largest economy in the world, is going to have a growth of at least 5%. And that is actually underpinned by consumption and Okay, unlike as we have all talked about, talk about inflation. I think the previous speaker also talked about energy prices going up very high. The point here is that China does not have an inflation problem. China's inflation last count was at 1.6%, and meaning that interest rates can be very accommodative for economic growth. So in that sense, I just want to highlight to everyone is that not the whole world is in hyperinflation. Even Singapore is in inflation. But the point is that in China, inflation is just at 1.6%. And therefore, their interest rates are actually pretty accommodative. I know that for the past 1.5 years, investors are all very concerned about the property market in China. No doubt, I also agree that there were actually a pretty tough situation then. But it's actually after, I would say, 1.5 years, since the crackdown of China Evergrande, which is the largest private property developer in China. But since then, what the Chinese government has also highlighted is that they will ensure, they come up with a 16-point plan to ensure that they will ensure sufficient support to the property sector. So Chinese government is not, when I study China and Chinese government, is that they are not in a habit to bail out companies that they are not obedient to them, I mean, in a sense that these are all private-owned enterprises. We're not talking about Jack Ma, all this. They are not obedient. So you cannot do that to the communist, regime that we are talking about in China. But after 1.5 years, when China wants to ensure a soft landing, I believe that they can do it with time. Okay, I know you all also may have all followed news about the Chinese market, especially on politics, and meetings about people like Joe Biden and China, and recently even Philippine Marcos went to meet with Xi Jinping, and also Saudi Arabia, when Xi Jinping went to visit Saudi Arabia. So there's actually a lot of happening over the last, I would say, last 3 months, and that actually, to us, is that it actually is making the environment pretty conducive for the Chinese stock market, or Chinese economy forward. I just want to highlight here is that how you look at it is that over the last 2 years, in 2021, China, the Chinese government hit at all the rich, e-commerce company like Jack Ma, for example, Alibaba, the point here is that they want to do a regulatory crackdown. And the market disliked uncertainty, and therefore the market actually fell. And last year, 2022 was because of COVID lockdown. Okay, now what we have right now is that it's the end of COVID. They have declared lifting of zero COVID policy. And what happens also is that in terms of Jack Ma, I think over the weekend you have read the news is that they have actually allowed Ant Financial to be listing soon. So meaning that they also going forward are going to be more pro-business. So all this concern about all this regulatory crackdown, common prosperity, the 2021 story. 2022 was a COVID lockdown that hurt the market. is also over. And if you look at the valuation right now, we believe that it's actually a good opportunity to invest in China over the next 1-2 years. But however, there are other issues as well. In the interest of time, just let me skip this, is that the key word going to this MPC meeting, which just was 2 months ago, was that it's actually going to be scientific revolution, technology innovation. That will be the key word over the next 1 year, for China. Okay, a few issues that you all need to consider. I'm not going to teach you geography here, but I just want to highlight certain facts so that you want to understand what is actually happening in China. A Taiwan issue is a very sensitive issue to China. If you want to do business with China, you have to recognize the one China policy. So meaning that you should not have official dealing with Taiwan. If you do that, then the Chinese government will be very unhappy because you are supposed to recognize the one China policy. What I highlighted on this chart here is that you probably also read is that China is getting very aggressive in its naval power. I just want to show you this chart because you have to understand from here is that this is what we term as China naval perspective. In order to ensure national security of your country. I mean, we don't talk about Singapore. Singapore is so small. We're talking about a big country. As a superpower, you don't want war to happen in your country. Then you look inward. You have Russia on the north. You have Mongolia. You have Kazakhstan on the east. On the west, sorry. These countries are basically friendly countries to China. So what will happen here is that if you look at the issue here is that if there's any war that's likely to happen, it's actually going to be via the sea. And China will have to secure, what we term as the first island chain. So you need a bit of reading up to do, which I've done over the past 1 year. But the point here is that you have to understand why China is doing or conducting all this military exercise. The Western narrative will tell you that China wants to attack other countries. But we know that Chinese or China in general, they do not have the habit of conquering other countries. And therefore, what they are trying to do is to ensure that there is a first line of defense, which is what we term in here as the first island chain. But unfortunately, Taiwan is in the middle of this first island chain. And therefore, ultimately, Xi Jinping would like to ensure the security and take over, or what we term as a peaceful unification of Taiwan. And therefore, you can, my basically belief is that over the next 2-3 years, nothing will happen to Taiwan. Business will be as usual. But unless there's a declaration of independence by the pro-separatists in Taiwan, then there will be potential for military conflict. Otherwise, nothing will happen. Sorry, in the interest of time, I just want to highlight here is that unlike in other, we have actually monitored this very closely in the sense that, China now is not the China 10 years ago. China has military weapons. And when we look at some of the military weapons, it's actually considered very advanced, and in some instances, even more advanced than the US. So we talk about hypersonic missiles, for example. By the way, Russia also used some of those during the Ukraine war. But the point here, I want to highlight here is that, there's only 2 countries that hypersonic missile. Hypersonic missile, what it means, for the audience, for the purpose of audience, is that they are so fast, they move at 5 times the speed of sound, that there will be no interception. So what it means is that US aircraft carrier cannot go close to China because it will just be wiped out by these hypersonic missiles, because normal missiles or anti-missiles cannot reflect all these, what we term as high-tech weapons. And you look at some of the aircraft, all these are due to a lot of advanced, I would say, expenditure. You look at, for those who are very interested in aircraft, J-20 is a 5th generation aircraft fighter. So again, just for information, is that, it's not that US is now the leading, US is still the strongest in terms of military, but what I'm trying to say is that if you want to fight on the home ground of China, and China is only for defensive purpose, the point is that US might not be able to win. Okay, we also talk about US-China tech war. This is something that really happened over the past, I would say, past 4 or 5 months. The key here is that, no doubt, US is very strong in technology, especially on the software portion, software aspect. But the key here is that, the market, a lot of Chinese consumers are buying all these chips. If you prevent chips from selling to China, what it means is that US corporates will also be affected. So it's not like, US can do anything and there's no impact on the US corporates itself. Okay, I just want to highlight here is that, unfortunately, we don't have much time, but the point here is that we don't really, for the last 3 years, we have not been to China. But I just want to highlight that China has been actually doing what we term as driverless, travel. They have operated a driverless taxi service in China, already started. So it's some development there, and this is because there is, they have 5G, in the system and proceeding to 6G. And on top of that is that, again, if China is technology is so backward, then they would not have achieved what we term as certain milestone. So the China space station will be the only space station in space when ISS is decommissioned. So, if they are low tech, then they wouldn't have all this. And not only US have the GPS, China has the Beidou navigation system to help, commercial use or military use in terms of navigation systems. So I would say that these are basically technology advances that China has made. Again, here, in the interest of time, is that the point is that if you buy the story of green energy, moving to green energy, China is an integral part of this, because, for example, in terms of EV batteries, China basically dominates the market. In terms of EV cars, China at least have half the market share. So, not only than that, China has what we term as rare earth. So we are not talking about basic things like metal, steel, or whatever, copper. We're talking about rare earth. China is the biggest producer of rare earth in the world. Unfortunately, the key here is that China is the largest, in terms of export. It's the second largest in terms of economy, but they are the largest in terms of export. They also have the largest what we term as middle income consumer market. Just an example for how many cars are sold in US a year. The number is between 16 to 17 million. But China commercial vehicle sales is at 26 million. So what I'm trying to say is that Chinese consumer market is very big. And if you look at the news flow, is that China, in terms of its Belt and Road Initiative, are pretty strong. So every country wants to befriend China because they can build high-speed rail. Just look at Indonesia, our near neighbor. They built from Jakarta to Bandung. And that's not the end. They want to build all the way from Bandung to Surabaya. And they need China, you know. And not only that, here is that in terms of 5G, 6G, EVs, you know, autonomous driving, AI, I think China is in the lead, you know. So all in all, I just want to highlight to everyone is that don't be too negative on China. China has the talent. The third year, this year, the third term will be very important. What Xi Jinping has to do is basically manage political influence. And as you see, the fourth point, they have really lifted the zero COVID policy. And we look at valuation right now, it's actually turning more attractive. But there will be always some noises about US-China relations. But that aside, looking at the valuation, we believe it's actually a very good opportunity, a good time to look at this market again. Thank you very much. If there's any questions, you can always come up to the UOB AM booth. I can share with you what my investment insights are. Thank you very much.
Thank you very much, Colin. All right, that was very good indeed, because if you've been here since the morning, you will realize that we have been talking about China in a certain aspect, but here's an alternative view shared with you by UOB AM Colin Ng. Want to find out more? Head on to the booth and you can do so. But with that said, right now we have someone who's going to be coming up, and it's very exciting because we will be talking about Welcome Back Japan. With that said, we want to welcome right here today the Head of Intermediary Business Development from Nikko Asset Management. Ladies and gentlemen, put your hands together and let's welcome Darius Fu.
Right, thank you so much. It's great to be here with everyone. How many of you, can I just have a show of hands, during this holiday period, you've actually gone to Japan? Anyone? Nobody? Wow, thank you for a couple of you. So, ladies and gentlemen, first I just thank you. I saw that running out from the back. I know that, for most people, we know in Japan, where's the best place to eat sushi, ramen, shopping, etc., etc. But when it comes to investing in Japan, most of us will be grossly underweight in our portfolio. So today, though, I want to give you a bit of a breather. I'm not going to be the one doing the presentation. In fact, I'm going to hand the time over to my investment director, who is Junichi Takayama. He's going to be coming to us on video. So he will do the presentation, convince you of the story of Japan. And in the meantime, if you have any questions, we will be over at our Nikko AM booth, ready to ask questions, take questions from you as well. So with that, I'm going to roll it over to Junichi Takayama-san.
Hello, everyone. My name is Junichi Takayama, Investment Director for Japan Equity, based here in Tokyo. So today I'd like to talk about why we think Japanese market offers attractive opportunities in 2023. So first of all, I'd like to show you this chart here on page 2, the left-hand side. Over the past decades, Japanese companies have aggressively invested abroad in an effort to capture global growth, and the trend accelerated in the past 10 years. Japan's foreign direct investments have grown to 28 trillion yen, or about $200 billion in 2019, prior to COVID crisis, quadrupling from 2009. However, recently, Japanese companies are becoming more cautious of the geopolitical risks after seeing the war in Ukraine and the pandemic-related disruptions in their global operations that have been built out over the past decades. Offshoring for low-cost production of goods has been the key driver of globalization, but the trend will inevitably be shifted more towards reshoring, nearshoring, and friendshoring to avoid any disruptions in the supply chain. The increasing focus by companies to engage in ESG and human rights due diligence will also be a factor that drives companies to reorganize their supply chains to bring manufacturing and procurement closer to home. And it's certainly not going to be the beginning of the end of globalization, but companies have started to optimize their supply chains with a new set of constraints that emerged over the past years, most notably public health, geopolitical risks, and ESG. Right-hand side, we can see some of the major Japanese companies that made decisions last year to diversify manufacturing and to invest more in Japan. And we expect Made in Japan to gain momentum more broadly in various sectors in the new year. And this will certainly have a trickle-down effect, and we expect this to have a positive impact on the overall economy. Now, from an investment perspective, on the next slide, I'd like to show you valuation for Japanese companies. We can see here that on the left-hand side, that Japan is not only undervalued against the US, but also relative to its own history. Price to earnings ratio is just over 12 times and is closer to, is close to the bottom of the trading range over the past several years. So we think that the downside is quite limited and there's a lot of upside risk from here. And on the right-hand side, we can see that we have half of the companies, or about 30% in terms of market cap in the prime market, trading below book value, which is the liquidation value. So it's clearly an oversold market at the moment with a lot of opportunities. And in terms of economic growth, I'd like to show you the outlook put out by OECD. This is the economic outlook released by OECD last September. Japan is expected to be resilient, outgrowing the US and Eurozone as the delayed reopening effect kicks in a bit later than other markets. And the level of inflation is not as high, contributing to relatively higher consumer confidence. And unlike the US, Japan's GDP hasn't fully recovered to the trend line, given the social restrictions and the closed borders we had last year. So the delayed recovery makes it all attractive. In Japan, we have significant amount of cash in excess savings in the household segment because of COVID over the past few years, which is estimated to be over 50 trillion yen, or about 15% of annual consumption. And there's a lot of pent-up demand as well. So we think Japan is relatively, more resilient and is better positioned than other developed markets. And there's one other factor that's going to give an immediate boost to the economy, but it's not reflected in this OECD outlook. And that is the expected recovery in inbound tourism. Japan had been quite conservative in dealing with COVID over the past 3 years, which is a reflection of the culture and the social norm that puts emphasis on social stability and avoiding uncertainty. Social restrictions were lifted in March last year, but international travels were restricted to control the pandemic until later in the year. And we think that the other reason why Japan was conservative was for political reasons. Japan held an upper house election in July, and as in other countries, senior citizens have high turnouts at the elections, and they're also the most sensitive to public health policies. So the government probably didn't want to take any risk ahead of the election. But with the election behind us, the government is now free from national elections for the next 3 years. And given that COVID cases came down after the summer, the time was ripe to make the change in border make the change to the border restrictions. And in fact, as shown on the left-hand side, the Nikkei survey conducted in September, 63% of respondents approved of the measure to relax border control. And the table on the right-hand side shows the actual change in border control measures. Effective October 11th, we no longer have any caps in the number of visitors. COVID tests are no longer required at the immigration. So this is expected to boost the number of tourists as well as tourist spending. So the question becomes, how likely and how big is the recovery in inbound tourism? And what's the impact on the economy? And we think that it's only a matter of time that inbound tourism will recover and eventually surpass the pre-COVID level. The left bar chart shows the number of international tourist arrivals through September by country, and this is sorted by the number. And Japan comes only after Thailand and is down 96% versus the pre-COVID level in 2019. And the world tourists are recovering, as you can see on the left-hand side at the very bottom, only down 37%, whereas Japan is coming off a low base and is likely to see a huge rebound in the number of tourists this year. And the table on the right-hand side shows the latest ranking of tourism index released by the World Economic Forum in May last year. And Japan tops the ranking and is clearly a popular destination among international tourists. And combine this with the weaker Japanese yen. Yen has depreciated by about 25% since pre-COVID, and so it's all the more attractive for foreign visitors. So the bottom line here is number of tourists are down 96%, but Japan remains a popular destination and it's cheap. So in fact, it's at the cheapest level in decades in real terms. And from an economic standpoint, the amount spent by inbound tourists was 4.8 trillion yen in 2019, which accounts for about 0.9% of GDP. So this is quite significant. And in terms of the macroeconomic situation in Japan, it'll be increasingly important to monitor the cumulative effect of higher inflation in 2023. In the US and Europe, the surging inflation is considered to be a threat to the economy, and the central banks are focused on deflating aggregate demand in an effort to combat the decades high inflation before it goes out of control. But on the other hand, as a country that suffered from the so-called lost decade and the deflationary period in the early 2000s, inflation may not be all that bad for Japan. And this is because inflation has the potential to break the vicious cycle of disinflation and low wages, which is essentially a chicken and egg problem. And it's widely believed that inflation by nature is driven by self-fulfilling prophecy, and therefore inflation expectation needs to be raised for the actual inflation to move up. In order for inflation expectation to be positive, ideally close to 2%, there will have to be an exogenous shock that becomes a catalyst, and the recent rise in import prices may have been what we needed. And while we do need to make a distinction between certain purchasing items with rising prices driven by higher commodity prices and those that are seeing chronic deflation, at an aggregate level, we are seeing the inflation rate pick up as you can see, and the latest reading was 3.7%. And while the inflation rate itself is lower than in the US and Europe, the good news may be that we're actually finally starting to see signs of inflation expectation picking up in Japan in line with actual inflation. We found some interesting results in a survey conducted by University of Tokyo professor Tsutomu Watanabe. People appear to have become more resilient to an increase in the price level. This is a household survey conducted at 2 different points in time. And among all the questions, one of the questions asked was, what would you do if the price of a product that you always buy at a supermarket rises by 10%? Japanese consumers had historically been quite sensitive to prices, and as you can see in the August 2021 survey on the left-hand side, higher percentage of Japanese consumers answered that they would go somewhere else if they find higher prices for certain staple products at a supermarket. 57% of respondents said they would switch to a different supermarket. But what happened was that in the April 2022 survey on the right-hand side, this percentage dropped significantly to 44%. And on the other hand, 56% answered that they would stick to the same store despite the price hike. And this is quite a remarkable change in the consumer attitude. And we think this change in inflation expectation has the potential to end the broad-based deflationary mindset, which could lead to a virtuous cycle in the economy. In Japan, every year in spring, we have what we call shunto, or the spring wage offensive, where management teams and labor unions sit down to negotiate wages for the coming fiscal year. Corporate earnings have been solid, and the outlook is quite positive as indicated by earnings guidance, and increasing amount of share buybacks, which signals the management team's confidence. And so there's an increasing amount of pressure on companies to raise wages now that inflation and expected inflation have finally started to move up in Japan. And Prime Minister Kishida is calling for higher wages in his new form of capitalism economic agenda, and considers wage hikes to be critical in creating a virtuous cycle of growth and distribution. Labor unions are also becoming aggressive in calling for higher wages. Rengo, which is the largest national trade union center in Japan, is calling for a 5% wage hike in order to cover the recent rise in the price level ahead of Shunto. And higher wages will clearly be positive for consumption, as households have a lot of pent-up demand. And this would also have implications for monetary policy in Japan. Wage hikes could pave the way for the BOJ, Bank of Japan, to pivot following the change in governor in April. And just to remind you, the current governor, Kuroda, his term ends in April. So we'll have a new governor in a couple of months. So there will be many news flows on the spring wage negotiations, and we need to carefully monitor the situation and see how it goes. And any change or signs of a change in monetary policy could have a significant impact on the currency, as we just saw after Bank of Japan tweaked its policy in December. Next slide, please. As you know, Japanese yen has depreciated significantly over the past 12 months. This chart here shows MSCI World Index against Japanese Broad Market Index. the TOPIX index in both US dollar terms and Japanese yen terms. And the light blue is the TOPIX index in Japanese yen terms and is keeping pace with the world equity index. However, for the US dollar-based investors, the currency loss outweighed any gains in the stock market itself, leading to a negative return in the past 2 years. As we saw on one of my earlier slides, Japanese market is undervalued, and if the currency is going to be either stable or to reverse course, we expect this will be a catalyst for US dollar-based investors to reconsider getting back into the Japanese market. And we're actually starting to see foreign investors coming back into the market in the fourth quarter of last year. And in the US, we expect the Fed to continue to slow down the pace of its monetary tightening this year. So narrowing of the interest rate differential between the US and Japan on the back of the Fed becoming less hawkish, Bank of Japan becoming less dovish will likely result in reversal in the currency movement, meaning stronger yen, which would be positive for dollar-based investors as currency gains can be expected to be on the top of capital gains. And given that foreign investors dominate the trading in the Tokyo market, we expect it'll be positive for the overall market. And again, here we can see how the Japanese yen had the worst performance among all major currencies in 2022. And on the right-hand side, we can see that the yen is overshooting now. The dark blue line is the level of purchasing power parity as estimated by OECD, implying that the current level of the yen is significantly undervalued relative to its theoretical value. As of the end of November, the discount was about 27%. So the bottom line here is that it's not just the overall equity market that's undervalued, but also the currency is undervalued, which means that we have an opportunity to profit from both capital market appreciation and the gains on the currency. And finally, I wanted to touch briefly on the corporate governance situation, where we stand on the corporate governance reform. Since Japan first introduced the Stewardship Code and Corporate Governance Code in 2014 and 2015, there's been a lot of changes made at companies. There have been more independent directors being adopted, and capital efficiency targets such as ROE or ROIC have been introduced at many companies. And returns to shareholders, including dividends and buybacks, have also grown significantly and with higher transparency. And outside of companies, there's been a significant growth in the number of activist investors entering the Japanese market. They pressure companies to, unlock and create shareholders' value. But the ongoing unwinding of cross-shareholdings by the companies and the increasing pressure by traditional institutional shareholders from, stricter proxy voting guidelines make the market more attractive for activist investors, because value is expected to be unlocked by leveraging the support from traditional institutional shareholders. And last year in September, Prime Minister Kishida gave a speech at the New York Stock Exchange and made it clear that corporate governance reform is front and center and will be accelerated going forward. And he talked about establishing a forum to hear from global investors on corporate governance issues. And following his speech, the Financial Services Agency has held talks with the Asian Corporate Governance Association, as well as the International Corporate Governance Network. And the third meeting is to be scheduled with a group of US-based investors in the new year. And we believe that these discussions will continue to be reflected in future policies and guidelines which will contribute to unlocking and creating value in the new year and beyond. This concludes my presentation. Thank you very much.
All right, thank you, Junichi Takayama-san. So, ladies and gentlemen, I hope that gives you a very good insight and overview in terms of the Japan market. Lastly, just to summarize, there are values to be found within the Japan market. There are many reasons to support the market, and if you'd like to find out a little bit more, once again, we are at the very, very first booth near the entrance. Come and look for us. My name is Darius. Enjoy the rest of the Saturday afternoon. Thank you very much.
All right, so having said all that, it is interesting to see that, as we mentioned previously in the morning about how you can invest in the Japanese markets, you can definitely check out Nikko AM's site and the booth all the way to the front over there to find out more about what kind of funds and what kind of investment strategies are available for all of you. Now, with that, we would like to have our very next segment of our speaker, and the topic is going to be about 3 reasons to remain cautious on the US dollar, and another warning on cryptocurrencies. Ladies and gentlemen, coming all the way from IFAS Singapore, we are research analyst, research and portfolio management, Cyrus Ng, everybody.
Hi, thank you very much. Good afternoon to everyone. Today, in this currency segment, we'll discuss our views on 2 currencies. So first, we'll look at the US dollar. Now, the US dollar was one of the top performing currencies in 2022. But as we mentioned, we'll look at 3 reasons to remain cautious on the US dollar moving ahead into 2023. Then we'll look at cryptocurrencies. Now, cryptocurrencies were one of the worst performers in 2022. And today, we will reiterate why we think investors should stay far, and very far away from cryptocurrencies. Let's start off with the US dollar. Now, the 2022 was a great year for the US dollar. It was a standout year. Its 8% climb in 2022 was one of its strongest in recent history. It's been surpassed by previously in 2014 and 2015, and before that in 2005. So this was driven mainly by 2 things. First, widening rate and yield differentials, and second, safe haven flows, both of which I'll talk about later. So one thing to note, if we look at the USD's performance through the DXY index, the US dollar index, we can see that historical up cycles for the US dollar have lasted about 6 to 7 years on average. Currently, we are at 11 years and counting. So, because of this extended period of USD appreciation over the past 11 years or so, the USD now looks very overvalued. So what we did is we looked at the US dollar's real effective exchange rate, or REER, and this measures a currency against a basket of other currencies adjusted for inflation. So what we find is that this REER currently sits at very extreme levels. These levels have only been reached twice in history. First, in 1972, when the US was still on the gold standard. Second, in the 1980s, and that's where the Fed did an unprecedented rate hike to 20%. And we think that the current economic backdrop is far from reaching such extremes at the moment. For confirmation, we look at another metric. We look at the purchasing power parity, or PPP, of the US dollar. So this compares the purchasing power of different currencies benchmarked to a specific basket of goods. And what we find is that this PPP metric suggests that the US dollar is overvalued against all but one currency, with a whopping 30%, for instance, against the Japanese yen. And hence, we believe that this overvaluation of the US dollar through RER, through PPP, sets up for a potential reversal of US dollar strength. And we think that currently, with heavy long positioning in the US dollar, this hints that the reversal could come even sooner than you might expect. So across 2022, investors have bet on a strong greenback. They have bought the US dollar, gone into the US dollar. And long positioning, as a percentage of total positioning, remains stretched at the moment, as you can see on the chart. And what this means is that conditions are ripe for a correction once we see the emergence of negative catalysts that could drive traders to cut back on their long positioning. And one important negative catalyst that could drive this reversal is narrowing rate and yield differentials. So historically speaking, rising rates have led to increasing real yield differentials. And then rising real yield differentials have in turn led to more people buying the US dollar because of the better yields on offer. So it's unsurprising that if we look at across history, we see a strong positive correlation between real yield differentials as well as US dollar strength. Correlation plus 0.82. And 2022 itself was not an exception. So what we saw in 2022 was the Fed hiking rates more aggressively than other DM central banks. And this has in turn led to real government bond yields in the US rising ahead of many of its DM counterparts. And this again has in turn led to the USD appreciating against many of its peers through the DXY index. But looking ahead, what do we think? So looking ahead, we think that rates and real yield differentials are set to narrow, which should lead to this key USD driver of 2022 fading away and reversing in 2023. So on one hand, we expect the Fed to pause its rate hike cycle in early this year at about 5%, 5.25%. But on the other hand, what we see is that other DM central banks have a lot of room to catch up. And that's in terms of rate hikes. And this is because inflation readings, as you can see from the chart, are much higher in the rest of DMs as compared to the US. So two markets we want to highlight here are UK and Europe. So sterling, pound, and euro. And first we include them because they have a large composition in the DXY index of over 60%. And we note that these two markets are actually facing very strong inflationary pressures right now in the US, currently facing double-digit inflation compared to the US 5-6%. But despite this, their central banks, ECB in Europe, BOE in UK, have not hiked rates as early, have not hiked rates as aggressively as the US so far. And we think that a lot of DMs, including especially UK and Europe, have a lot of room to out-hawk the Fed in 2023. So let's move on to the third reason. So we saw that in 2022, a key driver for the US dollar was safe haven flows. But we believe that as we head into the new year, the US dollar's safe haven appeal may falter in 2023. So first, we acknowledge the possibility of a mild recession. So this could lead to an easing of safe haven flows. So previously, in a few slides ago, we saw that positioning in the US dollar was already very long. And this was because a lot of traders moved in the US dollar in anticipation of a recession already. But initial signs in the US are pointing to something mild. So if you look at household liquid assets and debt service ratio as a percentage of disposable income, you can see that household balance sheets are actually still looking quite robust for now. And we think that this suggests with a mild inflation coming up in the US, investors might already be pricing in somewhat of a recession. We might not get that much of an increase in safe haven flows from today compared to what people are already expecting. But even in a more severe recession, we think there's a risk that other safe haven currencies may emerge and take the place of the US as the safe haven FX of choice. So for example, we have listed the Japanese yen and the Swiss franc over here, both of which are traditional safe haven currencies. So we want to highlight the Japanese yen in particular, given its poor performance last year. So last year, the Japanese yen performed very poorly. And this was due to widening real yield differentials. As you can see from the chart, US yields have climbed up, Japanese yields have remained relatively flat. This was because the BOJ engaged in its ultra-loose monetary policies, kept this ultra-loose monetary policy intact. And in contrast, the Fed turned more hawkish throughout 2022. But in December last year, what we saw was the BOJ's surprise widening of its yield curve control band. And we think that this is a sign that they are warming up to further tightenings in 2023. So this should in turn help to push up Japanese yields, which then makes the Japanese yen probably more attractive as a safe haven currency in 2023 compared to the US dollar. So with all that being said, I think we can see that there are many factors that affect the demand of safe haven flows. So it includes the severity of incoming recession affecting broader safe haven flows. It includes idiosyncratic factors affecting which safe haven currency investors will pick. And with these many variables, it is unsurprising that the US dollar has displayed mixed performances during previous recessions. So what we did is we narrowed down the 8 previous recessions in the US defined by the National Bureau of Economic Research, NBER. And we found that the USD actually depreciated in 4 of these 8 recessions. And this is honestly not a very convincing record if you're looking for a foolproof safe haven. So if we look at market volatility instead of economic volatility, we get the same result. So for this, we use the VIX index, which is a gauge of US market volatility. So normally, we would expect a safe haven to have a positive correlation with the VIX index. This is because if volatility goes up, then theoretically, a safe haven demand should also go up. But we don't see it in this case. We can see it oscillates between positive, negative, and if we just do a simple average of the correlation throughout the years, we get a very tiny plus 0.05. Furthermore, what else we did? We isolated periods of high volatility. So we looked at months when the VIX peaked above 35. So why we chose 35? This is the top 5 percentile of the VIX index, so the most volatile periods. And in 7 of these instances, the correlation was actually negative in 3, about half of these instances. And this again suggests an inconsistent performance of the US dollar even during periods of heightened market volatility. So moving beyond the shorter term, medium term safe haven flows, I think I want to end off this point with one last point on long-term safe haven flows. We think we are seeing a long-term trend of de-dollarization playing out over the years. And this is observed through the decreasing share, the gradually decreasing share of the US dollar over time in international foreign reserves. And we think that this trend of de-dollarization could accelerate in the coming years due to the US's decision to weaponize the dollar against its rivals. And we think that this could dim the allure of the US dollar in the long term, especially for countries with a more tenuous relationship with the US. So let me summarize what I've said about the US dollar. So we expect a reversal of USD strength in 2023 due to 3 main reasons, namely stretch valuations, narrowing real rates and real yield differentials, and inconsistency as a safe haven. So with the USD expected to weaken in 2023, we recommend that investors evaluate their portfolios, your portfolios, for any US dollar exposure. So one way to start off is to look at your unit trust investments, which we are classifying into 2 types. So first, if you have a unit trust with exposure to US assets, for example, a US equity fund, we recommend choosing a hedged share class for this fund to neutralize out this USD exposure. And second, we recommend avoiding US dollar hedged share classes in general and look at other currencies instead. With that, let me quickly move on to cryptocurrencies. We'll look at it using a similar framework and we'll explain why we are negative on cryptocurrencies in 2023 and beyond. So first, like the US dollar, we look at valuations first. So we think that cryptos are supremely overvalued. In fact, we think that many cryptos have little, no intrinsic value to begin with, meaning that their fair price should theoretically be 0. So how we look at stocks in the first place is we usually look at them based on projected future earnings. So after all, stock prices, as you can see from the chart, have shown a very, very strong long-term correlation with earnings, plus 0.96. And this is based off 150 years of S&P 500 data. And this is why PE ratio is actually one of the most commonly used metrics in finance because of the strong importance of earnings in determining price. But what about crypto? If we look at crypto, a large majority of crypto have no earnings, no cash flows to speak of. I'll say most crypto is essentially an arbitrary coin or concept conjured up from nothing. So again, no earnings, no cash flows, nada. And that means no matter what PE ratio, price to earnings ratio we apply to it, if your projected earnings of this crypto is zero, then your fair price is essentially zero. So another way to look at asset is to look at underlying assets. So some of you might look at price to book ratio. But again, many cryptos are actually magically created out of thin air, very little underlying assets backing them. So we look specifically at stable coins. So these stable coins theoretically should be 100% backed by 100% backed by underlying assets. But they have seen many scandals over the years over their lack of reserves. So this is USD Tether. This is one of the biggest stable coins right now, even now. And it only has 82% of its assets backed by cash and cash equivalents, as you can see from the chart. Remaining 18% is in less liquid and potentially more risky products. There's very little transparency on this breakdown of 82% cash and cash equivalents, even less transparency on the 18% risky side. And if we get periods of market stress like we saw last year, we cannot rule out the possibility of insufficient reserves, bank run, especially if these reserves turn out to be lower quality than expected. So what this means for you as an investor is that most cryptos not only have no earnings or cash flows behind them, but they also not backed by a sufficient amount of underlying assets. Then the question is, what are you investing in for crypto? I think we've said it for multiple years now. We said it at last year's Expo, and we'll say it again. Crypto is essentially a greater fool asset class. There's no intrinsic value, and what is reliant on is people generating hype, hoping that they can sell their crypto off to a greater fool. So many financial professionals have emphasized this point. So here are Berkshire CEO Warren Buffett, ECB President Christine Lagarde, JP Morgan CEO Jerry Dimon, and they've all said the similar things. Most of the time in the crypto space, you're investing in something with no intrinsic value, and we recommend that investors stay far, far, far away from this asset class. Okay, let's move on from valuations to yield attractiveness. So we previously talked about narrowing yield differentials for US dollar, how it might lead to some USD weakness in 2023. Let's look at the same for crypto. So if you search online, you'll find cryptos claiming to offer very high yields. So I went online this morning, and I found that some cryptos claim to provide 1 million% annualized. But here's a warning. If you invest in these cryptos, I'm very sure that you'll lose all of your money. Just look at Terra USD, one of the largest stable coins previously. Promised just a 20% return on your UST deposits. And in May, what happened? It just unraveled suddenly, within a few days. From a price of $1, you're looking at about 2 cents today. Now, whether it collapsed because it was flawed, or because it was a fraud, I think as an investor, what matters to you is that any types of yields that come with these type of cryptocurrencies come with insurmountable levels of risk. And we do not recommend this for any investors looking to make money in the long run. Finally, let's look at defensiveness. So one thing we said about US dollar was that it's an inconsistent safe haven, but what about crypto? Well, the bad news is crypto is as unsafe as it gets. So this is notwithstanding the many scams we have seen in the crypto space. This is notwithstanding the contagion effect that we saw in crypto last year with collapse of companies like Three Arrows Capital. Purely looking at a simple metric like 12-month or 1-year rolling volatility, crypto is one of the riskiest asset classes available to investors by a huge margin. And we will argue that it is the exact opposite of a safe haven. In fact, if you look at Bitcoin specifically, Bitcoin has pretty much performed like a volatile tech stock in 2022. And we've seen how these have performed in a rising rates environment. But even worse, Bitcoin doesn't have any fundamentals backing it at all. So what you're essentially buying is, you're buying all this downside volatility with very little fundamentals supporting any upside at all. So let us summarize today's presentation. So for the US dollar, we think it's increasingly unattractive, again due to a combination of 3 things: high valuations, narrowing yield advantages, as well as inconsistency as safe haven. 3 things. For crypto, it's different. We think that its valuations are absolutely ridiculous due to their negligible intrinsic value. And in fact, many of the higher yielding ones are outright scams. it is also one of the riskiest asset classes on a historical basis. And it's the exact opposite of the defensiveness you need in your portfolio with a recession coming up. So this leads to different conclusions on the USD and cryptos as a whole. So for the USD, again, we recommend you hedge your USD exposure where possible. For example, for your US equity fund holdings, consider a hedge share class. But for cryptos, it's very different. For cryptos, we recommend you to not speculate in cryptos at all. Stay very far away from it. Just don't touch it at all. And with that, I'd like to wish you all a happy, fulfilling, and prosperous investing journey in 2023. Thank you very much.
Thank you very much, Cyrus. All right, so that was definitely a perspective for all of us to take on to be able to see how we can really invest towards our 2023 markets and beyond. Together with rising inflation, and you have the different kinds of maybe recession coming up or probably coming up. This is where you can really have opportunities as well. So it's not all down and dire, but there are things to be cautious about. And with that, you will be able to invest smartly and better. Of course, if you'd like to speak to any of our other asset management people and to be able to find out about the different funds, please feel free to take the move to go to the different booths as we're here all the way till 6 p.m. Now, we have one last segment up for you, and it's going to be the very much coveted question and answer segment. So throughout the day, as you can see on your event flyer, there is a QR code for you to be able to scan it and write your questions in so that our panelists will be able to discuss it with you live. On top of that, beyond this segment, we will have our Grand Lucky Draw. So the Grand Lucky Draw, as a reminder, do make sure that you've already placed your ticket stubs into the box at the FSM booth all the way to the back. So once again, please make sure that you have already placed your ticket stubs to the FSM booth all the way to the back over there. With that, we would like to go on to our question and answer segment. And the main question is, what's changed and what's next? Ladies and gentlemen, let's welcome Yo Wei Ren, CFA, our Senior Portfolio Manager, Research and Portfolio Management, IFAS Singapore, followed by Tan Der Jin, CFA, Assistant Manager, Research and Portfolio Management, IFAS Singapore, Lim Teng Chong, Senior Research Analyst, Global Fixed Income, IFAS Singapore. And of course, for the moderator for today, we have Manager, Investment Advisory, FSM1.com Singapore, Catherine Chua. Ladies and gentlemen, put your hands together for our panelists.
Hi, thank you everyone for staying for all the way to the end of the event for this highly anticipated Q&A. Sorry. Okay, sorry about that. Yeah, so based on all the questions that we have received online, I think one of the highest voted question was asking about the recommendation on REITs last year, and because currently I do believe investors who are holding on to REITs, especially S-REITs, you're looking at quite substantial losses in your portfolio. So the question is, what should we take? How should we take this, and what is the view discussed today?
I think just to give everyone a bit of a context, I think last year, if you were here for our FSM Expo, we did express a somewhat positive view on S-REITs. I think our general message to investors was that I think S-REITs, it's good to be selective. It's good to focus on the fundamentals. But that was before the federal rate hikes that we have seen throughout 2022. So in the middle of the year, we have actually turned bearish on S-REITs. And right now, have we changed our view on S-REITs? I think that's no. I think we are still relatively bearish on S-REITs. Simply because of the fact that there are now better alternatives in the investment space. Bond yields especially, they have shot up a lot in 2022, offering yields of about 3 to 4%. S-REITs in the past, giving distribution yields of about 5 to 6%, but that was at a time when interest rates was very low, at about less than 1% or maybe even 2%. But now with interest rates picking up, with bond yields now giving investors very decent, very attractive returns, I think the fact that there is now an alternative in the fixed income space, it now makes the S-REIT space a lot less attractive. So the distribution yield for S-REITs, I think that's about like 6%. In a low interest rate environment, I would say this is an attractive yield to have. But with bond yields now at 3 to 4%, I think this is still relatively unattractive. So at what level would we consider S-REITs to be attractive? I think you probably may have to wait for yields to adjust upwards to about 7 to 8%. I think that would be perhaps a level that I will consider S-REITs to be attractive.
Okay, thank you so much for the question about the S-REIT. So I hope investors know our view on S-REITs and what should you do next. So leading up to this question, there's another question that's asking about US recession, like how would it affect us in Singapore? So probably I'll ask Wei Ren and Dejin.
Yeah, I think the question is on whether US recession will affect Singapore, right? I think that's a yes. Because Singapore, ultimately, we are an open economy, so we are very susceptible to external shocks. So if, let's say, US goes into a recession in 2023, then it is very likely that economic activity in Singapore will slow down as well. So we are not immune to a global growth slowdown because we are an open economy. Same thing for interest rates. If the Fed continues to hike its interest rates, then this will have an implication on the interest rate environment in Singapore as well. So we are very dependent on external events. But having said that, I think there are also reasons to be optimistic for the Singapore economy. I think even though generally growth is going to slow down, I think it will at least be a bit more resilient as compared to some of our neighbors, simply because of the fact that Singapore, we are starting to overtake Hong Kong as Asia's financial center because of what is happening over in Hong Kong. So a lot of businesses, they are relooking their business exposure within Hong Kong. So a lot of them are starting to relocate their headquarters over to Singapore. Over in China, because of the common prosperity drive, a lot of rich Chinese people, they are all relocating their assets to Singapore as well. So we are starting to see family offices being set up in Singapore. So our financials industry will have that additional boost from all these trends that have been taking place outside. And on top of that, I think, when you talk about China reopening, they're opening their borders, so tourists are starting to look for places to travel. But at a time when a lot of countries are thinking about implementing bans on tourist arrivals from China. So far, Singapore, we have opted not to. So we will also have a bit of a boost in terms of our services sector from tourist arrivals from China. So a couple of factors that will help soften the blow, but I guess the general direction for Singapore's economy in 2023 is that of a slowdown, albeit quite a resilient one.
Well, I also agree with what Wei Ren said. I think Singapore being a very open and trade-reliant economy, we will definitely be affected if other major economies such as the US go into recession. So if I recall correctly, net exports as a percentage of GDP, it is around 30+% for Singapore. Hence, it's quite a significant exposure. So the similar argument also can be extended to other more trade-oriented markets such as South Korea and Taiwan, for instance. And I think Wei Ren also brought up a very good point about how Singapore's market is relatively more resilient. So just to put some context into it, you can see that over the past year, I believe that Singapore was actually one of the better performing markets, having much less decline in share prices compared to other markets like the US, Europe, or even China, for instance. And that is, I would say, one of the strengths of Singapore's market, being resilient in a downturn.
Thank you so much for your reply. So there's actually another question also related to the declining of the equity prices in the market. And one of the investors asking specifically about US and also the investment outlook on our semicon as well as the tech industry. Whether should we cut loss or buy the dip? I do believe this is one of a very huge awaited question, especially if clients here have actually invested in these kind of FANG stocks during the pandemic period of time. So I'm looking forward to hear all your answers about this.
Right, so with regards to whether or not to cut losses or buy the dip, when it comes to your investments? I think this is a very specific question. So I think it very much depends on what you're investing in. So if you think that the market or the sector that you're investing in, the fundamentals, they have changed substantially and they are not likely to give you the same type of returns as it did maybe 5 years ago, then I think perhaps it's time to consider cutting losses. However, if it is like a temporary dip and you think that things will eventually recover and the long-term growth story of that particular market or sector still remains intact, then I think you should make use of this opportunity to buy the dip. So with regards to the US, I think right now for the US, even though valuations have fallen quite a bit, I don't think they're exactly extremely cheap like what we have seen in the past. So if you're looking to invest in the US, what I would suggest is you consider value stocks rather than growth stocks. So yeah, in a rising interest rate environment, value stocks, they tend to outperform their growth counterparts. And with regards to semicons, so semicons is a very interesting sector. I think the long-term growth story of semiconductors, it has always been there. I think the argument is very simple. As the world we live in becomes increasingly digitalized, increasingly tech-driven, the need for semiconductors, it will certainly be there. And US semicon companies right now, they are amongst the best in the world. They are the world-class semiconductor companies. No other country or other markets have semiconductor companies that are comparable like to the scale of the US. So I think with regards to semicons, even though the consensus is we are going into an economic downturn and likely consumer demand for electronics and other products will be low, I think that this is only a phase and that semiconductors, they will eventually recover to higher levels than before.
Yeah, maybe just to add on to what Jin has already shared, I think there needs to be a distinction within the tech sector because not all tech companies are made the same. So when you talk about growth companies, most of them are your tech companies. So they tend to not do well in a rising interest rate environment. And the reason for that is because most of them, a large part of them are loss-making. And a big part of their valuations is derived from earnings that are expected to be earned far out into the future. Which is why a lot of all these tech companies, most of them are loss-making. So they have suffered under the crushing weight of a rising interest rate environment. But the thing is, not all tech companies are made in the same mold because you have big tech companies, Microsoft, Apple, Facebook. So these are companies that are not loss-making at all. In fact, they are very profitable, generating a lot of cash flows. If you look at the amount of cash that the big tech stocks have, as a percentage of the S&P non-financials companies, big tech cash balances make up about 25% of the overall index. That's how much cash they have. And in a downturn, if you expect a recession to come, cash is king. You will expect these companies sitting with lots of cash to be able to make acquisitions when the rest of its competitors are staying away. That is the best time to make acquisitions. And with that cash, you can also expect to retain some of your best talent in a downturn. So I think that there needs to be a distinction. Not all tech is bad. And also in the longer term, whether interest rates go up or not, tech it's going to be relevant in the longer run. So if you are a long-term investor, I think having a bit of tech exposure, I think it's good. But in a rising interest rate environment, I think it would be better for investors to focus on the higher quality, the big tech names over in the US.
Yeah, definitely. This is very insightful. So overall, we still prefer value over growth stocks. And also for tech, we are looking at a quality, high company with good cash flow balance sheet. I hope you guys have already taken down notes on this. So moving on to the next questions. It's not really on equities, but is on fixed income. So there's one question about treasury bills, Singapore T-Bills, which I do believe everyone here had heard of it, or if not already subscribed for it. So I think somebody could be new asking like what's the differentiation between like Singapore savings bonds, Singapore government bonds and T-bills, and she's asking which one is better. And also there's a second up question leading to that is if we think equity markets are bottoming, like the oncoming recession and all, should we still buy bonds or should we go into stocks?
Yeah, so I think the similarity between both of them is they are both government treasuries, government securities. So both are issued by the Singapore government, which are relatively safer, one of the safest instruments out there for bonds. So they are AAA rated by credit agencies. So the difference between T-bills and SSBs, T-bills is mainly short tenor government bonds. So they are issued within for 6 months, or either 6 months or 1 year in tenor. Whereas for SSBs, the maximum tenor is 10 years. However, investors can have the flexibility to choose when they can redeem the bond. So they are not affected by any secondary market fluctuations in their bond price. Because let's say you want to hold the SSB for 3 years, then you can choose to redeem it on the 3rd year and still get back your principal in full. So it will not be affected by secondary market pricing. Whereas for T-bills and also SGS, when you sell it on the secondary market, it will be affected by secondary bond pricing. On top of that, SSB also have a rather unique feature, which is the step-up coupon. So every year, the SSBs will actually step up in interest payments. So compared to regular SGS or T-bills, where they give a fixed regular coupon payment, SSBs actually gave a increasing coupon payment, which overall, if you hold it for the total of 10 years, you'll see an increase in your interest total interest rates. So I guess in terms of the question of which one is better, I guess it depends on your investment horizon and also and how long do you want to hold your investments for. So if you want to hold it for a short term, definitely T-bills is much more attractive because they give, number one, higher rates for just only 6 months or 1 year. Whereas T-bills, if you want to lock in the rates for much longer, you can definitely consider SSBs as you can still have the flexibility to redeem when you want, because SSBs still provide you the choice to actually redeem redeem your principal in full. So So lastly, on the question of whether T-bills or SSBs are investment choice as we head into a recession and with the equities bottoming. I guess mainly it's like during my presentation just now. I think bonds do provide stable income during a recession, and they tend to actually perform better during a recession. So definitely, as we head into economic slowdown and a possible recession around the world, bonds do have a place in your portfolio. And definitely, I think the second part is diversification. Even though you expect equity markets to maybe bottom up and perform much better than bonds, but definitely bonds still is able to provide capital protection and provide some diversification for your portfolio. So so even if you still want to invest in equities, but I think you should still allocate a certain amount of your allocation into bonds.
I think just to add on to what Teng Chong said, I think with regards to fixed income as well as equities, I shared in my presentation earlier in the morning or so, one thing that you can look at is the relative valuations between the two asset classes. So right now, the earnings and bond yield spread is currently at about 3.2%. And that also indicates that at this point in time, equities, they are relatively less attractive compared to bonds, which is why in our house view, we favor fixed income over equities. So if you're thinking about when to invest in equities, perhaps you can pay attention to the earnings bond yield spread. And when this spread level increases back to higher levels, then you can consider allocating more capital to equities.
Yeah, I was about to just chime in with a comment that I think if you look at 2022, that really is nothing that has done well in 2022. Pretty much everything has sold off. In stock markets, all the speculative excesses have already been flushed out. Bond markets have also sold off steeply as well, which also means that valuations across both equity and fixed income markets, they are a lot cheaper compared to 1 year ago, which also means that if you have been waiting for a good time to do your investments, I think 2023 it's a good starting point for all of us because now everything is significantly cheaper compared to 1 year ago. I think we can at least take heart from the fact that at least now our expected returns in the future are probably higher because of the lower valuations.
Okay, Ken, thank you. So because of time constraint, we'll just take one last question. It's about this client asking about the Bank of Japan widening of its bond yield control curve. Is positive for yen bonds and JPY, but it's negative for Japanese equities. So how come we are still recommending Jap equities in one of our investment outlook?
Yep, I'll take this question. So I think for the yield curve control that the BOJ has implemented, I think Japan is one of those places in the world right now that is still implementing easy monetary policy. China, they have also been doing that, but the reason why China has been able to maintain that policy is because it has capital controls in place. Japan doesn't have that, which is why its easy monetary policy in 2022 has led to a very sharp decline in the Japanese yen. So when the Fed raises its interest rates, developed countries, or rather central banks across the world, most of them, they probably will have to take cue from the Fed. They all have to raise their interest rates. If not, they risk a sharp depreciation in their currency, which was what happened to Japan. So, so the fact that they have recently adjusted their yield curve policy, it also suggests that perhaps an easy monetary policy is no longer something that is sustainable. Perhaps they are looking at the start of tightening their monetary policy, moving away from the ultra-low interest rate environment that they have been in for the past few years. So there are several implications from this with rising interest rates in Japan. So I think the investor said this is actually good for bonds. No, that is actually not good for bonds because when interest rates rise, bond prices decline. So this is a negative for Japanese bonds. For the currency, it is a positive. So for 2023, if you want to bet on a currency, you can actually try betting on the Japanese yen to rebound. And as for Japanese equities, in general, it is a negative. In a rising interest rate environment, it is generally a negative thing for equities. But for Japanese equities, I think there are certain things that differentiates them from the rest of the world. Firstly, it's because Japan is in the midst of opening up to the world. I think number two, it is also one of the few markets where the companies are flushed with cash. If you look at Japanese companies, in the past, they have been discounted because they have been holding too much cash on their balance sheets. When times are good, if you don't deploy your cash, then investors will not be happy about it because you could potentially be making more acquisition to turbocharge your growth. So investors have discounted Japanese equities in the past because of the fact that they are holding too much cash on their balance sheets. But as I've said just now, heading into a recession, this cash pile that they have been holding on for the past few years, it suddenly becomes more attractive, especially against the backdrop of a slowing macroeconomic backdrop at the global level. So Japanese companies, balance sheets, they are flush with cash. Fundamentals are strong. And last but not least, I think there's the yen factor. So it doesn't matter what Japanese assets that you invest in 2023, if you have exposure to yen, you will get that additional return from a potential appreciation in the Japanese yen as well. So I think all things considered, I think, yeah, in a rising interest rate environment, it's generally bad for equities, but for Japanese equities in particular, especially when compared to your other alternative markets, I think Japanese equities, it is probably something that you should consider for your equity exposure.
Thank you so much for all our panelists. They are very insightful perspectives. So we have drawn wrap up the time here, and I will pass the time back to Chris for the lucky draw. Yeah, thank you so much for staying behind. Yeah.
Yes, indeed. Ladies and gentlemen, let's give it up for our panelists. Wow, hope your questions are answered, and if they are not to worry, feel free to go to the different booths and talk to the different asset class managers and they'll be able to help you out. Having said all that, we're now prepared for our final and grand lucky draw. The prizes today have been graciously sponsored, and they are from Capital Group, Eastspring Investments, JP Morgan, Lion Global Investors, Nicole AM, and UOB AM. They have graciously sponsored 6 Apple iPads for everybody to have a chance to win. So, ladies and gentlemen, make sure you come on down to the stage area right now because you have to be here in order to claim your prize. So, ladies and gentlemen, let's now invite our guest for today. Once again, let's welcome General Manager, FSM1.com Singapore, Jean-Paul Wong. Hi, JP. All right, so right here today, we will be having the lucky draw itself. You will be drawing the final 6. And we have been waiting. I can see the eagerness from the people. They've been waiting since the morning. We had $100 FSM credits. We had 4 Apple Watches. And now we have 6 iPad Airs. So, are you ready, JP?
Ready? I'm ready.
I think they're excited. So let's go on with our very first draw. Let's see who will be winning the really amazing iPad prizes. And for the very first one, it will be going to our lucky winner. All right, first one over to you, JP. The numbers are
2,
5,
7,
257, 2, 5, 7, 8. Are you here? 2578. Congratulations. We have Dre 2578. Once again, 2578. Are you here? 2578. Going once. Going twice. Going. Gone. Let's go for a redraw. Here we go. All right. So the next one for our redraw itself. Let's see who will be our lucky winner. The very first one. Once again, it will be
2,
0,
2,
202. All right. 2, 0, 2, 8. Are you here? 2028. Hey, congratulations. Congratulations! Well done! Wow, the prizes are really amazing. Coming on down to the expo over here, and we have a chance to win the iPad. So let's draw out our next winner. Here we go. And the next winner will be... First number.
Same, 2.
2, 9,
2,
292. All right, 2, 9, 2, 6. Congratulations. 2926. Are you here? Going once. 2926. Going twice. 2926. Going. Redraw. Here we go. All right. So with our redraw over here, gonna give away our next iPad, which is going to go to our lucky number of
1,
3,
9,
139. 1391. Congratulations. Are you here? 1391. 1391. 1391. Going once. Going. I can see some people doing this. They're like, MC, can you hurry up next? 1391. Once, twice, thrice. Redraw. Here we go. You're very cute, all of you. Just really want the iPad. Here we go. Our last segment over here. And first number once again.
2,
294. 294. 294. 3. Are you here? 294. 3. We have the name of Niang. Mobile number ending with 2629. Going once. 2943. Going twice. Going. Redraw. Wow, what a lot of redraws. Go ahead, sir. Now, we're going to see our next lucky one, which is going to be our winner of the iPad. And first number once again.
2,
6.
1.
2, 6, 1, 8. 活了，有没有？2, 6, 1, 8. Well done. At this point of time, we really want to give out the prizes over here. So we're giving out our second one and we're going to give out our third one right here, right now. So let's see who will be the lucky winner. JP, I love it when you go inside. You're really digging, really fair. Okay, really fair. First number, what do we have?
2,
2, 5.
7.
2, 5, 7. 2, 5, 7. 2, 5, 7. 0. Are you here? Hey, congratulations! I love it. All right, here you go. We're gonna have the prize over here. Congratulations! Congratulations on winning the iPad, and it's going to be great fun over here. Many prizes to give away, and of course, we're going to give away to our very next winner of the 4th iPad itself, coming right up. Here we go. All right. Now. Hello. Annyeong. All right, so, we have a change now. We had the 1s, we had the 2s, and of course now we have the
0,
0, 5. Okay, the moment I hear 0, a lot of people light up. That means these are the early birds, the ones who came since like 10 a.m. 0, 5, I've not forgotten about you. Next number.
0,
0, 5, 0. 0, 5, 0, 1. Now you here. 0501. Going once. Going twice. Going. Redraw. There we go. All right. Coming here since the morning. Go back kun now, So, yeah. But hey, iPads to give out to the people who are here. And now the first number once again goes to
1,
3,
6,
136. 136. 136. 9. Are you here? 1369. 1369. Going once. Going twice. 1369. Redraw. Here we go. All right. Now let's see who will be our lucky winners here today. Here we go. Now, great job. Let's go.
0,
0, 1,
3,
0, 1, 3, 0. Are you here? 0130. 0130. 0130. Going once. Going twice. And redraw. Wow, at this point I'm getting desperate to give out the iPad. Maybe I take one, you take one, then... Okay, come on. Need some luck, Must send your energy here. Now, the first number.
2,
1,
3,
2139. Are you here? 2139. 2139. Going. Oh, congratulations! Well done. All right, here we go with our lucky number of 2139. Come on up, man. Here we go. what a great prize to give away. We have 3 more iPads to give away. Once again, they are sponsored by our beautiful, beautiful sponsors. And of course, with that said, we want to thank you and congratulations, ma'am. Now we're going to move on to the next iPad prize as well. Sorry, we have 2 more iPads to give out. 2 more iPads. So, iPad Airs, our very, really coveted prizes. And the numbers will go to
1,
6. What is number? Very nice. 169
9.
1699. Are you here? Yeah, congratulations. So with that said, just to highlight as well that for FSM, you can definitely still have a account opening and we will be getting $20 credit. And it's very simple. As long as you have your SingPass, you will be able to sign up straight away. So, ladies and gentlemen, right now, we're going to go for our last and final iPad prize. Let's see who will be our lucky winner. Yes, this is the one. All right, let's hope they're here. Wow, lucky number goes to
1,
6. 3. 163s. 163s, are you here? Any 163s? Anybody? Raise up your hand if you are 163. If not, we'll just skip the last number. I won't even tell you, you know. 163s, don't have? Really? Where? Oh, here. Okay. Only one? Oh. Okay. What's your number, sir? 7. 1637. 1630. 1630. Are you here? Going once. Going twice. Going. Good. Here we go. 1630. All right. So here we go. Now, I'm sure he was very excited for a moment. I was the only one. Okay. So here we go. Once again. 2, 1, 8. Okay. Should have more, right? Number 2 is 218. Are you here? 218s. 218s. Don't have? Eh? Where? What? One again? Where? Okay, so 218. 218. Number? What's your last number? Sorry? Okay. Now, 2, 1, 8. It's not 1. It's not 9, I'm sorry. It's not 0. It is 2183. Congratulations! Yay! Congratulations, sir, and thank you very much, JP, as well, for giving out the prizes. Thank you. So, ladies and gentlemen, the fair and the expo will continue all the way till 6 p.m. Please make use of every single minute, every single second to speak to all the different booths, use the connect zone, do the vote and spin, and you still got prizes to win. So once again, just to highlight the few things right over here, for an account opening with FSM1, you will be able to get $20 credit, and it's going to be very simple because you have the SingPass with you. It's going to be very, very fast. And if you do refer a friend, you will also be able to get $20 of credit, and it's both the referral and the referee, so both of you will get $20 credits each. Ladies and gentlemen, we still also have our vote and spin, and you can cast your votes right over on your left-hand side near the corner of the stage area and get yourself even more prizes. So once again, ladies and gentlemen, my name is Chris Kai, and I do wish you to have a great weekend. See you and have a great 2023 in your investment journey. Thank you.